ones, but this is what actually moves portfolios.
Yeah, and now that number has ceased to sound alarming, because with the number of listings that have happened in the last 4 years in India, any given week you have 500 companies declaring numbers. So it's good. But on balance, I know the overarching opinion from the larger boys who've come on air have said that, oh, the earnings have missed expectations. But if you look at all the reports that from brokerages who track the mid-size space, they are saying, hey, things don't look all that bad. So
even from the print yesterday overnight, quite a few hits.
Yeah.
Maybe a couple of misses, but quite a few hits.
You know, I think it's one thing that you will notice, all of the larger companies, Neeraj and Alex, they are saying that things will get better. It's more the commentary than just the core numbers.
Yeah.
So it's a bit of here looking at it glass full or glass empty kind of a scenario that's coming in.
But I don't know, I somehow feel that there is merit in looking at the glass half full. But just simply, no, as in not generally
just as
life.
a philosophy.
Yeah, not just as a philosophy. I'm saying for FY26, simply because the macros are stacked in our favor, right? Yesterday, Pranjul Bhandari coming in saying that they expect 3 rate cuts. My remote point being, if all of that were to happen, and we are betting on consumption for FY26, so no capex or lack of capex baked into the price, any surprise there because of rate cuts, because of favorable macros, because of lower crude, or because of the first half base effect, and I think things might turn. So I'm looking at the glass half full.
I'm sorry, I want to clarify, because I'll go and watch that conversation, which of course is on YouTube with Pranjul Bhandari, but did she say 3 rate cuts from this point or 3 rate cuts
from this point?
Wow.
In this calendar
year.
Wow.
Yeah, this calendar year, 3 rate cuts. Yeah, we did clarify that as well. Okay, let's take you through what global markets have been doing. So US markets were shut on Monday, but do take a look at the Dow futures. That's important because remember, after markets closed Friday in US trade, that's when Trump came and said that he's pushing the deadline to July for the 50% tariff on European Union. So you did see the Dow up nearly 400 points after that deadline was pushed. It's going to be an important week from a US markets perspective. Economic data will be out on housing, consumer confidence, consumer durables. So all of these key economic indicators will be watched by global investors as far as US markets are concerned. You will also have commentary coming in from key Fed officials, including Neil Kashkari. So that's something that will be on watch as well. Meanwhile, crude prices have stayed pretty steady. Brent is nearing the $64 mark, so trending downwards. Good news for India. Asian markets have opened mixed in early trade. Well, let's pull up some of those indicators. Yeah, the Hang Seng up in the green, Shanghai and Nikkei down in the red mildly. That's the trend on the implied open as well. If you take a look at it, we're looking like we're going to open with a small downtick. So expect another day of range-bound trade. Remember, we've crossed that 25,000 mark in trade yesterday, but staying above it is turning out to be a bit of a challenge. So we will have to wait and see where we head from here. And it was a pretty exciting day of trade yesterday, even though it was range-bound, volatile, but very stock-specific.
Oh, certainly, no doubt. You said it. But 25,000 just above the mark is where we ended yesterday. We'll get to those levels in just a bit, but take a look at the flows data. Because you had buying by both foreign institutions as well as domestic institutions in trade yesterday. Small buy number by the foreign institutions, but that is still going to be taken as a positive sign. 136 crore rupees or thereabouts deployed. For the month as a whole, they have been net buyers to the extent of 17,000 crore rupees or thereabouts. Let's talk about what happened in trade yesterday. Markets started the week with gains, of course, building on Friday's momentum. The Nifty 50 traded in a 179-point range and ended just above the 25,000 mark with gains of about 0.6%. The broader markets kept pace, gaining about 0.6% for the mid-cap index and about 0.5% for the small-cap index. Now take a closer look at the Nifty 50. 38 Nifty 50 stocks advanced, 10 declined, and that was led by Eternal because of the flows update that we got you at the start of trade yesterday. JSW Steel was a key mover in trade. It gained 5.4% from the low point of the day after that Supreme Court order. What did the Supreme Court do? And we'll talk about it in more detail today. It ordered a status quo on the Bhushan Power liquidation. That's certainly seen as a positive for this stock. It ended with gains of 2.2% or 2.4% or thereabouts. All the major sectoral indices gained, led by defense once again and auto. IT also was up there among the gainers, up about 1% or so. And an interesting note coming through today on the IT pack, I'm sure we'll discuss that as well. The Nifty Bank underperformed relatively, gained only about 0.33%. The market breadth overall was favouring the advances in a 2:1 ratio, which was pretty good over the course of the day. If anything, it might have actually collapsed a little bit towards the end of the session. The India VIX climbed about 4.3%, indicating higher volatility, and that was at 18.02 at the end yesterday. A couple of key movers, and there were more, as Tamanna has pointed out, but I've just picked up a few. BEML gained about 15%, very strong move on the back of a Q4 that was quite positive, as well as an outlook that looks very good. GVTND, we spoke about it at the start yesterday. It was locked in upper circuit through the session yesterday after that strong earnings performance in the fourth quarter, and another earnings reaction in the form of Gillette. I think a lot of people being inspired by Neeraj and myself, and making changes to the bearded look, Neeraj.
At the cost of saying that, oh, they are not looking at the Indian cricket team, but looking at us too. But
I wanted to say Alex's beard lasted 2 days, and nobody liked it except your wife.
Yes. No. Actually, she's the one that got me to shave.
Okay, eventually.
Okay. So, guys, I'm doing a bit of a change today. Every day we talk about the trade setup and sectors. I mean, we spoke about insurance, we spoke about pipe companies yesterday, and they did well. And today, I mean, it's a simple math that metals will do well because the China industrial profits have risen and the output has beaten estimates despite the tariffs, right? So you expect metals to do well. So I'm kind of standing on the shoulders of Citi and making that as the trade setup, because they've got a feedback from a US roadshow with 25 investors, and we all want to know what the FI is thinking, right? So here's the first-hand feedback for today's trade setup from the Citigroup note. So they met with 25 portfolio investors in the US to discuss India's macro and financial sector trends. They found investors to be constructive on Indian macros, not yet reflecting on their India investment positions. And hence, you kind of corroborate that with the fact that, yes, some bit of money is coming, but not all of money is coming. So will money come in now, in the next 6 months? That's the other key thing, right? So towards the end of the year, so to say. They say that signs of urban consumption recovery on the back of fiscal and monetary stimulus could change investor perception. Now, viewers, you tie this point in with what HSBC was saying yesterday, that this time around for FY26, focus on consumption, not as much on capex, and you need consumption to get revived and mark up, because that will drive GDP growth. It's a year phenomenon, but it is there. They say optimism around capex recovery is still muted, and early trade deal with the US, success of China plus one diversification, and robust external sector are the other areas of optimism. So here's Citi, one of the premier brokerages, meeting 25 US investors, which are the largest pools of capital into India and emerging markets alongside Singapore and Middle East, talking about some optimism out here. So I suffice to say, maybe one more reason why I see the glass half full for the second half. Let's wait and watch if some of this, and if there is a consumption recovery, translates into some bit of flows going higher. Like we discussed yesterday as well, right, guys? That Venkat of IIFL mentioned that there is a trickle of flows that has happened thus far. Expect a deluge to come in the second half. I love that term.
The deluge of flows is definitely awaited. Even the fact that FDI, and I thought that was an important clarification that Pranjul made yesterday and put it into perspective, because that's something that's been hitting headlines, that FDI in India has plunged by, some 95% over the year. So she's saying that foreign investors across the world are not willing to go out and make plans, because how do you know what's going to happen? I mean, think of a Tim Cook saying, okay, I will make in India, because, China is a problem. And then Trump says, no, even that doesn't work. So how do you plan anything in an environment like that? So that's the overarching factor to watch. But for today and for the rest of the week, let's get specific. Over 200 earnings will be reported today. Watch out for LIC, Life Insurance Corporation. I think that's a big set of numbers that we should watch out for. We've been talking about how the insurance space is finding a new lease of life, and LIC has been buzzing ahead of its numbers as well. The other factor, it's I don't think at alarm level. Let me put it in monsoon parlance. It's not a red alert. Maybe it's an amber or a yellow or an orange alert right now, which is the active COVID cases. The number has crossed 1,000 in India. Most of the cases are mild. There have been some deaths reported for people with comorbidities, but that's one factor to watch out for. As far as levels are concerned, Nifty is poised for a potential consolidation with key support placed in the 24,850 to 24,900 zone. A break below this area could trigger selling pressure. Think of it this way, we're poised at a point where we don't know which way the index could move. You could see either way today. If this holds above this support level, a move towards 25,200 to 25,300 range remains likely. This zone may act as near-term resistance, and a breakout could lead to a sharp rally. The Bank Nifty continues to trade with a narrow consolidation band of 54,442 to 55,876 seen over the past 11 sessions. Yesterday, the index did approach the upper end of the range intraday. It failed to achieve a breakout though. A close above the 55,700 mark would lead to a retest of the all-time high near 56,100. Resistance at 55,800, support at 55,368. So those are some of the key levels to watch out. But what's all the action in the derivative space? Puneet is joining us for a lowdown on that.
Well, thank you for that. Definitely a very narrow band in trade that we've seen, but one of the key positive was achieving that 25,000 mark yesterday again. While the cues weren't indicating that at the start, there was expected to be again a range-bound session. Yesterday, the GIFT Nifty was up about 100 points before the trade started. Today, it's largely in the 6 to 7 point range. It's not been too much. Currently down 8 points as well, but maintaining that level, of course, goes without saying, will be one of the key levels to watch out for. On the Bank Nifty as well, we've also seen a very sharp, cut in open interest specifically for the Nifty 50 futures, as well as for the Bank Nifty. Though we've largely maintained that level and seen another cut in open interest for the Bank Nifty as well, above the 55,600 mark comfortably, and closing on to that 55,700 mark for the Bank Nifty. Overall, for the FI positions, we've largely seen the FI maintain a long position, which is a bullish sentiment, continuing their long position, as well as the increased interest in markets for the Nifty options, almost roughly 30,000 crores, as well as just some short positions seen in the Nifty Bank future specifically. Let's also look at the PCR. We've seen it maintain and hover around the 1.07 mark. Is largely been and maintained around the 1 mark. So that's largely a key sentiment between both those verticals, maintaining both in calls and puts at a similar level. While the index long position has moved up from 32% yesterday to 34%, and that's reflected in the previous chart as well. Finally, in terms of open interest distribution, and this is the final thing that we're going to talk about, 25,000 as a key level has seen increased call interest. We've also seen an increased interest in puts at that similar level now that the range has narrowed for the trading in the Nifty as well as the Bank Nifty. 25,500 is another level that's been largely maintained as an out-of-money call option. But again, today will be another day, could possibly be where there is trading in the narrow band, and a lot of stocks could react to earnings as well as news specifically.
Okay. Specific news is going to be the name of the game. Look at that, implied open is just shrunk to 8 points down. So expect a flat open. You could also tip into positive territory by the time we get to 9:15. All right, stocks on my radar, on my watch list, a lot of them, 2 of them driven by results that they have declared for Q4, and one is news related. So Akums Drugs is the first one on my list. It's a thumbs up, good set of numbers. Revenue up nearly 12% to 1,056 crores versus 944 crores for the quarter. EBITDA is up to 93, nearly 94 crores versus 2.9 crores. Margin has expanded massively. So there are one-offs. There are one-offs which have contributed to what is optically looking like superb numbers. So keep that in mind. Nevertheless, profit has also gone up 147 crores versus a loss of 41 crores. So what are those one-offs? PAT has been aided by other income. Other income is up by 71%. There was an exceptional gain of 8.2 crores in the current quarter. Deferred tax credit of 94.8 crores in the current quarter as well. So the stars have sort of aligned for Akums Drugs in this quarter in that sense, but nevertheless, basis that, a thumbs up from what you see on the numbers. Electra Green Tech, the other company on my radar, based on numbers, I'm giving it a thumbs up. Revenue up about 55% to 449 crores versus 289 crores. EBITDA up 64% to 56.5 crores. Margins have also inched up, not dramatically, but from 12 to 12.6%. Margin preservation is also good enough in this market right now. Net profit is up 53% to 21 crores versus 13.7 crores. So that's a thumbs up. So is Interglobe. So Interglobe is going to be a block deal, and in fact, news coming in that the size of that block deal has increased. So the Gangwal Group will be selling 2.1 crore shares, that is 5.5% stake via a block today. The offer size is 11,060 crores. The offer price is 5,175, which is a 4.5% discount to the current market price. There is a 150-day lock-up period for the remaining stake. So why is this important? So we know that these two partners, Rahul Bhatia and Gangwal, announced a split a few years ago. Gangwal wants to, exit his stake, which is why that overhang that there will be a sale has now receded until the next block. The Gangwal Group is left with about 8% stake post the block deal today. So far, he's mopped 26,900 crores from his stake sale, and today's deal will give him an additional 11,000 crores. Basically, the size of that block has gone up from 800 million to 1.3 billion. So Interglobe, which is why will be on our radar. Not a bad investment at all for Mr. Gangwal, just say the very least.
Yeah, well, okay, I have nothing to say about that, because when I'm talking about selling investments, it's not like that. Anyway, let's talk about earnings. Couple of stocks that I have on my radar that have to do with earnings, and Beer Crop is one of them. It was a strong set of numbers. And we've said this quite often in the earnings season so far about chemicals, fertilizers companies. You had Gujarat Narmada Valley Fertilizer just a short while back that posted a pretty good set of numbers. The margin performance, just before we get to the numbers, has improved after soft Q2 and Q3. There was other income of 37 crore rupees, which is higher than they have seen in the recent past, but not egregiously high. I'm using a word that Neeraj likes to use. Strong PAT growth both year on year as well as sequentially. Let's talk about what the revenue growth was led by, and that was a strong performance in the spring corn and the crop protection portfolio. And that margin expansion has been led by lower employee costs. So take a look at the numbers. The revenues rising as much as 32%. You had the EBITDA that was up as much as 75% or thereabouts. You had margins that came in at 16.3%, a significant expansion from the year ago period of 12.3%. And the PAT numbers up as much as 49%. Strong set of numbers, should do well in trade today. Up as much as 3% in trade yesterday, trading above its 50 and 100-day moving average, but below its 200-day moving average, which is considerably higher. Let's talk about Vadilal, and it is a weak performance by this company in the fourth quarter. The revenue is up as much as 9%, but the weakness has come in the way of a shrinking of the EBITDA margin, which has come in at 14.1% compared with 18.2%, and that has resulted in a decline in the EBITDA during the quarter gone by to about 38.8 crore rupees. Now, the PAT number as a result is down about 20% or thereabouts and come in at 22 crore rupees. Not a good look for the company. In fact, it is a worse performance even compared with the last couple of years, the track record that they've had. The last stock is on an initiation of coverage by Goldman Sachs. It's on Varun Beverages, and this is a stock that has been in focus in the recent past. It was up and about on Friday, losing a little bit of ground in trade yesterday. The target price has been set at 600 rupees. That implies a potential upside of over 24% from that Monday's closing. What are they saying? They're saying that they're unlocking market potential through superior execution, and they have multiple drivers to outperform India's fast-growing ready-to-drink market. The international expansion is also an opportunity, and the strong past track record is certainly something to bear in mind. There isn't too much of an impact on account of Campa Cola, according to GS, and they don't see a disruptive impact. And they also see that there's going to be an inflection in the free cash flow as the high capital expenditure phase is now behind the company. So all factors in favor of Varun Beverages in the opinion of Goldman Sachs. As I said, 24% upside is what they're seeing.
Yeah, it's interesting. I'm not a cola drinker, but just anecdotally, I haven't seen too many people going out and asking for a Campa Cola at local stores. Sure,
Yes.
it happens at NMACC because that's captive audience, but otherwise, I haven't quite seen too many people going out and saying that, okay, don't give me a thumbs up, give me a Campa Cola. But I'm a minority because I don't really drink
I
cola.
don't either.
You're with the Diet Coke crowd.
No, I'm with no
No
cola,
cola.
no
cola.
fizzy drink
No
crowd.
fizzy.
But just anecdotally, I haven't quite seen. So maybe this makes sense. Okay, just 3 stocks from my end, and I'm using NSE as a stock because it's now traded so frequently. So BSE, NSE, both of them in focus. No,
That's
it's a
actually a
very
good point.
active OTC trade.
Yeah.
Right?
That is a good point.
So SEBI's allowed exchanges to pick 2 days for expiry. Now, much as people may have wanted different things and then new people wanted, okay, all of us should have our days, I think finally it's boiled down to 2 days for expiry, a Tuesday and a Thursday. So NSE has likely picked Tuesday as its expiry day. We don't have a final confirmation of this, but very likely that NSE has done that in the new scheme of things. And BSE, remember, currently has Tuesday as its expiry. So therefore, there are 2 things out here, right? Does BSE continue to stay with Tuesday, or does BSE do Thursday? Either ways, it's a bit of an added competition for BSE, which in the future, which had gained some market share in the recent past, and NSE had lost. Now, in a recent con call, I think NSE chairperson had said that this is about the extent of the loss that we'll do. They will be hoping to recoup some market share. I would suspect that while the die is not cast, this would be an overhang for BSE. So in the last 1 month, BSE has gained about 12-13%. So do keep an eye out for Bombay Stock Exchange. Might be under a bit of a cloud today or over the near term. KEC International, we'll speak to the management a bit later on in the show as well. Revenues up 11% at 6872 crores, margins at 7.8 versus 6.3. That on that base is a very good margin expansion that they have shown. And profit after tax up 77% at 268 crores versus 151 crores. Remember, viewers, almost everybody is saying that there is enough power being produced. Evacuation is a problem, and therefore transmission and distribution companies will effectively have very good growth. We'll corroborate this with the management joining in a bit later on in the show today, but let's see if KEC has any positive reaction on these numbers or no. The margin expansion was pretty heartening. And then I'll watch out for PG Electroplast. Remember, viewers, there is Indigo, a block deal. There is Sagility OFS. And because it's an OFS, it might have an overhang and may continue to stay lower. The one that might bounce back is PG Electroplast, because this was about the overhang that stayed on PG. I don't think there is a further block after this, and therefore, if this is a clean out trade happening at a 4% discount and not a substantial discount, I would suspect that post the block, the stock might see a bit of a bump up. So keep an eye out for PG Electroplast in the session today. That might do well. So guys, in terms of these blocks and OFSs, PG probably a thumbs up. Indigo, Tamanna, I don't know how you think about it.
Thumbs up, I think.
Thumbs up,
Thumbs
maybe.
up in my view only because the overhang is done. Yes, I mean, technically you will have sale today, so demand supply, and from that sense you will have some weakness. But from an investor's point of
For
view,
the near term, it is done.
Yeah,
You're saying.
at least it's done, because this was coming, and now it has come.
Yeah, and on Sagility, because it's an OFS at a 12% discount, at that floor price, great valuations, but suffice to say, it will not necessarily have a very sharp bounce back, very likely could crumble a bit. Again, it's an offer for sale and not in block, so won't be done in a block window, but being offered, so might have that overhang. So 3 stocks with large deals in focus this morning.
Just on BSE, NSE, just wanted to add one point that June 15th is the deadline
Yeah.
for all exchanges to come and, talk about their preference. So yes, this conundrum is there down the line. What happens if both want Tuesday? And obviously, any exchange will want the earlier day of the week, just because that's how volumes will flow, and you want most of the volumes. In the earlier avatar of all of this, NSE had an advantage because they had, the Tuesday expiry, bulk of the volumes on Nifty expiry. So let's see how that goes. So June 15th will be important to see. We're on top of that story. Another story that NDTV Profit is on top of this morning, it's an exclusive. Sources tell us that top 6 infra lenders are writing to the Reserve Bank of India to ease project financing norms. They will be recommending that the RBI consider a one-size-fits-all approach, or not consider a one-size-fits-all approach, actually. Suhana brings us those exclusive details.
Yes, so hi. All top 9 infrastructure financiers are actually planning to send the recommendations to the Reserve Bank of India to ease project financing norms. This is because they believe that the proposed stringent project financing norms could actually, stall India's ambitious infrastructure growth plans and could also, increase costs for developers. What they're asking is that the RBI should actually go for a sector-wise approach and look at probability of defaults and loss estimates that are published by rating agencies, and then ascertain the provisioning instead of going for a 5% provisioning on all existing and fresh project finance loans. Like you said, they're actually recommending the RBI to do away with a one-size-fit-all approach. They're also asking the RBI to actually look at data which is backed by banks and NBFCs and rating agencies and publish it publicly, which could improve transparency. They're also asking the RBI to align these norms with international practices and look at IFRS's expected credit loss model, which could actually avoid excess provisioning. What they're also saying is that the RBI should remove extra provisioning when a project actually reaches, is in operational status, when it is in stable cash flows. So these are the recommendations that they've made based on the proposed stringent guidelines that the RBI had come out with in May 2024.
All right, thanks so much, Subhana, for getting us those details. Certainly a story to watch out for in the regulatory space. Let's talk about earnings that didn't go as per plan and were disappointing. We've got Harsh joining in to tell you about a few of those. Harsh, Brainbees at the top of the list?
It is. In fact, last 6 quarters, this is the lowest EBITDA number, or rather EBITDA margin number that Brainbees has clocked. Largely, a couple of factors. One is some factors playing on the top line. A shorter winter is what contributed to a slight miss with regard to the top line, but really ESOP costs mounted, and that kind of has impacted the margin number, and that's what's created that bit of a drag in margins. There's also been an increase in the other expenses, so both of those impacting the Q4 margin number, which has come in at sub 1% versus the near 2% number same time last year, and thereafter we had seen a recovery through all 3 quarters of this financial year. So this is surely a difficult quarter for a Brainbees, but they've made additional disclosures which is a positive, giving a breakup of the business. So maybe that kind of sentimentally adds to some bit of positivity. Let's talk about Vadilal now. Margins impacted by raw material costs, and a 25% increase in raw material costs. Revenue was up just 9%. That's impacted the margin number, which is the lowest Q4 margin number in over 4 financial years. What we've seen is EBITDA is in fact down on 15% on a YOY basis. Margins have come in at 14.1%. Profit down 20% on a YOY basis. Last off is Capacity Infra. Now that one again, lowest margin in over 15 quarters is what Capacity has clocked this time around. Revenue is up around 12% odd. Margins are down 23% on a YOY basis. Margins are sub 13% versus over 18% same time last year, and profitability down around 1.5%. That's because other income has aided the profit after tax number. Other income has jumped over 3x on a YOY basis.
Okay, just want to add on Brainbees, and this is something Harsh mentioned, that there could be some upside because of the extent of disclosure. So just for context, what Morgan Stanley is saying on Brainbees is what I wanted to add. They have in fact maintained an overweight and given a target of 574, which is steeply above what the current market price is. This is the reason. They say the top line is actually in line in their view. Of course, there is a miss on margins, but improved disclosures for the first time, which is something that Morgan Stanley finds heartening as far as Brainbees is concerned. They said for the first time, the company has disclosed the apparel and footwear category share in India. The multi-channel GMV is at 52%. Management is focusing to improve offline growth in India and driving margin expansion in global bees. So take a look and watch out for what happens there. The numbers on the face of it, yeah, could look bad, but there seems to be some silver lining as far as Brainbees is concerned. Okay, let me quickly recap for you what's on our watch list this morning. KEC International is a stock we're watching out for. That's the profit watch list for you. Its best margins in over 15 quarters. We're going to be hearing from the management as well. Electra Green Tech as well, something we're watching out for. Strong EBITDA growth. Bayer Crop has seen a sharp quarter-on-quarter and year-on-year rise in margins. Varun Beverages, Goldman Sachs has initiated coverage with a 24% upside.
Okay, all right. Now you also have PG Electroplast. The promoter is set to sell stake. This is something that Neeraj pointed out. Interglobe Aviation, the other block to watch out for. Gangwal is set to offload a 3.4% stake. Lumax, on the back of earnings, is set to respond. It has posted a strong top line as well as a profit growth.
Okay, on the downside, Aurobindo Pharma, their PAT has missed estimates. Brainbees Solution, ESOP costs have gone up, margin pressures as well. But like I told you, Morgan Stanley is quite happy that they have at least given some disclosures. Vadilal Industries, raw material costs have impacted margins. And then let's add a Sagility. There's a stake sale by promoters, which may definitely not be taken well in this market. Maybe the offer for sale pricing could be a bit of a silver lining. Time for a very short break, but we'll be right back getting you the top trading strategies of the day. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Welcome back. You're watching India Market Open, and Indigo is a stock that we've already discussed, and we've spoken about how this has been a fantastic investment for Rakesh Gangwal. Well, he's set to sell additional stake in the company along with the Chinkapu Family Trust, and we've got Somit joining in to tell you about this particular deal as well as all of the stake that has been sold so far and how much that amounts to. Somit.
Well, yes, Indigo will remain in focus. The Gangwal Group will be selling their stake, partial stake via block deal today. So they're looking to sell close to 2.1 crore shares. That is 5.5% of the equity. The offer size is close to 11,000 crore rupees and the offer price is around 5,175, which is at a discount of nearly 4.5% compared to yesterday's market price. Now, post this block deal, there's a lock-up period for the promoter to sell the remaining part of the stake, and that is of around 150 days, which means that for the next 150 days, there won't won't be any block coming in from the Gangwal group at least. Now, this block deal will reduce the overhang that Indigo had currently that was there on Indigo, given the fact that everyone on the street knew that there would be a block deal coming in from the Gangwal group, and post this stake sale, the Gangwal group will be left with around 8% stake, which again could come on the block in at least one or two deals. Now, so far he has mopped up close to 26,900 crore rupees by selling his stake in Indigo, and this deal will give him additional 11,000 crore rupees. Now, why Gangwal has been selling his stake? Now, he resigned from the board of directors of Indigo back in 2022, and he had stated very specifically that he will be looking to sell his entire stake in the company over the next 5 years, and that is what he has been doing so far. Now, Rahul Bhatia and Rakesh Gangwal were the co-founders of Indigo, and they had a fallout back in 2019, and this was owing to disagreements related to related party transactions and corporate governance. And since then, Gangwal Group has been completely exiting from Indigo. Now, this has been an overhang on the stock price, but nothing wrong so far with Indigo on the fundamental side, given the fact that they are the largest airline company in India with market share of more than 60%. They have been gaining on the back of strong air traffic, stable fuel prices and stable ticket prices. However, for the first quarter of FY26, they have hinted that it could be a bit weak compared to what it was last year, given the fact that there was geopolitical issues which had impacted the ticket sales in the first quarter of FY26. Now, how are analysts viewing Indigo? Currently, if you look at all the analysts that have been tracking Indigo, around 82% of them have a buy rating. There is hold, around 9% of them have a hold rating, while around 9% of them have a sell rating, and the 12-month consensus target price for Indigo stands at close to 5,939 rupees, which suggests a return potential of around 10% from the current levels.
Sumit, thanks for that, but I have a follow-up, Sumit. So this is not the only deal, right? While there is Interglobe Aviation and Sagility as an OFS, the one that I pointed out in the morning was PG Electroplast. And I, for one, thought that because this is a clean-out trade of sorts, maybe there could be a bounce here. Anything that you are gathering from your dealing room sources or otherwise about PG?
Well, as the demand for PG Electroplast is quite strong, multiple domestic mutual funds have already shown interest for this block. And if you look at PG Electroplast, despite reporting a strong set of numbers in the fourth quarter, the stock has been quite range-bound. In fact, it was trading at around 900 rupees at one point of time and currently has been range-bound around 750. So yes, the stock could bounce back after the block, given the fact that this block was a big overhang on the share prices. Now here, if you look at, the promoters are looking to sell close to 1.59 crore shares, that is 5.6% of the stake. The offer is given at a price of 740 rupees, which is at a discount of just 4% to the market price, and the overall offer size is close to 1200 crore rupees. So yeah, the stock could actually bounce back, given the fact that this was a big overhang on the stock. And the second company that we need to watch out for is Sagility, where it's an OFS. Promoter is looking to sell up to 15% stake in the company. This is including the green shoe option, which means that if there is a strong demand, they will look to sell close to 15% stake. Now, this OFS will open for non-retail investors today and for retail investors tomorrow, that is May 28th. And the offer price for this OFS is around 38 rupees per share, which is at a steep discount of nearly 12% to the current market price. And post this OFS, the promoter holding could come down to around 67.4%. And this will also help the company or the promoter to meet the minimum public shareholding requirement norms that has been prescribed by SEBI. Now, if you remember, Sagility listed back in November 12, 2024, and the IPO price was 30 rupees. So the current market price is at a premium of around 43% to the IPO price, and this OFS is being done at a premium of around 27% when you compare it with the IPO price of 30 rupees.
Okay, that was at full speed, Sumit. So those are the three block deals to look out for this morning. Kunal Rambia off the street with us this morning. Sunny Agarwal, SBI Cap Security, is also joining in. A very good morning to you. Kunal, let's start with you and your take on the index and the levels that we could see today, because there's a hesitancy. Yes, we managed to close above the 25,000 mark, but not convincingly, let's be honest. There's been a bit of a fight. Where do you see the index going today?
Good morning, everyone. So if you look at the index, as you rightly mentioned, it's been range bound. Nifty is in the range of around 24,800 on the lower side to 25,150 on the higher side. And this range we are witnessing since around 15 trading sessions. So certainly the trend is absolutely positive, but there seems to be some kind of selling pressure near 25,000 to 25,150. But still, the target of 25,500 remains open on the chart. Buy on dip can be a good strategy here, and 24,800 should be in mind as a support. As far as Bank Nifty is concerned, at the beginning of the month, we also discussed about, the Nifty outperforming Bank Nifty because Bank Nifty managed to come up to 56,000 very quickly. And that is the only reason. I think the more sideways consolidation is seen on the Bank Nifty right now. It's been almost 24 trading sessions. It's in the range of 54,600 to 55,900. But if it manages to cross 55,900, then I think the target of 50,000 or 57,000 are also likely in the month of June.
Okay, let's talk about your picks as well. And there are three of them, Kunal, this morning. Good morning to you. The first one, I believe, is Adani Green.
Absolutely. Good morning, Alex. So the first one is Adani Green. This counter has managed to come out of its consolidation. It retested the breakout zone, and yesterday it was up by around 2.5%. I think the momentum is gathering on this counter. So with the stop of 1,000, one can think of initiating a buy on this. The minimum target on this is 1,100. The second is HCC. Counter has come down significantly after a broad consolidation. Yesterday it was up by around 6%, and good volume activities are seen on the daily chart. So keeping that in mind, stop loss can be 29. One can go long with the target of 35. And the third is SW Solar. Now this counter was in upper circuit yesterday. In fact, it's making a clear higher top, higher bottom on the daily chart with the stop of 280. One can go long. The first conservative target on this can be 310, and all three of them are looking really good from the long-term point of view also. So trailing stop loss would make a lot of sense rather than keeping target in mind.
Okay. All right. Interesting list. By the way, standard disclaimer, of course, the Adani Group owns Adani Green and NDTV. NDTV Profit is part of the NDTV Group. Sunny Agarwal joining us this morning as well. Sunny, very good morning to you. And let's first talk about Interglobe Aviation. We've been seeing selling of stake by the Gangwal Group over a period of time, but that seems to be drawing now to a close after this latest deal. Of course, there will be a residual stake of about 8% post the deal. But would you say that that key overhang now goes away and the fundamentals have been strong in any case? Would you suggest a buy?
Yeah, good morning, everyone. Good morning, Alex. Yeah, definitely. I think once this overhang of selling the promoter is over, definitely it will lap up the Interglobe Aviation. And so if you look at numbers also, at least in terms of valuation, if you look at Interglobe Aviation, the company is trading at close to 25 times FY26 earnings and 12.5 times EV/EBITDA on FY26 estimated number. And at the same time, I believe all the concerns regarding the non-availability of plane is getting addressed as far as Indigo is concerned. And again, being a market leader, I feel one of the most profitable organization globally in aviation space. So I think definitely all the investor, whether it is institution or retail or HNI clients, they would love to add this stock in the portfolio in the once this overhang of selling by the promoter is over. We believe the fair value of Interglobe is close to 6,000, 6,200. Keeping that price target in mind, one can approach Interglobe Aviation.
Okay. I saw an interesting note today on Varun Beverages, and it led to some conversation here as well, Sunny, about whether or not there is disruption. Goldman Sachs does not believe that there is disruption in the form of new entrants. Do you hold that that is the view, or do you think that there is disruption and there is an eating up of market share?
Yeah, so again, I feel, of late there has been a lot of talk about disruption in this beverages space by the new entrant and discounting, so on and so forth. But what I feel is that ultimately, Varun Beverages being way ahead in terms of its distribution network, in terms of its brand popularity, in terms of diversification. So recently we have seen Varun Beverages foraying into South Africa as a territory. They have recently forayed into snacks. So there are multiple growth levers as far as Varun Beverages is concerned. And I believe that any increase in competition won't dent the growth outlook as far as Varun Beverages is concerned. And I think if somebody is a long-term investor, definitely it's one of the portfolio stock and can be added in the portfolio. And again, as per the street consensus, also our fair value also lies between somewhere 550, 575 rupees. Keeping that price target in mind and investment horizon of 12 to 18 months, one can approach Varun Beverages.
Okay, so Varun, beverages, that's the view coming in. Kunal, in terms of IT stocks, an interesting note from HSBC on IT as well today, and it's been, you know, an up and down kind of a scenario as far as IT is concerned. Is there anything that you think is ripe for the picking right now?
Absolutely. So I was very comfortable. We had discussed earlier that I was very comfortable with Infi and TCS. In fact, Infi was along at 1435, and since then this counter is making clearly higher top, higher bottom. In fact, a fresh breakout is now on chart at above 1620 with the target of around 1800. So yes, buy on dip can be also good strategy, but if someone wants to play momentum, I think Infosys above 1620 can give us good opportunity. Similarly, is the case with TCS, perfect inverse head and shoulder on chart. So with the breakout of 3600 and stop of 3500, one can go long. Targets can be 4000, and both these counters are offering great risk reward ratio from long term point of view. So someone should actually consider these underperforming counters so far as a good pick for next 3 to 6 months.
Okay. Sunny, we discussed the block deals internally. I just wanted to understand from you if PG Electroplast were to start off lower today, is it a stock that you might want to buy? Also, if it doesn't start off low today but starts off flat, because we hear that there is fairly good demand for the block, what's the call on that one? It's certainly not cheap, but it's a high growth stock.
Yeah, definitely, Neeraj. I think a solid set of numbers reported by PG during the fourth quarter and the kind of outlook which they have given, it seems that company will continue to report a healthy growth during FY26 and FY27 number. So already they are working with more than 35 air conditioner brands. The April-May demand has been very strong as per the commentary of the management, and their compressor plant is likely to get commercialized in fourth quarter of FY26, which will again drive growth for FY27. And at the same time, their JVs are likely to witness an EBITDA margin expansion. So we believe that again, it's a good opportunity if somebody want to add PG Electroplast in a long-term portfolio. We believe that the fair value of PG Electroplast is close to 950 rupees, although trading at expensive valuation, at currently trading at close to 44 times FY27 price to earning multiple.
Okay. All right, Sunny, thanks so much for that view. We'll circle back to you because we've got an interesting research-based piece to talk about, and that has to do with the paint space. Speaking about competition heating up, this is one space that has seen the implication of that in the way pricing has moved, in the way margins have moved in the quarter gone by. Now, Sajid is joining us to tell you about what his key takeaways have been from the fourth quarter results and the way forward. Sajid?
That's right. The paints business is now heating up. In FY25, it was one of the, a blockbuster year with respect to the capex coming into the industry. The paint sector itself saw a capex of more than 10,000 odd crores, led by new entrants like Grasim through Birla Opus. And there were other smaller players which were adding more capacity to get into the premium and luxury segment there. We had 3 new entrants that came into the paint segment, with Birla Opus being one, then you have JSW, and then there were smaller players like the Kamdhenus and others who started some of the paint operations in this segment. And that led to a drastic churn of market share within the decorative paints market, which accounts for nearly 70% of the total paint industry there. If you look at it, Asian Paints being the largest paint maker with over 50% market share was the biggest loser in this thing at the end of the year. Birla Opus ensured that there was a dent in the premium and the luxury segment, and there were other players like a Berger, the Nerolac and Indigo, which gained market share in terms of revenue going into the year. What was important and striking was that the industry as a whole did not grow much. There was a stagnant market. It was a stagnant market. There was no organic growth. Urban discretionary spend was slow, and rural was picking up. If you look at the total revenue of the industry in FY25, and I'm talking of the 9 listed companies in the paint segment, the revenues grew by only just 2% in terms of absolute revenues there. So listed companies' revenue went up by 2%, and incumbents, which are Burgers, the Nerolacs, and Indigos, did gain some market share in terms of revenues. And there were, while profitability was hit because there was an extensive price war which was coming in, because every company was trying to maintain their market share in this lucrative market, which was a high margin business, premium and luxury segment being the one. If you look at the revenue market share, how it moved during the year, Asian Paints at the end of FY24 had a revenue market share of 58.5%. By the end of FY25, it came down to 54.5%. Berger, it had 18.2%, it went up to 18.6%, and there are slight variations with other players in the market there. But what is striking here is that the Q4 numbers were a little striking, because the leader in the pack, which is Asian Paints, came back to safeguard its market share. And we saw the revenue market share for Asian Paints just jump to 55.3%. And that basically shows the kind of hyper competition which is there in the market. Players are now vying for the limited demand which is coming in. From a dealer's point of view, the dealerships are not increasing. It's the existing dealer which is, bifurcating demand to multiple paint makers. And so everyone is vying for that demand. And as a result of that, hyper price competition is coming in, higher marketing and distribution spends are coming in, and that's denting the margin for the Asian paints industry. So going into FY26, you have a lower urban demand which is there. Rural is improving, and hopefully if the spends increase, then there is going to be some kind of relief for the paints industry.
I don't think the last word is written yet on Asian Paints. Yes, there will be some initial dent perhaps with competition heating up. I don't know if Sunny has a view on this. Let's quickly get Sunny's view on a very in-depth piece done by Sajid. Sunny, how are you looking at the paint space and some of the key players there?
Yeah, definitely. I think FY25 has been a tough year in terms of demand environment as well as the volume growth. So we have seen a kind of muted set of number from entire paint industry. And we believe that, again, we are hopeful that during the second half of FY26, when the festival season kicks off post-monsoon, at that time we may see some demand revival. And moreover, the benefit of lower base should also start kicking in for the entire paint industry. So again, a cautiously optimistic on the paint industry. One player which I feel has stood out during the entire fourth quarter result season has been the Indigo Paint, where we have seen a very healthy retention as far as gross margins are concerned, and again trading at a reasonable valuation now, close to 30 times price to earning multiple. In case they are able to deliver growth in second half of FY26, I think there is still a scope of a kind of appreciation by 20-25%. But again, hopeful that second half of FY26 where demand will revive for the entire paint industry.
But do you have so you said Indigo has done well, but Sunny, is that the interpretation of that would be that you prefer it? Is that right?
Yeah, so right now, again, tracking cautiously optimistic in terms of valuation and in terms of the way relatively better numbers has been posted by Indigo. So I think I would like to prefer Indigo at a current juncture, although very small player compared to the larger players like Asian or Birla Opus. But I feel that whatever the issues they were facing on distribution side, everything has been resolved. And I believe that FY26 is the year, especially second half of FY26, where they can deliver an healthy earning growth.
Okay. I want to shift focus to another stock. So this was on my list today. I'm curious about what you made of the results. Bayer Crop Science, and it is in the fertilizer as well as insecticide and fungicide space. Crop protection is what it is in, and it had a pretty strong quarter. Sunny, did you study the numbers, and are you positive it's an improvement after 2 weak quarters?
Yeah, again, one has to keep in mind that all these agri-related stocks have a lot of volatility in terms of earning quarter on quarter. So again, that's the nature of the business. But again, coming to the March quarter number, I think very strong set of number reported by Bayer Crop Science. So I think to that extent, it's that will be taken positively by Street. But if I look at a full year number, I think the growth has been muted for the Bayer. And at the same time, valuations are slightly expensive at a current juncture, trading at close to 40 times price to earning multiple. So I would like to stay neutral on bear. In fact, we have got a coverage on Dhanuka Agritech, where we feel that again another player from agrochemical space, very similar to the Bayer crop insecticide, pesticide, that's the portfolio. So there we feel valuation is comfortable, and our price target for Dhanuka Agritech is 2,000 rupees with investment horizon of 12 to 18.
Okay. On that note, we have to slip into a very quick break. Stay with us, gentlemen. We'll be back on the other side. And viewers, we'll be back to tell you about the pre-open. At this juncture, it seems like it's going to be a pretty range-bound, muted sort of an open. Let's see if that pans out. Do stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of
You're watching India Market Open. Let's quickly pull up the implied. We're set for a very flat opening in the markets. About 11 points down is what it's showing, but honestly, it could go either way at this point. But we're picking stocks for you this morning. So let's start with this interesting note that Jefferies has come out with on chemical stocks. And it's essentially their review of the Q4 numbers of some of these key companies. They say Navin Fluorine is better placed amidst flat demand outlook. Innovators are guiding for a flat revenue year on year in calendar year 25 with pricing pressure in LATAM. Chinese agrichem exports are elevated. Crop prices are mixed. Ref gas markets are also flat year on year in Q4. PI is facing demand peak out in key products and slower than expected pickup in pharma. Navin's long-term contract startups provide strong earning growth visibility. That's their story on Navin. Let's come to SRF. They say SRF's valuations are extended with limited visibility on earnings growth. They prefer PI Industries and Navin Fluorine to SRF. So the worst doesn't seem to be over yet for chemical stocks. I don't know if you have a view on this, Neeraj, because this is a sector that you look at fairly closely. And from the last, I think, at least 4 quarters, this is the constant refrain.
Yeah, yeah, and that continues. And therefore, maybe like a few wise men say, right, that it's better to wait for the uptake to come in, buy 5-10% higher, but at least you know that the trend has started, because the longest time people have been waiting for this uptrend to happen hasn't, except for, like you said, Tamanna, Navin Fluorine, which has given very good numbers. So people in fluorination space, and I think Anupam Rasayan yesterday was up 5.5% because again in the same space, or companies which have got this CDMO angle to themselves, like Ami Organics does. So therefore, those are the ones which have kind of delivered okay numbers.
Yeah, yeah. In fact, let's get a view on Sunny very quickly if that's something you're tracking. Interesting note from Jeffries there. Overall, not very positive on the space, but Naveen Fluorine seems to be a standout.
Yeah, definitely. I think relatively fluorine-based player are doing well, and the outlook continue to look constructive. But again, if you want to identify a wealth creation idea within the chemical space, the few names which we are bullish on are a Privi Specialty, again mid to small size player. So there we feel it's a basically turpentine-based chemical. So there the demand is pretty robust, and again a very unique product. One another player which has reported good set of numbers is Camlin Fine Science, where we feel again there the potential for stock appreciation is significantly. Again, they have reported a very good set of numbers. And one a pretty stable company like Vinati Organic, after a long time, has reported a decent set of growth in FY25. And with their plant getting commissioning, we believe FY26 is the year where again the company can report 15 to 16% kind of growth in FY26. So these three players are out among the chemical space.
Only question is that even at this juncture, the argument is, Sunny, that these are not cheap. You were talking about Vinati on a trailing basis 46 times. So therefore, the argument that says that we will wait for FY26, I think that argument was made, unfortunately, at the start of FY25 as well. So what Neeraj is saying, you wait for a 5 to 10% upside and you are convinced that this is actually happening. Is that a better approach, in your opinion?
Again, what I feel is that definitely valuations are not cheap across the market or most of the chemical player, in fact. But ultimately, if you have to allocate certain weight to your portfolio in the chemical basket, then there are few players which you need to identify. And ultimately, these are the few players which we feel are relatively better placed in terms of risk-reward ratio. So maybe accumulate on deep or buy on deep is the right strategy if somebody is looking to enter fresh in all these names.
Okay, Aurobindo Pharma, another stock in focus. First pre-open rates hitting your screen. We're going to wait for those rates to settle down as well before any kind of conclusion on them. But Aurobindo Pharma posted yesterday. Profit has slipped. They've missed estimates, and the con call has also taken place this morning. So Varsha, putting it all together for us. Poor set of numbers. Any sort of relief from what the management is saying in the conference call, Varsha?
Yeah, so first of all on numbers, Tamanna, if you see revenue was in line, but yes, there was a miss on margins front and of course net profit front. The EBITDA margin impact that you're seeing is due to higher other expenses, and though the good thing was the US business grew almost 13.5% driven by volume, stable pricing and new launches. Europe business grew 16% year on year, which was led by strong performance across key markets, and the net profit impact that you're seeing is due to higher interest costs and depreciation expenses, and of course share of loss of associates and higher tax also impacted the net profit. On the key con call highlights, I was just listening to con call wherein what they're saying is this: the gross margin, which is at 59%, was supported by benign raw material and better product mix, and they are continuing to see the benign raw material which will actually impact positively to the company. Also overall, if you see the R&D expenses were at 5% for Q4 FY25. There was a temporary halt of Kakinada plant due to fire incident, which also impacted overall financials for the company, and they've expanded formulation manufacturing facility to drive the growth, and they're also working on multiple respiratory products, and they're confident to continue growth trajectory for FY26, but they're expecting a high single digit of growth for FY26, and they're going to sustain EBITDA margin at around 21%.
Okay, all right. A quick view, Sunny, on Auro Pharma. What do you think?
Yeah, again, I think right now the con call is going on, and what I'm getting a figure is that FY26 is the year where they will be able to maintain their EBITDA margins during the FY26. So because of this one-off expense, there was a dent during this quarter. So again, we continue to remain constructive on Auro Pharma. But within, again, if you ask me, I mean, any other better pick compared to Auro Pharma, so definitely there are better choices which are available as compared to Auro Pharma. So again, we are more bullish on mid-sized pharma companies. So companies like Shilpa Medicare, somewhere where we have seen a very good set of numbers by Shilpa. At the same time, Blue Jet Healthcare, where we again one of the stock which we like among the pharma mid-cap name.
Okay, well, Blue Jet and the management spoke to us a little while back. Again, sorry, while we spoke about companies, CDMO, pharma, etc., which have done well, Blue Jet kind of features in that list as well. So it's a pharma name, and almost everything in the pharma CDMO space has done well. Now, we spoke about Electra Green Tech in the morning too, so keep that in mind. Numbers were very good. Maharashtra government, the news is, may likely cancel the bus order awarded to the company after failure to deliver 1,000 electric buses within the timeline. Stock maybe starting off slightly lower because of this order cancellation, but the numbers look pretty okay. Kunal, no, assuming that it kind of trades in this 1300 range, Electra Green Tech used to be a trading favorite, kind of out of the ranks of late, would you trade this one?
So, Neeraj bhai, good morning. If you look at the overall performance of Electra Green from Feb 2024 so far, this counter was down by around 55%. And after a massive decline, now this counter is turning into sideways consolidation. So, yes, certainly if there is an opportunity to buy this counter somewhere near 1175, 1180 kind of levels, then yes, it can be a good opportunity, provided someone is holding for a longer period of time. Otherwise, your approach, which you mentioned just now, then let the counter go up and pick up the momentum. We initiate the trade then. In that case, I think the breakout is placed at 1400. One should initiate a buy above 1400.
Some stocks that are buzzing this morning in the first 3 or 4 minutes of pre-open trade. Bayer Crop, because of numbers, nearly 7.5% up. KAC International, decent set of numbers, 4.5% up on that. Acums Drugs we spoke about, that is seeing an uptick in the first few seconds of trade. BSE on radar. So 15th June is the date at which all exchanges can tell the SEBI what they want as their expiry day. But SEBI yesterday making it clear it'll be Tuesday or Thursday and you have to pick one. So BSE actually with a 2% uptick, not a downtick this morning. I think the last word is still not out on who gets that coveted Tuesday expiry spot between the two top exchanges. Also want to talk about some of the block deals that we've been covering. Let's look at Sagility, let's look at Interglobe. The very simple explanation is that if there's a big bulk of stock coming into the market, is going to depress the stock price. Some of these are promoter stake sales, so Sagility about 5% down, PG Electro also seeing a bit of pain. But let's go to our top brokerage call this morning. Goldman Sachs has initiated coverage on Varun Beverages with a buy rating. Why have they set a 600 rupee target price? Harsh.
Well, it's a very interesting note, Tamanna, and good morning to everyone. The target price here is 600. It's a 23% upside from the close yesterday. They believe, or rather Goldman Sachs believes, that there are multiple drivers to outperform. India is, of course, a very fast-growing market, and Pepsi markets, or rather Varun Beverages markets Pepsi products in India and manufactures it. Now, the per capita ready-to-drink market in India is the lowest globally. So the opportunity size is extremely large. There's a high growth headroom is what they are underlining. Execution has led to growth of PepsiCo's market share in India. Market share is up for PepsiCo from 28% in 2015 to 38% in FY24. And they attribute this largely to Varun Beverages. India is one of PepsiCo's best performing markets worldwide over the last decade, and they expect Varun Beverages to gain share in the fastest growing segments, which is energy drinks and hydration going forward as well. There's no disruption that they see from Campa Cola coming in. So that's on the domestic front. Plenty happening on the international front as well. The track record for turning Africa to profitability is a positive one, and they are constructive with regard to that. Playbook is backward integration plus improved distribution, and they're using this in Africa. They expect a similar turnaround in South Africa as well. Margins to go from 10% currently to 17% by calendar year 2027. In terms of free cash flow now, a bulk of the capex is already done. A lot of it will come into free cash flow. So operating cash flow will continue to grow steadily and add to the net cash flow number. Capex is likely to moderate is what they are suggesting. It currently trades at around 40 times FY27 EPS, which is below the median staples coverage given by Goldman Sachs. They're expecting earnings CAGR to be strong and higher than sector average. Value this as 48 times, which is in line with the 5-year average, but they're valuing it basis FY27 quarterly average EPS. Risks, of course, being competition and execution delays.
All right, thanks so much for that, Harsh. The stocks that we've discussed this morning, one of them stands out, Bayer Crop Science, up about 9% in the pre-open session. There you go, 9.1% at this point. Kunal, the question to you, since we've already discussed it with Sunny and he prefers another stock because of the kind of cyclicality and unevenness of earnings in the space, would you still trade it though? The kind of up move today seems quite strong.
So Alex, now if you look at the historical performance of this counter, since 2020, this counter is in the range of 5,600 itself, which is the mean level. On the higher side, 6,700, on the lower side, it's 4,300. So, if someone wants to trade that range, one should have accumulated near those 5,000 levels, considering the risk-reward ratio to be favorable. But at this elevated level, I'll certainly avoid this counter, because risk-reward for a trader is absolutely unfavorable. By any chance, if the counter manages to come down near those 5,300, which looks unlikely right now, but if it comes to that level, then I think one can initiate a buy with the stop of 5,000, but otherwise it's an avoid for now.
Okay, avoid for now, but at the end of 8 minutes has certainly done really well. I wonder what the three companies with the blocks or the OFS around them are doing. So Indigo, 2.77% lower. PG 1.5, Sagility 5% lower. Now Sagility at the base price, if it does go to that max discount of 12%, from a valuation perspective likely becomes very interesting, but remains to be seen. Actually, Sunny, do you have a view on Sagility?
No, sorry, Neeraj, we are not right.
No, fair call. I mean, not a very commonly tracked name, but just thought we'll try my luck any which ways. The other pack, which, by the way, Electra Green Tech is down 14%. Ooh. So keep that in mind at the end of the pre-open session. It's a really, really sharp gash on that one. Sunny, a stock which has done some very interesting moves in the last 1 month is Apar Industries, and we've covered that extensively, but because it's up 1.5% again today, I wonder if you track that one fundamentally.
Yeah, I think Apar again a proxy play on basically power as well as the transformer, to be very specific, and continue to be one of the huge wealth creator. In fact, if you look at the number, in FY 16-17, the company used to clock around 120-130 crore of PAT number, and that has gone up now to close to 800 crore number. And again, we believe that looking at a strong industry tailwind, the company will continue to deliver a healthy growth. Even during the fourth quarter, the numbers were a decent, I won't say very robust, but a decent kind of growth which the company has reported, and we continue to remain constructive on the
speaking about auto ancillary players, now we've looked at Lumax earnings and the stock stands out. Okay, it's lost a little bit of ground since the open, or rather since the earlier part. Okay, Lumax Industries, thank you for that. I thought I was wrong. It's up about 4%. On the back of numbers, Sunny, coverage on this one, and would you suggest a fresh entry at this point based on what you've seen? The lighting game has changed quite dramatically over the course of the last 5 to 10 years, right, in the automotive space.
Yeah, definitely. I think the story in Lumax industry was all about shift from halogen light to LED light, which are margin accretive portfolio. So as of now, LED light portfolio for Lumax stands at close to 58-60%. And if you look at their order book, which is close to 2,100-2,200 crore, there 88% of the order book is from LED light. So which again gives an hope that margins will continue to expand from a current 9% to close to 9.5% to 10% in FY26. Again, in terms of product, so they have been a lot of new orders in terms of new product launches across, whether it is two-wheeler or four-wheeler. Trading at a very reasonable valuation, close to 18 to 19 times price to earning multiple. I think the stock is headed to make further new highs over the period of next 3 to 6 months.
Would you trade this, Kunal, if it stays the way that it is and has a decent open? Would you trade this?
So again, Alex, it's entering the all-time high, and the immediate support which I can find is around 650. So with the stop of 650, one can certainly initiate a buy, provided this counter gives a decisive closing above 685. But if it turns out to be a failure, then the high of Jan 2025, which is 685, might act as a strong resistance. So I'll wait for a day and confirmation on the breakout and then initiate a buy.
Okay, I want to just pull up Electra. Good numbers, but it's just become irrelevant at that point. At this point, 13% down on Electra Green Tech, nearly 14% down because Maharashtra government has cancelled the bus order awarded to Electra. They failed to meet contractual delivery obligations, so says the State Transport Minister Pratap Baburao Sarnaik. In fact, some reports that they haven't even delivered a single bus as per that order. This is going to have a very, very tough day. Are you seeing any light at the end of the tunnel for Electra Green Tech, Kunal?
So yeah, certainly it's near again back to those consolidation zones, and 1140 to 1150, which we discussed in the beginning itself. I think 1150 is a good support for now. If the counter manages to hold those levels, then we can expect some kind of consolidation, and with the stop of 1075, then one can initiate a buy. But otherwise, as Neeraj sir pointed out in the beginning itself, wait for the counter to settle down and then initiate only when there is a momentum. So as of now, I'll avoid this counter rather than catching the falling knife.
What about KC International? So it's up and about on the back of earnings. It's 3.3% higher. Would you trade this, Kunal?
Absolutely. This counter is coming out from the consolidation of last 5 months. In fact, the breakout was at 855, which we saw yesterday. And today it's continuing in the momentum. So with the stop of 850, one can certainly initiate a buy, and the positional targets can be 1050 to 1100.
And mind you, a clutch of other smaller names could be in focus. IPL or India Pesticides also reacting to its numbers. So I think there are a few that we'll talk about. None as much of a reaction as Electra, but still watch out for some of the others. Comments from Aurobindo Pharma, Concall on your screen as well. So keep that in mind. That stock had that company had an okay kind of a quarter. With almost everything coming maybe marginally below or in line, but the comments from the con call are important. For now, the stock not reacting dramatically to its numbers. We'll keep an eye out for metal names as well, viewers. Keep in mind that, because during the course of the day, because of the China industrial data looking strong, you never know, there might be a bit of a fillip for the metal counters yet again. But here come the first trades this Tuesday morning on our markets, and well, flattish really. No green on the screen at all. I wonder if IT services are continuing from where they left off yesterday. No, not really. 0.25% lower for that as well. 0.33% now. Mid caps, metals quiet too. And mid caps and small caps should come up on your screen. Flat for the mid cap index. Come on, small caps, show some green. Not really. It's a tick of red across. Let's get the heat map up on the screen. Fair degree of red, very little green. And the ones on the green are hardly far and few. I mean, Shriram Finance, Reddy's, Hindalco, IndusInd, BEL. No reasons, just a small speck of green. It's increasing a little bit, but none of the stocks are above 1%. What's lost out? Eternal yet again. NTPC, Finserv, Infosys. You know, that kind of a morning where on the large caps at least, there is no news moving any of the stocks. Maybe Tamanna has better luck, but suffice to say, a quiet start with a bit of a negative bias today morning, Tamanna.
RIL 0.5% down, weighing heavily on the index, I would say, and that's a true pain point that you're seeing. Eternal giving a second day's opportunity. Remember, outflows are going to increase for Eternal from the MSCI index perspective, and that's why a bit of pain. Let me come to what the broader markets are doing individually, because the Sensex nearly 0.5% down is not great news, but at least spot of green here. So broader markets, the advanced decline ratio is not as bad on the face of it. Small cap 250 also still in the green, dipping quickly towards the red, but not half bad. I want to pull up India VIX just for a second before we get to the overall sectoral indices. This is the pain point, above 17, 3.5% up on the India VIX. That's the volatility index, and that's probably showing some of the jitters that we're seeing in the market today. Let's pull up the sectoral indices for you and see what's working, if at all. I mean, defense really standing strong and defending the market in that sense, but there would be very few stocks in that index which is leading it to being in the green. PSU banks also, but it's a sea of red overall. Nifty IT about 0.5% down. That HSBC note not really helped, or maybe has actually underlined the weakness in the IT space. Consumption stocks down, infra stocks down as well. I wouldn't say it's a bloodbath or a sellout, none of that. But yes, markets are largely in the red today. Let's pull up some of the stocks that are on our radar, and you'll have to lead it for me today. Let's start with some of the block deals that we're talking about, and the details of Indigo there on your screen. We said that Rakesh Gangwal is selling his stake. He's paring down his stake. Of course, more supply comes into the market. The stock's going to be 3% down. But is this the end of the overhang of this? The Gangwal family now left with about 8% stake in Indigo. PG Electro, again, 0.5% down because there is a stake sale from promoters. But as we have been reporting, and as Somit reported this morning, my colleague, that there is a lot of institutional interest in PG Electro as well. So that's actually holding on. Sagility is not at all, 5% down this morning. Let's talk about Electra Green Tech. Could be the mistake of the day because the Maharashtra government has dropped its order nearly 7% down. Numbers on the face of it looked good, but they could be losing one of their biggest clients because of non-delivery. So that's not looking very good for Electra Green Tech. Let's look at impact of results, and we're picking up companies that have reported. India Pesticides 12.5% up. Orofarm actually bad results, but their commentary in the con call seems to have helped the stock, nearly 1% up. Clean Science not doing too well this morning. Other companies that have reported, Bayer Crop seems to be completely sizzling. This is something that Alex was talking about earlier in the day. 10% up on the stock. Acum's Drug on my watch list, 5% up. Good set of numbers on Acum's Drugs. And the one-offs may have helped, but nevertheless, Street is liking what they see. KEC International also doing well. Goldman Sachs has an initiate coverage on Varun Beverage. It was our big brokerage call of the day. Stock is about 1% up as we start. So a little difficult to spot winners this morning, even as we go into trade. Let's pull up Shilpa at Care as well very quickly before I toss it back. So a newsmaker of the morning, nearly 3% down. So difficult to pick too many winners today, I would say, Alex. It's going to be a stock picker's morning, a bit of a tough morning.
Certainly. There are a few stocks that are building on momentum from yesterday's session or earlier sessions as well. And one of them is GVTND. This is a stock that was locked in upper circuit yesterday, and it is up another 6% in trade today. I'd be curious to find out where this momentum will take it. Another few stocks from the broader markets. Maharashtra Seamless is looking quite good at the start today, gaining over 4%. JK Cement building on the gains that it had, and there were a couple of brokerage notes as well that were positive on this particular counter. It's up another 3.5% or thereabouts. The defense pack as a whole is holding out. So if you can pull up the constituents on the defense index, you will notice that they're up and about once again. In fact, you have Garden Reach that is doing well. You have Bharat Dynamics that is in focus on account of earnings as well, I think, if I'm not mistaken. But Kunal, I want to come to you on GVTND. Circuit is open, so people can buy. The question is, should they? Or if you had, should you book out at this point? Because you've made very quick gains in a very short amount of time.
So Alex, now looking at the weekly chart, this counter is reaching the December 2024 high, which is 2243. And at the same time, recent rally has been really sharp. So if I decide about the trailing stop loss, that's coming at around 1850 to 1900. Again, risk reward ratio is not really favorable. If someone is holding, I think this is a time to book out a small profit at least and trail the stop loss to 2000, so that you're not missing out too much on if the counter comes down. But at the same time, no fresh entry on this counter.
Bayer Crop Science is actually not doing too badly for itself. It's up amongst the key gainers today. So keep that in mind. Adani Green is in the red, by the way, Kunal. I want your view there because it was a buy at your end. But we look at the metals pack, and I wonder if everything is doing well, but Lloyd's Metals certainly is up about a couple of percentage points. I wonder if the base metal companies, so Hindalco and Nalco, should also come up on your screen. And I wonder if those two are doing well. But predominantly, it is the index which grabs center stage attention with that 1% downtick that we have on open. So before I go to Sunny, Kunal, one quick word on the Nifty. Is there some support that we have, or would you open a fresh trade on the index at these levels?
So Neeraj bhai, in the beginning, as we discussed, I think 24,800 is a strong support and Nifty is right now trading at that level itself. I think this should hold on. If Nifty manages to hold 24,800, then we can expect some, the bounce till 24,900 to 24,950. But if Nifty falls below 24,800, then I think the levels of 24,650 are also open. So it's a crucial level to watch out at the present level. Nifty is down by 200 points. So this can be a good point to keep in mind for either going bullish or bearish.
What about Adani Green? Would you like to revise your trade?
No, certainly. I think this counter is now, if at all, comes near to those 1,000 levels, which we mentioned as a support, and consolidates near that, it can be a good buying opportunity because the trend is still positive. So I'm still bullish on this counter.
Okay, RIL. I just want to look at top Nifty contributors. What's contributing to the fall? Because we need to see what the heavyweights are doing right now. Yeah, so BEL pulling, staying in the green, but nothing else really. HDFC Bank, ICICI Bank. You're seeing two top private banks and RIL. All the heavyweights are dragging down the markets today. So is Infosys. I'm not sure why that kind of weakness in banking stocks, because look at an Axis as well. They're also seeing some pain. Infosys, TCS, none of them holding out. Would this be a time to go bottom fishing, Sunny? Anything over here that you think is worth picking up?
Yeah, again, we will continue to remain in the camp where companies are reporting a good set of number. So, case in point, TD Power has reported a very good set of number. Play on
stocks. Sunny, I'm asking you on index stocks. Some of the heavyweights on the Nifty.
Okay, sorry. Yeah. So again, coming to Nifty, again, we continue to remain bullish on ICICI Bank, HDFC Bank. From a medium to long term perspective, so both this pick from a banking space. From the cement, again, we believe the worst is behind for the cement. So from the cement, we would like to pick Ultratech Cement, where we feel that a decent kind of volume growth of 6 to 7% can be seen in FY26, and pricing seems to be bottoming out. Although one need to keep in mind that monsoon is the seasonally a weaker quarter for the cement, so maybe gradually one can accumulate Ultratech from index basket.
This could also be a dampener. Early monsoons and very heavy monsoons which have come in could also be a dampener, not just for the cement sector. You could be seeing a bit of that impact across the board. But there you have it. Thank you so much, Sunny, for speaking with us today. Kunal, please stay on with us just for a little longer as we talk about some of these index plays and why you are seeing, and if you are seeing, any kind of buying opportunity here.
Kunal, so on the Bank Nifty, on the Bank Nifty front, I'm finding a little more comfort because that index is actually range bound and coming down from the higher end of the range. So if someone wants to go bearish, I think with the stop of the day's high, which is 55,500, that's again far away, but yeah, that's the immediate level. Considering that as a stop loss, one can go short, and the support and the targets on the lower side can be 54,900. But on Nifty, I'll still remain cautious. Rather than shorting, I'll think of finding the buying opportunities.
Another stock that we haven't yet marked that is doing particularly well is India Pesticides, apparently on the back of numbers as well. Kunal, you said staying away from Bayer, it's up 10%. Would you say the same for India Pesticides as well?
So, Alex, India pesticide breakout was at 175 and that has come today itself. Today we saw, yesterday in fact the high was 179, closing was little lower. Today is a gap up open and a continuation. So I think with the stop of days low, one can go long on India pesticide. The stop can be 180, that's 180. And the immediate targets can be 212. The formation of India pesticides are looking much better than Baycock. So I'll continue with India pesticide for now.
I do want to also point out Action Construction Equipment is reacting to numbers as well and is down about 5% in trade right now. It's lost ground over the course of the last few minutes. Kunal, on this, is there a trade?
Absolutely no, Alex. Again, entire year sideways consolidation. Since Feb 24 so far, this counter has just not done anything. The trend is absolutely sideways, lackluster. So I'll literally avoid this counter. By any chance, if we get the opportunity somewhere near 1,050, 1,060, we'll think of revisiting this. But otherwise, it's a clear avoid.
Asian Pacific markets largely have been low today. So we are not the lone rangers in town which are falling, because there is no apparent reason for this to happen, but for the fact that the rest of the pack is lower. Dow futures as we speak are still in the green, by the way, so keep that in mind. But we, in line with Asia, are a bit soft in trade, so bear that in mind for sure. Now, volatility index up about 4%, but nothing dramatic out there. And the Nifty Bank 0.7% lower is lagging the index, because the Nifty IT is the one which has now gone down the most. If we can just pull up the constituents of the Nifty IT, because I think the large boys, HCL Tech, Infi, TCS, all of them are down about 1.5%, with the Lone Ranger being persistent in the green, and that too is bobbing between the red and the green. So it is the large cap IT names which are actually down in trade. Maybe some bit of profit booking after a few days of an uptick. Kunal, I know we spoke about this earlier, but since the stocks, it's the biggest loser per se as an index, is there a trade on HCL Tech or an Infosys or a TCS?
So Neeraj bhai, HCL Tech, Infi is actually in the range bound counter since 12th May. And the support is placed at 1550. In fact, this counter managed to touch that support level 3 to 4 times in last 10 days. So if the counter manages to break 1550, then I think we can see further profit booking, and the counter might just come down to 1500, and that can be a good short-term bearish trade. But if the counter manages to hold this 1550, then I think this can be a good buying opportunity. So I'm just looking at Infi and TCS for now, where the trend is still absolutely intact, and this can be a buying opportunity for now.
What about some of the private banks, HDFC, ICICI, Axis, anything that you'd want to pick up there?
So, Tamanna, actually, we have executed one of the option strategies here, which I would like to share, and that's on the HDFC Bank, because this counter is absolutely sideways since 15 to 20 trading sessions, right? So, the best strategy here is to short straddle, and if the counter manages to come near 1900, it can be a good buying opportunity. So, consider that as a buying future. So, it's a covered straddle, where we go short on the options. That's the range bound expectation, and the future being long. Because it's sideways, that can be a good money-making opportunity for short-term traders also. So I think that's the view on the entire pack, but we are very comfortable with HDFC because of limited range available on the chart.
Okay. Let's take a broader look at the FMCG pack as well. It's down about 0.7%. And I'm just looking at the constituents to see what is moving here. You still have Radico Khaitan that's holding out with gains of about 1% or so. Dabur is up and about. Varun Beverages, treading water, just about 0.1% higher. Is there a trade in Radico Khaitan in your opinion?
Alex, now again, this counter is trending counter, but very, very sideways. The support is placed at 2440. Where we saw the counter not breaking that support since a month. I think that can be a good opportunity to buy. It's right now trading at 2464, and yesterday's low was 2440. So consider that as a stop loss, and one can definitely go long. But there's no major momentum as such. So I would rather wait for the counter to reach near the support level to initiate a buy, rather than jumping at the even 20 rupees higher than the support level.
Okay. Yeah, so we've moved into the red for the broader markets as well. On that note, let me thank you, Kunal. Thanks so much for joining us as always. Pleasure having you on the program. All right, let's talk about KC International. And we've spoken about the earnings, we've spoken about the technical levels. The stock is up, in fact, at the high point of the day, as much as 6% higher. This is on the back of earnings, because the inventory clearance has aided the net profit in the quarter, which is jumped as much as 77%. We'll bring in the management soon to figure out what worked for them and the outlook going forward. But let's bring up what has gone well for them in the quarter gone by. Mahima joining in to tell you about that. Mahima?
So as you rightly mentioned, strong set of numbers for KC International this particular quarter, and net profit was aided by inventory clearance as well as high OCI income, that is your other comprehensive income. Now in terms of the overall numbers, revenue was up 11%, EBITDA up almost 39%, margins improved to 7.8% versus that of 6.3%. Net profit also up 76 odd %. In terms of the business revenue performance, the transmission and distribution revenue was up 28%, non-transmission distribution revenue was down 5 odd %. In terms of the total share of transmission distribution to the total revenue stands at 63% and non-transmission distribution stands at 37%. Order book, healthy order book plus L1 over 40,000 crore for the company. The overall order book as of 31st March stood at 33,300 odd crores, and FY25 order intake stood at around 24,600 odd crores, which grew 36% YOY. They've also secured 2,000 orders in FY26 till date as per the recent filings. And in terms of order book breakup, transmission and distribution constitutes around 59%, civil constitutes 26%, and transportation constitutes around 11%. In terms of the order book breakup geography-wise, domestic is 67% and international is 33%. The company also repaid around 500 crores of their debt, and the net debt stands at around 4,500 odd crores. The net working capital days increased to 122 days versus that of 112 days in March 24. And lastly, in terms of outlook, they expect margin to improve to around 7.5% in FY25 and around 8.5% to 9% in FY26 is what the management has said. So this is the overall view as to how Q4 has panned out for KC International.
Okay. Let's get in Mr. Vimal Kejriwal for our conversation now. He's Managing Director and CEO KEC International. Mr. Kejriwal, thank you so much for speaking with us. It seems like a very, very solid quarter. What has aided the numbers and the profits? You've also sharp inventory decrease. Is that one of the key reasons?
Good morning, Tamanna, and thanks for having me. I think the basic reason is our T&D ratios are improving. The share of T&D is going up both in the order book and the revenue. Also, we have been able to close some of our legacy orders which were part of the COVID era, etc. So those are, I'll say, two major reasons why the margins are going up, and we have been talking of improving them further next year.
Okay, tell us about the margin expansion that we've seen. Want to understand if this is something pushed by factors we've seen this quarter. Is it sustainable? What are the kind of margin levels you're seeing for the financial year?
So, Tamanna, if you look at the margins for the year, we have ended up at 7%. For the quarter, at 7.8%. And generally, we have been saying that we will be between 8 to 8.5 for the next year. And I'll not say it is one-off. It has been a sustained effort to close old projects and push revenue in the newer projects. Also, we talked about order book being order intake for the year being close to 25,000 crores. So what has helped us is that with the growth in the tender pipeline, we are becoming much more selective in the orders which we take, looking at cash flows, looking at margins. So clearly the order book is looking much more healthy than what it was at the start of the year in terms of margins and cash flows.
Mr. Kejriwal, good morning. Neeraj here. Congrats on a good year as well. I reflect back upon a conversation that we had in June last year, wherein you said that you've never been so bullish in your 22 years of working in this industry. I wonder if that optimism still continues.
Yes, it still continues, and now it's 23 years. And especially what happens is, if you look at the India T&D piece, government was talking about 500 gigawatt of renewable by 2030. Now they've made it 600 by 2032. And, the work just continues, especially on the renewable front, both on the transmission lines, substations. In fact, the Prime Minister inaugurated a few lines yesterday and also last week also, and many of them were built by us. So we are clearly seeing at least a 4 to 5 or maybe 7 years run in the India piece. And similarly, international, our largest markets is Middle East. So whether it's UAE, whether it's Oman, whether it's Saudi, and we are just seeing a consistent flow of tender pipelines. So I think we are pretty confident that at least for the next few years, this growth in the T&D piece will continue.
That was going to be my question, Mr. Kejriwal, that almost everybody is complaining that while the assets are there, evacuation is not happening, and therefore T&D will be on a war footing in FY26 and 27 maybe. Now, do you sense that, and therefore, while you've grown your T&D execution by 28%, and I believe the order book uptake, T&D is about 60% currently for you, would you reckon that will only get, pick up pace in FY26, both execution and order inflow?
I'm not sure whether order inflow will pick up pace at the same level.
Okay.
Because I think a large part of ordering has happened. It will continue to grow, but execution has to pick up. There's no question about execution not picking up. And that's why, we do expect that our transmission revenue should grow by at least 20% in FY26.
Let's talk about I want to come back to the core numbers just for a second before we get to the outlook, Mr. Kejriwal. In terms of what has aided, we talked about the decrease in inventory. You've seen expenses come in, other incomes go higher, and other income has actually gone up significantly. Just trying to understand where these now sit on your books in the quarters to come so we can get a more comprehensive assessment of the top line.
So other income is not consistent. I think this year we had some interest income from income tax refund, etc. But typically, I think we have been getting 20, 30, I don't know, 30, 40 crores of other income through asset sales or through interest income, arbitration awards, etc., etc. I think that's where the other income part of it. But I think, Amanda, what you should look at is our interest cost. For the quarter, it was at 2.5%. And for the whole year, 3%. And next year, we're talking about the overall number going down to 2.5%. So the increase in the PBT and the PAT would be significantly higher than what we see in the EBITDA. You can see this year also, EBITDA has gone up by, I think, 25-30% in terms of percentage, whereas the PBT and PAT have grown by more than 60%. Other pieces that we have got a lot of, I'll say cash revenue and margins coming in through our Middle East subsidiaries, where obviously the tax rates are slightly lower than India. So our effective tax rates have also helped us in improving the PAT.
Okay, so that's important because that's something that carries on from quarter to quarter. Just want to talk about your order book, healthy order book. What is the outlook or the number that you've penciled in for this financial year, Mr. Kejriwal?
So last year we touched around 25,000, which was our guidance. This year we expect to do around 30,000 crores. That's the broad number which we are looking at for our order intake.
To do an additional 13,000 crores for your order intake, and this is focused on
30,000 for the year, 30 for the whole year.
30,000 for the full year. And this is going to be focused on international markets because I know your split is about 40-60 international to domestic, if I'm not mistaken.
It's broadly, order intake has been around 70-30. Let me explain for you that T&D is something which is, we are there international. Other businesses, we are not there. Hopefully this year, we should get some orders in civil, etc. So it may become 40-60. Otherwise, India has been typically 70. So India T&D plus civil plus railways, all is India. And T&D is only the only game in the international. But hopefully some more orders would come in civil and all that, in which case the ratio could be 60 India and 40 international.
So, which was my question going to be, Mr. Kejriwal, that if indeed your T&D order intake from 28 or 29% in the current quarter or the year goes down to, let's say, 20%, right? It was 28% for the quarter or for the year? One of the two, right?
For the year.
For the year,
the growth.
And you mentioned that it will go down to or be 20%. So therefore, it goes down from 28 to 20. So are civil orders gonna come in thick and fast, or is it a fact that the overall order inflow will decelerate, part one? And part two, would the operational metrics be materially different between T&D versus the other segments?
So, Neeraj, what I said on 20% was the 20% of the revenue growth, not the order intake. I think let me clarify that. Okay. So I clearly see that the order intake in T&D would probably be more than all other sectors. So I think I do not see any deceleration in the T&D orders. We have a very large L1 already, I think 5,000 or 6,000 crores, of which almost 80% is in the T&D sector. So I have zero risk of that. As far as execution is concerned, clearly T&D has got a better margin profile, which is why when we talked about why the margins will go up in 26, because we expect that we'll do better on execution of T&D orders where the margins are better.
Mr. Kejriwal, one last thing. Okay, this comes from memory, and I'm also getting old, but I believe you walked the talk when it comes to reduction of debt from the erstwhile levels. Now, at the current net debt situation, I think circa 4,500 crores, is this a comfortable position for you, or would you look to reduce debt for FY26, FY27 as well?
I think we are clear that this is still not comfortable. We reduced debt by 500 crores from year to year, but if you look at December to March, we reduced it by 1,000 crores. We are looking at reducing it by a further 500 crores despite a 15% projected turnover increase. So clearly, we are looking at it going down to 4,000 crores and the net working capital coming down by another 10 days.
Okay, just one last question, Mr. Kejriwal. In terms of what are the challenges you see, if any, going forward to execution? Like you said in our interview, execution becomes key. Is manpower or manpower shortage the biggest pain point that you're getting ready for going ahead? Uncertainties geopolitically, high costs or high working capital. What is it that you need to prepare for right now?
So to me, if I put it not in a particular order, one is labor. I think very clearly a manpower shortage. We have shortage of almost 5,000 people across our civil and T&D also. So manpower shortage, I think, is the biggest I'll say headwind which we see in our this. I'll say second one is we have an order book of roughly around 2,000 crores in water, and the payments have been slightly erratic. So it's a small piece, but that's the one piece which is there. Working capital, I don't think I see it at all as a headwind. I have more than enough room available for borrowing more if I want to, but as I said, we are looking at reducing it further. So I think biggest would be I'll say manpower.
Okay, thank you so much, Mr. Vimal Kejriwal. Always a pleasure speaking with you and getting your point of view on. Let's pull up the intraday of the
Thank
KC.
you for having me. Thank you.
Absolutely. Let's pull up the intraday of the KC International stock. Has actually spiked up while we were having that conversation as well. All right, shifting focus to the defense space. India continues to focus on building its image globally in the defense space and emphasize on domestic manufacturing. How does the road ahead look for the space? Before we speak to good luck, let's go across to Varsha, who is setting up the conversation.
Yeah, thank you for that. So let me just give you an outlook on defense sector, where India is actually focusing on building up global image in defense continues, and the defense Indianization focus from FY14 has seen most defense companies revenue rising in double digits, and recent India-Pakistan tension saw PM Modi laud Made in India equipment, which points to further domestic manufacturing focus. Now, how good luck India is actually eyeing on this defense opportunities? One, they've incorporated subsidiary Good Luck Defense and Aerospace in 2024, and the company to strengthen presence in defense sector. They're going to begin their trial production in Q1 FY26, and this will be a top priority since Q4 FY25 due to its relevance to high value sectors. This company is designed to produce 150,000 precision components annually, and the commercial production is expected by end of Q2 FY26. The capabilities include end-to-end solution, which includes your forging, machining, heat treatment and coating of steel, and company is focused on serving the defense and aerospace industries.
Okay, thanks for setting that up, Varsha. Mr. MC Garg, chairman of Good Luck India, joins us right now on the show. Mr. Garg, good talking to you. It's been a while. Thank you so much for speaking to us today.
Thank you.
And we saw your results for the year and for the quarter. The quarterly numbers were looking good. We'll talk about all of that. But you want to start off with what are your plans around newer projects, particularly defense? Because that is that big focus for a lot of investors. And in your case, while defense formed maybe just 2% of revenues in FY25, I believe there is this new plant that Varsha was talking about coming on board, which is going to spur the revenues for you.
Is on the verge of commissioning, awaiting government license.
Okay.
Is more or less complete, but production trial will start as soon as we get the license from the government. This is a licensed product.
Okay, sir.
We will be making shells for 155mm gun.
Okay. How long does the license typically take? I mean, could it happen in the next 1, 2, 3, 4 weeks?
Normally it should not take more than 6 months. It's already 6 months are over.
Okay.
So there are various departments are involved in this. It's a very, very sensitive subject, and government is very careful in granting the license.
Yeah, as it should be, sir. Okay. So Okay, just let's assume that you get the license, sir. So so how long does it take for you to begin commercial production from the time you get the license? And what are the capacities of this plant?
For 2 months, 150,000 cells a year. But we are not going to stop at that. We plan to put up another plant to go to 350,000 ton cells. Once we stabilize the production in the first plant, the second plant, it is already on the horizon that we start the production.
Mr. Garg, a very good morning. Tamanna here. Let's just take a step back and help us understand what exactly you're already doing in the defense space. Are you there in a big way? What is its contribution to your revenues and where you want to move forward?
Defense, we will be moving forward. The defense production coming from this subsidiary will be the major move towards the defense. However, already we are doing...
Just to clarify, so currently you are not doing anything in the defense space, or you're doing something in the defense space?
We are doing.
Okay.
Some of the components, we are approved supplier, vendor supplier for BrahMos missile. And we are supplying, but that quantity is insignificant as on date. And it is increasing year after year. Because the government system is like that it has to slowly grow. And we are already approved supplier for BrahMos missile.
Does that aid you in your attempt to increase your defense portfolio, that you are already an approved supplier? I'm trying to understand the strategic thought behind going further into defense in a space where there are a lot of Indian companies who are already established and are now growing.
Yes, we have a strategic thinking of growing into this sector. It's a high value added item. It will add to our EBITDA and will add to our value in the market.
See, you're also in supplies to large automotive clients. You know, you have Tesla, BMW, Volkswagen. Explain to us how big that part of the business is right now and what is the strategic focus there?
This is a very big part of our production. Almost 30% of our production goes. Most of the precision tubes and what we call a auto tube. Precision tube is a generic name of auto tubes. Auto tube are specialized precision tube made to order for car manufacturers. We are approved by several brands from overseas to supply them these tubes, and we are supplying them. As a second tier to all the component manufacturers, they buy our tube which are approved.
Got it. So, Mr. Garg, now that you are doing what you're doing, plus defense comes in, I see that from March 22, when your revenues were about 2,600 crores, in 3 years you expanded them to 4,000 odd crores. So that's about a 50% uptick in revenues and about 100% uptick in PAT, because from 75 crores you went to about 160 crores, slightly more than 100. Is there some guidance that you've given to your investors for what you will do, let's say in FY26 as a consolidated entity or over the next 2 or 3 years?
Sir, I am very conservative.
Okay.
I do not like to give high-fi figures.
Okay.
But I am apologetic about it.
No, that's okay.
I am confident we will be doing anything between 18 to 20% year after year. We are not going to high-fly unnecessarily, giving expectation. We may go higher. The products which we are choosing, like the one which we commissioned the plant only in September for making the hydraulic tube, one of its own kind plant in the world. There are very few plants. Hydraulic tube used in the construction equipment machinery, like tower cranes. There are only few plants in the world which will be supplying hydraulic tube, and that is the plant which is going to make a game changer for the company. And with this addition of the hydraulic tube, this defense shell making, which will give another boost to the EBITDA margin of the plant.
Okay, so you will take it higher from the 8% currently to slightly more in terms of operating profit margins. I believe 25% operating profit margins for the defense vertical, right, Mr. Garg?
Roughly, you can expect.
Roughly, we can expect. Okay. Well, wishing you all the best for the licenses, Mr. Garg, and your expansion plans. Thank you so much for speaking to us today.
Thank you.
Well, viewers, one of the reasons why it was important to highlight this as well, everything in defense is sparkling. Look at what Good Luck has done in the last 1 month. I think it's gained quite significantly, as have a clutch of other defense names. 1 month, about 16 or 17 odd %. So that's a pretty strong move for Good Luck India. Time for a quick break. On the other side, we will have a full-blown conversation on the tire space. Remember, Balkrishna Industries or BKT has announced a foray into passenger vehicle and commercial vehicle radials. But while there is increased competition, the tailwinds for the sector seem to be alive. We'll be joined by Mumuksh Mandlesha, research analyst at Anand Rathi Institutional Equities for the same.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest.
Welcome back. You're watching India Market Open. It's a tough day. Tough day could be expiry, which is pushing this, could be any number of reasons, but it is the heavyweights which are not playing ball at all. Still over 200 points down on the Nifty. I mean, we told you this morning this could go in either direction. It's very clear what direction it's gone for. It's been a slip and slide ever since the markets opened at 9:15. But let's focus on one sector which could see some upside. We're talking about tire stocks with rubber prices easing gradually and order inflows also getting higher. Puneet is joining us now with a breakdown of what to expect from this space.
Well, thank you for that. Definitely. Let's look at FY25 as a year first, because that was one of the most crucial years. Natural rubber prices had increased, margins had contracted, and demand was faltering. That is the three key highlights for the sector. But when you look at the numbers as well, for Balkrishna Industries, the numbers have been very stupendous. That's the only company which has actually shown margin growth. First, let's start with the revenue. 13% revenue growth for the company. That's the highest across the sector. 25% margins for the company, which was a 50 basis point expansion. The only company in the tire space to actually saw expansions in margins, and subsequently the profit was also up 13%. For the rest, as visible, there was, while revenue growth was there for the likes of MRF as well as CAT, there was contractions in margins as well. And it's important to note that this is actually growth in revenue as well as growth in profits, while we've given margins in the center as well. When you look at something like an Apollo and JK Tires, it was a tough year, because for Apollo, the company was dealing with company-specific issues of what's happening in Europe as well as getting out of low-margin businesses, and hence just a 2.9% growth in terms of revenue. There was a larger hit on margins as well, and in the Q4, the company also did a little bit of reintegration in terms of their operations in Europe as well, and that's reflective in the margins. Subsequently, profits were also down for both these companies. For JK Tires, they are a weaker player amongst the 5 listed companies, and hence that's visible in numbers as well. Let's now look at the key guidance, and here's where the differentiation is, because there's positive commentary across the 5 players this time. Balakrishna, while they refrain to give any guidance, they are expecting high single-digit growth. That's what they mentioned. For something like an MRF, they are expecting market share gains in both the two-wheelers as well as the truck and bus radial segment in this year. And this wasn't mentioned in any of these conference calls last time. So it's a positive outlook for MRF. When you look at something like a CAT, they are anticipating positive growth that will be led by Europe. And for Apollo as well as JK Tires, for Apollo specifically, they are expecting growth in OEM business, which is for the car makers specifically, as well as the two-wheeler makers, as well as exports to largely return, which is a high margin business compared to the domestic market. For JK Tires as well, they've guided for a double-digit revenue growth. Finally, the key aspect on natural rubber prices, we did see the natural rubber prices hover between 190 to 200 rupees in Q4. This was largely between 150 to 160 rupees per kg, roughly between 4 to 5 quarters. But now they've started to subside again starting from Q4 as well as in Q1 of FY26. Currently, the international rubber prices are also trading at a discount of 7 to 8 rupees to the Indian natural rubber prices as well. That's another key monitorable going forward. Brokerage consensus that's largely built in for something like an MRF. There is a large number of hold calls, and that's largely because it is a market leader and growth was absent. That could be one key monitorable. For Balakrishna as well, the sell calls have increased because of valuation concerns, and this was what we saw yesterday as well, a couple of downgrades coming in. For CAT as well as Apollo, we've seen the largest number of buy calls of 16 as well as 18. And finally, for JK Tires as well, we've seen limited brokerage coverage for this one, but both MK as well as DAM Capital having a buy call on the stock. And finally, in terms of valuation to end this discussion, currently FY26 price to earnings ratio, there's a clear visibility of your choices across the board. Take your pick accordingly, because the growth is where the aspect is. For Balakrishna as well as MRF, growth has been stagnant consistently, even in weaker times, and that could be one of the key reasons. But MRF is one of the most premium players, at least, as well as the highest growth players and the market leader. But for Balakrishna, at 25% margins compared to 15% for the rest of the peers, there is where the valuation differential lies. And for JK Tires as well, it's coming to a very at an inflection point now, anticipating growth in FY26 for CAT. The acquisition of Camzo done in the last year will now get them into off-highway tire segments, something that's very positive for BKT. So overall, there is choices available in this market, and we might be bottoming out in terms of commodity prices. So outlook for FY26 is upward and onwards.
Okay, that discussion actually just beginning. Thank you for that, Puneet. Mumuksh Mandlesha with us. He's research analyst at Anand Rathi Institutional Equities, who looks at the space very closely. Mumuksh, thank you for speaking with us. Just let's get your overview first before we begin, because we've seen numbers from all of these key companies, all the key players. The overarching theme seems to be saying that FY26 will be better. They are guiding for a better financial year, and rubber prices coming off. Are those fundamentally reasons to see an improvement?
Yeah. Good morning, everyone. Coming just on the old tire space per se, as what is happening is the crude prices have come down. international rubber prices have come down. So from going here onwards, you will see better margins for the tire companies. That will be a positive tailwind for them. And mostly the reflection of the better margin should happen from Q2 onwards, as is more lag in the impact. So in that way, the margins have bottomed down for them, and from here onwards, there should be an improvement on the margin side. And on the growth side, the replacement market should be around 6-7% growth, and the OEM market should be around mid-single-digit growth, and the exports should see a double-digit growth. So that will help them sustain a good top-line growth for all the tire companies. While in the near term, likes of CR and MRF will likely to continue to gain market share, and versus compared to Apollo and JK. So that's how in the demand side. While on the Balkrishna industry, also that the margin tail will continue. While on demand side, the India business and the global business, where excluding Europe and America, the growth should continue in double digit. While in Europe, it should be a mid-single digit number. While in the USA, where there's a trade war challenges, where the duty has increased, their demand could be muted for the near term. So they should be also growing in a high single digit number on overall basis. And for them, along with the crude prices softening, also free trades are also softening. So that also will be a tailwind ahead. And obviously, I mean, the key that changed for the Balkrishna post this result was the announcement into the PCR and the TBR segment. Now, what thought process is that the PCR TBR business, particularly India exposure business, you see the other tire companies, India, their margins are more to a low double-digit margins. And the ROC also of the profile of this business here low double digit, while what BKT currently does more like a 25% EBITDA margin, double digit, I mean high double digit ROC
So
business.
how did you see the news of BKT expanding into new territory? The street took it quite negatively. How did you see it?
It's quite similar that the basically are going to do more business, which dilutive in terms of return ratio. And as generally we have seen that the in Indian tire space is quite competitive. They generally have a huge earnings volatility because whenever the input cost changes, they are generally find difficult to pass on to the market. So there's hence there's a very low multiple valuation given to likes of Apollo, CEAT, and JK. So that also impacts their number going ahead. Hence, in my estimates, also my valuation multiple has seen a cut due to the dilutive nature of this new businesses.
Okay. Moksh, the belief was that when the incumbents made the foray, right, whenever they did into different segments, it was very margin dilutive. Now, I think the street showed its verdict on BKT yesterday when the stock tanked when they announced this. I do not know if you have individual coverage on BKT or no, but my larger point being, more than this being a worry for the incumbents that there is a new player coming, is it a worry for Balkrishna that they are venturing into something which is not quite their forte, and in the near term, there could be margin headwinds for them?
Yeah, that's what. So, see, they are almost targeting 4,600 crore revenue by FY30. So today, just India PCR TBR market may be around 50,000 odd crore revenue, and it may say to on 30 go towards 80,000 odd crore. So they are targeting quite a substantial number in just 5 years' time, and we believe. Like particular PCR segment where there's a brand importance, you need the OEM revenue first before it gets reflected in the aftermarket. So there are quite a difficult to penetrate such a TBR market, and the TBR market is a very cost conscious market. CV fleet operators are very cost conscious on the tire, on the truck and bus tires. So so there we believe that that could be a miss in their target. we find it difficult to see that kind of a growth itself. And then because of the higher marketing and there could be some gross margin pressure that could impact the margins also, which could be a sub 10% kind of a margin as well. So obviously the plans are still not fully out. That will get rolled out ahead. They are also talking about going more premium, more specialized tires in this two space. So we have to see what kind of a segments they target. But the initial challenge is that it would be not so easy to penetrate those market, and for a near term, the margins would be dilutive.
Okay, Mumuksh, what are your favorites in this space, and why is that? What would be your pecking order?
So MRF and CR, these are the two preferred pick because of more of gaining market share. And BKT, we were positive, but now that news have basically taken away the upside and the limited upside now on the BKT. So preference is CR and MRF and CR are the two preference in the tire space.
MRF and CAT. MRF may be prohibitive to our viewers because of the stock price. So CAT after MRF is your best bet?
Yeah. So yeah.
What is the kind of upside that you're seeing on the space and on some of these stocks with a 1 year's perspective?
So it's about 15% kind of upside, not a bigger upside. They have also catch up valuation wise. You see last few months CRT and MRF has done really well. So they're very limited upside today in the names. But we see them these two to be more better on in the tire space.
Okay. Thank you so much, Mumuksh, for speaking with us. I mean, the MRF stock are prohibitively expensive as a stock price, nearly, 1.4 lakh rupees for a stock. But those are some of the best picks in terms of how the company is doing. Balakrishna is perhaps an avoid at this point. Thank you so much, Mumuksh. All right, new listing that has taken place today, even as the market is seeing quite a pain point. At least Borana is listed up in the green, 18% up, 255 rupees is the current market price, 39 rupees above what the issue price was. Now, this is a company that manufactures synthetic grey fabrics. There's been a pretty decent response to the IPO. It was subscribed 149 times on the final day. Looking at that kind of interest, perhaps the listing is not what you would expect. But let's start with understanding what the company is and what it does. Mahima is joining in with more details.
Right, so as you rightly mentioned, Tamanna, it's engaged in manufacturing of synthetic grey fiber, and this fabric is supplied further to clients for processing garments, furnishing, etc. Now, in terms of the details of IPO, the issue price stood at 216. It was a fresh issue of around 144 odd crores, and the number of shares issued was 6.7 million. The IPO was overall subscribed for 149 times, where QIB subscription was at 87 times, NI subscription at 237 times, and individual subscription at around 200 odd times. In terms of the overall financial metrics, revenue in FY24 stood at around 1,900 odd crores, which increased to around 2,100 crores in 9 months FY25. Margin improved from 21% to 22%. EBITDA also grew from 412 to 460 in 9 months FY25, and profit after tax has also seen an uptick from 236 crores to around 293 crores. In terms of what this fundraising IPO is done for, they are proposing to finance the cost of establishing a new manufacturing unit, and this will expand its production of around 71 odd crores, and also funding incremental working capital of around 26 odd crores. In terms of valuation, it is valued at around 14.7 times in terms of its PE, and we've also seen that the stock did list at a 12% premium, and it's currently trading at 18% higher versus its issue price. So this is the overall view of how the IPO fares that with respect to where Borana Weaves is concerned.
Okay. Thanks, Mahima, for that. Let's get in. Market voice, Ajay Argal, SVP and Senior Portfolio Manager at Franklin Templeton Johnson, right now on the show to talk about his thoughts around markets, economy, and more. Ajay, good having you. Thanks for taking the time out. The views are split right down the middle, Ajay, in terms of whether this is a value zone for India because earnings might look up, or is that because the earnings delivery has been soft and the future is uncertain, we are well valued? Where is it that you are bending towards?
Yeah, good morning, Neeraj. We think that the markets are fairly valued. If you look at in terms of the large caps, look at the Nifty valuations, which are kind of 10% above the last 10-year medians or averages. But if you look at the mid caps and the small caps, they are definitely on the higher side. So mid cap is closer to 29 times, and which is about 35% premium to the large caps, and also premium to its own history. And somewhat similar situation for the small caps, that they are actually trading at a premium of about 20-25% to the larger caps. Normally they trade at a discount. So in terms of the earnings delivery, the March quarter, the earnings have been quite up to the mark, in the sense that they have met the expectations. But they, as we know, the expectations itself was very low in terms of single digits earnings growth. But generally, they have met the earnings expectations. So now we are looking forward to FY26, and the earnings growth is generally now in the about 11, 12, 13%, that ballpark, which has been a downgrade of about 3% in the last 6 months or so. And of course, we are looking forward to some of the positive triggers which are lined up.
What would those be, Ajay, according to you? And therefore, do they help in taking the earnings growth higher from the 11 to 13% band?
Yeah, I mean, that is what we need to see. So right now, that is what the market thinks in its wisdom, the analyst community and all of us think in our wisdom, that that is what the current scenario is. That obviously builds in the triggers which I was talking about. So primary among them is the tax cut, which has already started flowing in from April. So that's about $10 billion stimulus for the consumers, and that is specifically for the middle class, because that kind of tax bracket is where the maximum benefit would come on the consumption side. And then already we have seen 50 basis points of interest rate cuts, and maybe another 50 basis points of interest rate cuts at least is going to happen in this financial year. So that also might have another $5-6 billion of savings for the consumers, which will again be for the middle class. So we are looking at somewhere around $15 billion of extra money in the hands of the consumers, which should actually give a fillip to the urban consumption, because as we know, in the last couple of quarters, the urban consumptions have slowed down, whereas the rural consumption, which has been quite tepid for many quarters, have actually started looking up in the last couple of quarters. So we are looking forward to the urban consumption picking up, and if at all, once that demand picks up, whether there will be more pickup in the capex side from the private corporate sector.
Ajay, hi, good morning. Just wondering, apart from the consumption bit, now this is the sticky bit. When people have more money in their pockets, what are they spending on? Are they spending on, soaps, toothpaste, etc.? Are you looking at core staples? Are they spending on more discretionary items? And would be interested in knowing what your view is. For example, is an Eternal looking more exciting to you, or a Colgate Palmolive?
Yeah, so that's a very good question, and good morning. We think that this saving which is going to come is going to go more towards the consumer discretionary items. So definitely the items where the consumption had reduced when there was some stress for the consumers, and they were typically your food delivery, quick service restaurants, or maybe to some extent automobiles, white goods, refrigerators, washing machines, ACs, etc. So those are the kind of pockets which we think is going to benefit more. And the reason we think that way is because, as I said, the tax benefits as well as the interest rate cut benefits is likely to accrue more to the middle class. So if we leave aside maybe the bottom 10-15% of the consumers which have very low income, the people who have slightly higher income and they are paying income tax, so they will get the benefit in terms of lower tax outgoes and therefore higher savings. And it is quite likely that they would make their expenditure toward those areas. And that's why in our portfolios, we are more geared towards consumer discretionary in terms of the food services, quick commerce, QSR. So some of the names which you mentioned. So yes, we are positioned for that rather than the consumer staples, because consumer staples, we have been seeing for quite a long time that the volume growth itself has been tepid. And even now it is single digit volume growth, mid single digit volume growth, and in some companies, not even that. And we don't see any signs of that picking up, because you need to keep in mind that the consumer staples, the penetration levels are also much higher. So there is not that much of a benefit if there is increased savings.
So, Ajay, let me take that a step further. When I say discretionary consumption, hotels, airlines, those sectors, tourism, trade, is that something that you think has a further up move now baked in already? Or are you finding interesting pockets of possibilities there?
Yeah, so as usual, it's a bit of everything. So part of it is definitely baked in. So we have seen some of these sectors already done very well. But some of them, there is a bit of a structural story as well. So if you look at the airlines in India, it's going to be a very structural, secular theme, because more and more people are going to fly rather than go by train. So that's a structural thing. And of course, as we all know, there are supply constraints, and for various reasons, the supply constraints were very severe in the last few quarters. That might ease down a bit. But going forward, also, the supply is not going to come to the extent that the demand is going to pick up in the airline side. In the hotels, somewhat similar situation. Supply constraint is there. The demand is strong. But in our opinion, there the expectations are even higher. So we are playing more through the airlines as far as the focus fund is concerned. But in some of our other funds, we are also playing through the hotels sector.
Okay, so what would be your top favorites here, if you could name any names?
So unfortunately, I can't name any names, but as you can see in the portfolio, I mean, we are overweight in the, of course, the financial sector.
Yeah.
We are overweight consumer discretionary, as I already highlighted. We are overweight in the telecom services, and we are overweight in the healthcare, or basically the pharmaceutical sector.
Autos then, I mean, I just want to know what the view on autos is, because there's a lot of geopolitical elements also which are having impact, clarity or lack of clarity on tariffs for some of those players, components coming in, new entrants. How are you seeing that space?
Yeah, so auto, the ones which are domestically oriented, they are not that much impacted with all these developments on the geopolitical front. But there they have their own challenges in terms of the volume growth itself coming down this year for most of the sectors. So volume growth will be single digits, or maybe mid single digits and lower for passenger cars, for two-wheelers. That's what the expectations are. And also, most of these stocks have done very well. So the expectations are on the higher side in terms of higher valuations. But when you look at the autos, OEMs, as well as the components which are geared more towards exports, so they have these challenges which you highlight. And the primary challenge there is the companies don't know what to do, because the policies are changing all the time, at least as far as the talks are concerned. So right now, a company cannot take a decision of, let's say, starting a manufacturing plant in the US with just a 3-year view, because that's going to be the view for this administration, but we don't know what is going to be the view after that. So the companies typically would look at 15, 20 years before making any significant capex. And also, it's not easy. I mean, capex is one thing, and getting the workers and at that requisite cost so that you are able to make decent ROEs and ROCs. That's a bit of a challenge, and that's why we have seen that a lot of companies in the auto and the auto component space, specifically catering to the export markets, and even there more to the US market, they are themselves not giving any guidance or any outlook, because they are themselves not sure how things are going to pan out, because something is announced and then it is put in abeyance for 90 days. So very difficult to make the decision making there. And therefore, from a stock perspective, also, we are generally on the sidelines. And that is also because of the valuation concerns which I talked about, that the valuations, the entry point is not really very cheap. So we are focused more on the domestic auto companies.
Got it. Ajay, just one last question very quickly. What's the view on tech, IT services? The reports are chalk and cheese. Are you bullish? Are you not? And why?
So in the focus fund, we are underweight, and we have been underweight
okay.
for quite some time. And of course, the stocks have done very well in the last 1.5 months. That I think is just a kind of a sector rotation trade, because there was lack of ideas in terms of the lower valuation stocks. But if you look in terms of the outlook, for this year anyway, we know that the growth is going to be very, very low. Maybe definitely less than 5%. But even going forward, it's going to be quite a difficult scenario, because one, the market share gain for the Indian ID sector is kind of coming to an end, because they have very large market share in the areas in which they cater to. And secondly, there is still the phenomena of AI, which people need to understand in terms of what is going to be the impact on the Indian ID companies. So on the one side, there is going to be negative impact in terms of some of the legacy business will go away. But on the other hand, there will be positive impact in terms of some of the new businesses coming in. But as we have seen in the previous cycles, that there might be a mismatch in timing of this, as in the legacy business might be lost first, and then the new businesses tend to come up a bit later. So there might be a few quarters here and there. So from that perspective, also, we are not so positive for any growth to pick up even in FY27. And now that the valuations have also run up, we are comfortable with maintaining the underweight position which we have in the sector.
Okay. Ajay, we'll leave it at that. Thanks much for taking the time out and being with us. Really appreciate your time.
Well, thanks, Neeraj.
Well, Franklin Templeton is underweight IT. I'll tell you, the street is underweight Olectra Green Tech. Recovered from the lows of the day, yes, but still has seen cuts of about 5.5% to 6% as the Maharashtra government has cancelled a major order of some buses. Puneet Johnson with more details. Puneet, how many buses? Was it 1,000? Is it 5,000? What is it?
Well, it's a subsequent order which was passed by yesterday by the Maharashtra Transport Ministry for 5,150 buses. That's 50% of the company's current order book that's been cancelled. The issue was that this order was given, this order for roughly about 5,000 buses was given a decade ago, and the company has failed to deliver even a single bus. So the revised timeline that the ministry had mentioned is to at least deliver 1,000 buses by May 22nd of 2025. Now that deadline has passed, and again, no buses have been delivered. And hence, this order has now come for cancelling these orders. Now, this was, of course, mentioned by the Transport Minister, which is Mr. Pratap Sarnaik, on X, and he had mentioned specifically, and I quote, "There is a doubt about supply of buses by this organization in the future." And what's interesting is also that the company had mentioned that each bus cost roughly 1.75 crores, and roughly just multiplying that with over 5,000 buses, that comes to over 9,000 crores of order book that has been cancelled by the Maharashtra Ministry. Now, what is very interesting is the numbers, and this was the writing on the wall for this company coming for a while, because the company has an order book of roughly about 10,000 buses. They only delivered 581 buses in FY24 and roughly 580 buses in FY23. So there wasn't any plan to, deliver buses on time, because the production capacity doesn't exist. Currently, for this year, FY25, the production capacity was 1,200 buses for the whole year. And an order book of 10,000 buses, they would take roughly 8 years to deliver the current orders on hand. So subsequently, in the previous conference calls amongst analysts as well, that has been the key question, that they've only been able to increase capacity very minusculely over the last 2 to 3 years, despite having such big order wins. And sky-high valuation for the stock was based on the order wins hand-to-hand, but delivery is again in a limbo. So that's something to track going forward, and a key question for investors as well, of those holding Olectra Green Tech shares.
Okay. Thanks for that, Puneet. Well, another focus stock is Bayer Crop Science. It shot up 11% on the back of strong earnings. Varsha has details here. Varsha.
Yeah, thank you for that. So, the revenue growth that you're seeing is led by strong performance in their spring corn and of course their crop protection portfolio. Now, we are seeing that the volume in the agrochem is up, but the pricing pressure still persists, but the good numbers on the back of good volume. EBITDA margin expansion that you're seeing is at lower employee costs, and there's a significant lower employee cost, of course, due to increase in revenue. So, one of the reasons why good EBITDA margin is because of the operating leverage that the company has seen. But to talk on the employee cost was 6% to revenue last year versus 11% to revenue this year. The promotional investment made by the company in the previous quarter have generated significant returns, and that's why you're also seeing good set of numbers. Other income has also aided net profit. Just to speak on the four numbers, revenue was up 32%, EBITDA was up 75%, margins were at 16% versus 12% last year, net profit was up almost 49%.
Okay, so Bayer Crop is having a superb day on the street on the back of good numbers. I would say that's an outlier, more than an exception than the rule. As we wind down India markets open, the mood is turned, Neeraj, unfortunately. It is sour, but not the last word said on the markets today. We'll wait and see how it pans out on through the day as well. But stay tuned. Ask Profit up next, where we answer your queries.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Vachrajani. Hi, Mahima.
Hi, Alex.
And we're here to take you through the next 1 hour of trade. It's not the best start for trading in the Indian equity markets. We've erased yesterday's gains. We are trading about 250 points lower on the Nifty 50. Quite a considerable amount of resistance built up at that 25,000 mark. And if you remember, we closed just a couple of points above 25,000 yesterday. We broke below that mark very, very quickly. And we are trading at the low point of the day today. Quite a few of the heavyweights are actually leading this decline. And if you look at the contribution, you will notice a number of the top stocks there. HDFC Bank, ICICI Bank, Reliance Industries, Infosys, you name it. All of the heavyweights up there. And if you pull up the sectoral heat map, or not the sectoral heat map, the heat map for the Nifty 50, apologies. We'll pull up the Nifty 50 heat map. There are only a handful, a smattering of stocks that are gaining in trade. And on the bottom right, you will notice that the India VIX has also spiked. It did spike yesterday. It spiked even further. 19 is where it is. You might want to watch whether it goes above 20, which is an indicator of elevated volatility in the market as things stand. The broader market's not looking as bad, actually. In fact, you have the mid-cap index that's seeing cuts of only about 0.2%, and the small cap index is flat. So all told, it's a move that is concentrated in the large cap names, the heavyweight counters seeing selling, and the market breadth is, well, it's not terrible. There are a considerable number of advances as well. The gap has widened just a tad bit, but it's pretty much the opposite of what you saw in trade yesterday. Let's take a look at the sectoral picture as well. I know it got pulled up on the screen, but just to close out this conversation, the defense pack once again is leading the gains, and it is one of two counters that is holding up with gains. The other one being the Nifty Realty Index, which is up about 0.33%. And what we're going to ask our experts today is whether or not you should book profits in some of the defense names which are up and about quite considerably. We've got Vikas Jain as well as Asta Jain joining us this morning. Good morning to the both of you, and thanks so much for taking the time.
Good morning.
Vikas, let me ask you first. We saw quite a considerable amount of call and put writing take place at that 25,000 mark, and we're heading towards monthly expiry. We did move pretty quickly to this 25,000 mark, which is why I guess we're seeing a little bit of profit taking. Is that what is occurring, or is there more that I'm not seeing?
If you look at the higher band of resistance is at 25,050 to 25,100. Yesterday we closed convincingly above 25,000. But with today's Sensex monthly expiry, the market momentum is being pretty weak. So 25,000 fall has witnessed huge amount of writing. So that would again be a round number, and the highest fall open interest would continue to remain a step resistance. But again, on the downside, 24,700 puts also simultaneously as the highest put open interest, followed by 24,500. So that would also see in a strong amount of support area. So we may trade between these 24,700 to 25,000 over the next few days.
That's the view with regards to where the Nifty 50 stands. The first question of the day is from, do we have the name of this person? He's from Vizag, Andhra Pradesh. Kumar is writing in, and his question is on Zensar Technologies. He's bought Zensar Technologies at the price of 844. And he wants a view on this particular counter. Asta, I'll take this up with you. You know, as Alex mentioned earlier, everyone in the market wants to know right now if this is the time where valuations have again become expensive for defense counters. Plus, we've also seen the kind of run-up that we've seen in all of these counters today, considering the 4,400 crore order win that you can expect in the entire space. What's the view like for Zensar Tech, first thing, and your view on the entire defense pack?
Hi, good morning to all of you. Talking about Zensar Tech, I think this is a good bet to continue invested in, and that's why we are recommending a hold on this counter with a price target of around 950 odd levels. Now, talking about the fundamentals of this counter, fundamental seems to be very, very strong. First of all, what we are seeing in the company's fundamental, that their exposure to high-tech vertical is definitely yielding good results to them. In fact, if I look after the valuations also, I think, yes, it seems to be overpriced at the current level. But if I take the forward-looking valuations, then definitely we believe that there is still momentum, upside momentum is there in the counter, and hence we are recommending hold. Although we are not giving buy rating, because we believe that it can be a good buy at around 800 to 790 odd levels. So a hold can be strategy for this counter with a price target of more than 900 at the current level. In fact, for the whole defense sector, we are still positive on. You might be surprised to know that despite having such a strong momentum in this space, we are still keeping our eye on that space, and we believe Bharat Electronics, Bharat Dynamic, and HCL, these three counters to outperform in the defense space. For BEL, our target is 410 in the short to medium term. And for Bharat Dynamics, also our target is more than 2,000. So I think these counters are still very strong, are in a very strong momentum, and one can remain invested in, as well as buy on dip strategy can also be applied.
I could look it up, but I know that you know this, Asta. Is the Bharat Dynamics result today?
Bharat Dynamics, yes. I think, sorry, today I am not aware about the results.
Okay,
but,
well.
Fundamentals, and thank you for that update. But fundamental seems to be very, very strong in this.
Okay, all right. Let's take the first caller for the day. We've got Kiran calling us from Hyderabad. Very good morning, Kiran. How can we help you today?
Good morning. My query is regarding Ashok Leyland.
Okay.
I'm holding 1,010 shares of Ashok Leyland at 240 rupees. There is a bonus issue and dividend for this share. So should I hold on to this counter for some more time, or should I shift to some other counter like Adani Green or Bharat Dynamics at current levels is my...
Okay, that depends on whether you bought this on the fundamentals, or is this purely for the trading pop that you bought it?
For trading purpose, sir.
Understood. Okay. So then from that perspective...
Should I shift to Bharat Dynamics or Adani Green at current levels is my question?
Got it. All right. So Vikas, the question is... Got it. I got your question, Kiran. Vikas, so the question is for you, if it's a trading strategy and if you've got Ashok Leyland, would you wait for the bonus share record date, which is a 1:1, or would you simply book at this point and move to the two counters that he's mentioned?
So I would restrict myself and reserve the right that Ashok Leyland looks pretty promising because post numbers, the stock witnessed some amount of volatility. We believe remain positive because the constructive space continues to look good. In case of Bharat Dynamics, again, as you suggested, that result has been there, so the stock would trade a little bit volatile. And defense as a sector has been trading at 52-week highs. So some amount of profit booking cannot be ruled out. And plus BDL is also being getting into the F&O basket from the June expiry. So some amount of volatility would continue to remain. So would not recommend to invest into Bharat Dynamics at current levels.
The view with regards to where Bharat Dynamics stands, and of course Ashok Leyland in picture. The next question is from Manu, who is writing in from Bengaluru. He's bought Bajaj Housing Finance 214 odd stocks at 70 rupees a piece and wants a long-term view on this. Asta, what's the view like?
So we are still positive on this counter, and the long-term view seems to be good. Recommending a hold on this counter with a price target of 150 at the initial level. If I talk about their AUM growth, then AUM growth is also looking decent to us. In fact, their asset quality seems to be fine. The only thing which I believe is not playing well with the company is its valuation. And that is why we are seeing that this stock is not performing in those parameters. And hence, we might see some sort of weakness in the near term. But in the longer term, it will again move to the level of 150 to 160. So remain invested in this company.
Okay, remain invested is the view coming in on Bajaj Housing. Our next caller, Vikas, is calling in from Bengaluru. Vikas, a very good morning to you. How can we help you?
Good morning, ma'am. I'm having Sky Gold share at quantities 134 at the rate of 343.
Okay.
Is this a better gold stock, or I need to switch to any other stocks which are related to gold?
Okay. Okay, got your point, Vikas. I'll take this up with Asta. Asta, Sky Gold is set to announce its earnings today. What Vikas's question is that he wants to invest in a jewelry stock or a stock which is related to gold. Sky Gold is already in his holding. Should he continue to hold that or switch to some other jewelry counter?
So in fact, Kalyan Jewellers is looking good to us in some other space. And for the Sky Gold, I think it's better to remain invested in at least till the results come, because today it's a result date. But in the past performance also, we have seen a strong rise in their earnings, especially in their top line and the bottom line. And this is, I'm talking about the Q3 numbers. So on that basis, the counter seems to be okay. Idea here is to hold this counter at least till the results. And once again, review your query after the results arrive.
Are you still there? Are you still on the phone line?
Yeah.
So why do you want to buy gold? I'm just curious. As in, why do you want to buy gold companies?
Because its value is increasing. So
The value of gold. So why don't you buy gold?
the physical gold is very dangerous, I think.
No, but I'm talking about digital gold, ETFs.
I will think about it.
You'll think about it. Okay, I'm just wondering, Vikas Jain, if you have a view on gold, if you've been tracking it on the technical levels, globally the standpoint, and normally I know we talk about stocks, but I'm just wondering whether you have a view on gold as a commodity as well. It has lost a little bit of ground in the recent past, but it hit those record highs not too long back. And with dollar once again losing steam, the expectation is that gold will come back into focus. Do you track gold? And if so, what are the levels to watch on the upside?
Last time also we spoke that 3,500 ounce has been near to top. So we witnessed some amount of volatility. We tested the lower range of around 3120, 3170, which was the previous 52-week high. And again witnessed some amount of bounce. But again, those 3450, 3500 would continue to remain a supply zone, because if you look at the monthly charts, it is making lower tops and the RSI is also inversing. So some amount of consolidation and profit booking could be expected, no doubt about it. So we do not expect any major upside above $35 an ounce. And on the downside, if 3150, 3170 is being broken, then we could see some more corrective action near to $29.50 an ounce. I'm talking about international gold prices.
Okay. All right. Now, there's an interesting story with Mazagon Dock, and I know this because I've had a conversation with Ramesh Damani about it. And he spoke about how when he was sitting in his office, he could see the dock from his window. And when the IPO came out, he looked at the assets and he said that it has to be a buy. Now, it seems like Vivek had a similar thought process, though since he's sitting in New Delhi, I doubt that he could see the dock. Vivek, you bought at levels of 140. Help me understand what the thinking is or was when you bought it.
Yeah, good morning, Alex. Actually, when I buy this, they had a lot of cash reserve. They had a next 5 years order book. And the margins of the business was very good.
Yes.
They had clients. So that was the whole idea about it.
And did you buy all at once or did you acquire over a period of time?
Yeah, I buy it all at once.
Okay.
And the stock didn't perform when I buy it. Stock didn't perform for 9-10 months. It was range bound and suddenly it spiked from there.
Yeah. And so I'm just wondering, is this a considerable portion of your portfolio? Because look, ultimately in a stock portfolio, if 3 stocks are multi-baggers, that's all you need. But is this a big portion of your portfolio?
No, it is not a big portion. It is around 5% of my portfolio.
Congratulations, sir. So therefore, what you're trying to ask is whether you should take some money off the table right now. Is that right?
See, government is promoting a lot on shipbuilding and all these things. And seeing the geopolitical situation, I think that I should hold it till 2029 and again review it according to the policies and all that. So I just don't want to book the profits and shift to something else when this stock can further perform. So this is my outlook about it.
So what do you want me to...
I just want your views on it.
Okay, I got your question. So Asta, then the question is for you, because he's sitting on gains of 1.4 crore. You heard about when he bought it, levels of 140. Most investors have never seen this level, right? Because they've looked at Mazagon much later when it started making headlines. So he wants to hold to 2029. Should he do that?
So this company, it was established way back in 1934, first of all, and they have a capacity of 805 vessels, 11 submarines, etc. Now, what is more fascinating about this company is their entry into the aviation sector. Now, they have started taking the contract for helicopter repairs as well. So apart from this, they are building dry dock, etc. And their entry into the aviation sector is also looking very, very, strong to us. So my idea here is to stay invested in this counter. I think if there is no hurry to book the profit, then remain invested in this counter because we are seeing much more potential to be here, and hence we are recommending a hold on this counter. Initial price target can be set at around 3,900 odd levels.
All right, we had one more query on our WhatsApp regarding Mazgon Doc. I hope that answers your query. The next question is from Bhaira, who is writing in from Hyderabad. He's got 2,025 odd shares of NMDC bought at 70 rupees a piece, and he wants a long-term outlook again on this from a 5-year perspective. Asta, I'll come to you on this one. He's probably seen the year and bought the number of stocks, it seems. Your view on NMDC for the next 5 years?
Definitely for next 5 years, this is a very strong stock, and our idea is to remain invested and accumulate at the every lower level. So we believe that this counter is a potential, and now the kind of capacities they are targeting around 100 megatons per annum by 2030. So definitely, if these capacities will come on board, definitely they will help the company in posting very good numbers going ahead. So for next 5 years, it is a good stock to remain invested in. Hold is a recommendation from our side.
Okay, Orient Tech is the name of the counter we're looking at next. Not a very large counter, 1,370 odd crore market capitalization. We've got Vardarajan, who's writing in from Tamil Nadu and asking about this. He's bought at levels of 390, slightly elevated levels, and he's got a target in mind, 410 levels, and he's wondering how long it'll take for it to hit that mark and whether that looks like it's on the cards. He's got 150 shares. Vikas, any view on the charts?
Look at it has been, the stock has just recently listed. No doubt it had a super listing. The stock went to an all-time high near to 620, 630 levels. And from there, the stock has already halved by 50%. No doubt it has made some amount of formidable bottom near to 300 base levels area and witnessing some out, but it is remaining sideways. So unless until it doesn't cross on the higher side 365, 380, which is the 100-day average, the stock would remain subdued. If that is being crossed convincingly, then we could see strong amount of momentum. So would recommend to remain invested at current levels. Once 360, 385 is being crossed, then the stock would see strong amount of uptake.
All right, so that's the view with regards to where Orient Tech stands. Our next question is on DLF. We have Ramesh, who's writing in and wants to know as to what should be the outlook for DLF. Is having 100 odd shares bought at 670 a piece. Asta, not sure if DLF did come out with its earnings or is expected to post its earnings today. What's the view like for DLF?
No, they have already announced their earnings, and it was a stellar growth which they have posted in their earnings. So yes, the view is really positive on this counter on the back of the strong earnings which this company has posted, and we are recommending hold on this counter with a price target of 850 to 880 odd levels.
Okay, all right. The next question is, okay, so you've already taken on DLF. All right, let's take our next caller. I believe we've got Anant calling us from Bengaluru. Anant, very good morning to you. How can we help you today?
Hey, good morning, Alex, Mahima, and Asta ma'am. I had a question. I was planning to invest around 5 to 6 lakhs in electronic equipment management companies and transformer and distribution companies. Okay, I had a question where should I go and make a concentrated portfolio like something like in ABB, Siemens, Hitachi, or should I make majority of this investment in each 1.5 lakh in each company, and then go into smaller companies like Silchar, Indotech Transformers, and GE&D, a bit like say around 40,000 in each companies. I'm ready to take a risk and I can hold for 5-10 years, and if it goes 20-30%, even 40% down with a the company is good, I can hold. If it goes down, I can sleep at night.
Got your question.
Yeah.
And the results have been, the results have looked good, Anant. I see why you're asking. GE&D, for example, this week has done particularly well. If we can pull up that chart, just so you know, it's up about 5% yesterday. It was locked in upper circuit, very strong set of numbers. So therefore, I see why you're interested in this stock. Asta, the only problem is that the valuations are not supportive, because if you have to pay 70 times, or even upwards of 60 times, then it's not really something that is pricing in just the next year. It's pricing in the next couple of years of growth, right? So, would you be willing to deploy in any of these counters, and what should he do as strategy?
Yes, the pricing seems to be, on the higher side for these counter. But now, if I talk about ABB, I think that is a good stock to remain invested in because the results were okay. And in fact, if I look about the pricing also, it is trading at a price to earning multiple of 67, which is at around the industry price to earning multiple, which is 68. So I think, yes, it is at around the industry price to earning multiple ABB. So there is still a scope to, invest in this counter because there's a scope left for the further upside. Now, another counter which the viewer has talked about or the investors talk about is about the Indotech transformers. So right now, I'm not very much convinced about the fundamentals because what we have seen in the result was a degrowth. So I think one should remain invested in the frontline, stocks like ABB, GEV, TND, or for that sake, Hitachi, etc. But for the smaller companies, one really need to look about their financial performance first of all because they are more vulnerable to stock market conditions. So idea here is to invest in the frontline stocks like ABB, Siemens, etc. And for the another or a smaller companies, one really need to see their fundamentals and then make entry. As of now, I'm not recommending Indotech transformers for that sake.
I want to confirm, you're saying a buy in ABB, Siemens as well as Hitachi, all three?
Yes, they are looking good, but ABB is the strongest among these three.
Okay, the next question is on Apollo Microsystems. Sushila from Bellary has bought 302 shares at 124 apiece and wants to know whether she should hold or exit at the current levels. Asta, I'll again come to you on this one. Apollo Microsystems is the counter. It's overall a very interesting company to watch out for, even in terms of how Q4 panned out for them. Revenues up 19%, EBITDA up 25%, margins also up 22%, and net profit was also up 8%. What's the view like?
The view is positive for this counter for sure because yes, the results were up to the mark, and what we have seen is the reflection of the good results in the stock price momentum. So yes, the review is positive. One can remain invested in this counter. Initial price target which we would like to give to this counter is at around 180 to 190 odd.
All right. So that's the view on Apollo Micro. It's up as much as 14% in trade today. Wow. Amit is calling us from Noida. Amit, very good morning to you. How can we help you today?
Good morning. I have bought 1 lakh shares of Equinox, now called EMBDL, at a price of 143.
Okay.
Today it's trading at 103. I've been holding on for the last 6 months. So currently I'm suffering a loss of nearly 40 lakhs.
Yes.
So, there is a result which is supposed to come out on 29th. I am confused as to hold on to it or dispose it. What should I do?
Yes. Can you help me understand why you took such a large position in the company?
I took it because of the merger of Embassy and India Bulls. They have the largest land bank in India, and I thought the plans would go accordingly. But unfortunately, things didn't transpire as I thought.
And if the advice is such, and I will go to Asta on this one, you could hold for the long term?
I can.
Okay.
I can hold for 1 year, 2 years also.
Okay, I just want to understand, this is not a large part of your portfolio, I hope?
Yeah, it is a very large part of my portfolio.
It is a very large. Would you be comfortable telling me what concentration you have in this particular stock?
50% of my portfolio.
Understood. Okay, Asta, from that perspective, then the issue is ability to hold if there's further downside. So what is the advice in the context of what he has just stated? Obviously, also the fundamentals. Please comment on that first, but know that it's about 50% of its portfolio.
I think, first of all, one can remain invested in. Yes, there was a merger between the Equinox and Embassy, and I think it happened in the February month itself. But now, as today being the result day, there is, no logic of exiting as of now from this counter without seeing the results. Maybe the results will not come on the expected lines, but one can be very much sure when exiting from this counter because here the amount involved is very high. So my idea here is to remain invested in this counter at least till the results come and then again review query over here.
That's the view with regards to where Equinox stands. The next question is from Sujata, who's writing in from Bengaluru. She's bought CDSL shares 200 in quantity at 1400 piece, and she wants to know as to what should be the target price from a longer term period perspective. Vikas, I'll come to you on this one. What's the view like where charts are concerned for CDSL?
So for CDSL, the charts remain pretty prospective and promising. Because if you look at the whole capital market structure, looks pretty upbeat. CDSL has been continuously trading above the 200-day average for the last 6-7 trading sessions, and we believe the stock has the potential to retest near to 1640, 1650, the intermediate highs which it made in the month of December. So remain positive on the stock. We expect the stock to retrace back near to 1650 levels for the next few months. So view remains unreviewed.
So that's the view with regards to where CDSL stands. With that, it's time to slip into a very short break, but we'll be right back answering all your queries on the other side, so do stay tuned.
That's huge! That is a biggie! It's on
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay
Welcome back. You're watching Ask Profit. Let's take a check of where the markets are right now, and we're pretty much holding at 24,780 or thereabouts on the Nifty 50, down about 0.9% and very close to the low point of the day. And quite a bit of the selling, as I pointed out at the start of this program, is concentrated on the large caps, and you have the broader markets that are outperforming at this stage, still losing ground, but the broadest end of the market, the small caps, are actually gaining right now. They've recovered quite a bit of ground and they're trading in the green, up about 0.2%, and I would hazard a guess to say that the advance decline ratio has improved just a tad bit. In fact, let's pull up that. There you go. It's a narrowing of those lines. towards the midpoint, and hopefully it continues to improve over the course of the day. By the way, a lot of you know this already, but for those that haven't seen the next program, it's Know Your Company, and this is a show that gets you in-depth analysis of stocks that you probably hold in your portfolio or are contemplating holding. The stock that is going to be discussed today is Jyoti CNC. And the reason why we're talking about it on Know Your Company is that it's currently trading at a premium valuation, 90 times trailing price to earnings. The question we're asking is, are the valuations justified based on the growth that the company is seeing? It's a specialized business, of course. What are the opportunities, and is that enough to justify the valuation as it stands right now? What are the question marks about working capital? What is causing the pressure for the company right now? They have large capex plans. We're going to look at funding. We're going to look at some of the sustainability of their return ratios as well. So, as I said, in-depth analysis of how this stock and company are set to perform. I believe we've got our next caller. Pradeep is calling us, and as I understand it, Pradeep, you're a senior citizen, because I saw your message as well on WhatsApp. You'd like to know about Piccadilly Agro, is that right?
Yes, sir.
Please go ahead. Thanks so much for calling us.
See, I had bought initially 200 shares of Piccadilly Agro at the rate of 38 rupees.
Okay.
And I had been booking profits at periodical intervals.
Right.
Currently, I am having only 50 shares. So I just wanted to ascertain whether I should hold on or should I book my whatever residual profits I am having.
Okay. And you bought it, I'm assuming, because of the stock price. I'm just guessing you bought it a long time back, right?
Yeah, about, see, I have been investing for the last 3 years.
Right.
So I had bought it at around 38 rupees around 3 years back.
Got it. So you've had stellar returns. So let me get you a relatively shorter term view on the share, since you'd like to know whether to book the rest of your profit that you've made. Vikas, on the charts, what's the view on Piccadilly Agro?
So Piccadilly Agro is only a BSE listed company, so it lacks little bit amount of volumes. But if you look at the stock structure, has taken some support near to its 100-week average of 515, 500 odd levels. So I would recommend to hold with a stop of 500, because the stock has already declined from the highs of around 1000 to 500. So no point of selling at the current levels, but we can continue to hold and keep a stop of near to 500, because the stock can, if momentum comes through into these names, the stock has the potential to move higher near to 700.
That's the view with regards to where Piccadilly Agro stands. It's interesting because since the launch of Indri, this particular company has seen a significant amount of growth in their revenue in terms of the way volumes are being sold for that specific brand. All right, the next question is from Satish, who's writing in from Bengaluru. He's purchased 300 odd shares. Okay, he's not given us a stock name. So till he gives us his stock name, we have Rinesh from Chennai.
Because there are several stocks that are trading at 1300. I told him that.
Yeah.
Unfortunately, we don't have the name of the stock yet.
So then we'll take Rinesh's query. He's writing in from Chennai. He wants a long-term view on Quality Power. He's bought 26 odd shares at 425 a piece. Asa, not sure if you have a view on this particular counter. If yes, what's the view like? Quality Power.
So it was a recent listing, as far as I remember. The IPO came in December, I suppose, regarding this company. No, not December. It was in February month. I'm sorry. Apologies for that. So in February, the IPO came, and it came at around 425 at the higher end of the price band. So it was 401 to 425. And now, it has now started trading above those levels. So we are positive on that company in the IPO times also. But at that time, due to the poor market conditions, we all know that in the January, February month, markets were not in the good shape. So we were not able to see good listing. But I think in the longer term, it has a potential to move upwards from here. So remain invested in this counter is what we believe. Now it has started trading above its IPO price. So idea here is to stay invested in this counter with the price target which we would like to give to this counter is 408.
The mystery stock that Satish did not tell us about. And guys, if you're writing on WhatsApp, then you have to tell us the name of the stock, the price that you bought it, if you bought it, and also how long you'd intend to hold it. The mystery stock that was bought at a price of 1,150 with a short-term outlook and a long-term outlook, both, is Reliance Industries, none other than. Okay, so Vikas, on the charts, it's under a little bit of pressure. Oh, it's actually recovered very sharply. There you go. Wow. What an interesting intraday chart. What do you make of that, Vikas? And would you hold on?
I would recommend to hold because if you look at the structure remains positive. No doubt the stock massively underperformed in the month of March and April, but since the middle of April, the stock has witnessed strong amount of rebound from the lows of 1265, 1270 levels. Now it is sustaining above the bonus price. When it came out, we gave a 1:1 bonus issue. So that amount of sell-off has also been absorbed. And now the stock could head further higher near to 1545, 1570 levels. So it can continue to remain positive.
Okay. Okay, so that's the view with regards to where Reliance stands and with respect to where technicals are concerned. Our next caller, Mansingh, is calling in from Andhra Pradesh. Mansingh, a very good morning to you. How can we help you?
Very good morning, madam. I'm holding Garden Reach Shipbuilders, madam.
Okay.
66 average price is 460.
Okay.
Should I book or should I wait? I want to make it free of cost and I want to invest in power sector. So please recommend me any power. In my view, I want to know about one company, madam. That is, I want to book profit here and I want to invest in GIPCL, Gujarat Industry Power Corporation Limited. Is it a right approach or any other? Please suggest me.
Okay. So if I understand your question, Mansingh, what you're trying to do is you're going to recover your initial cost of capital when you invested in Garden Reach, and you want to deploy that in some other stock. Can you repeat the name of the stock that you have identified?
GIPCL, Gujarat Industry Power Corporation Limited.
Okay. I will try and get you a view. I'm not sure if Asta has coverage. Asta, it's a pretty tried and tested strategy to take the cost from an old acquisition of a stock and deploy it elsewhere. What would you say about that strategy, one? And do you have coverage on the stock that he's identified in the power space?
See, first of all, Garden Reach is looking very, very strong to us on the back of the strong earnings this company has posted. So this counter is looking good to us, and going ahead also the kind of order inflow these companies are witnessing, they are kind of one of the exceptional order books they are having. So I think long-term view is also very, very strong on this counter. So idea here is to not book full profits, book partial profit, because if anyone really want to book some sort of profit, then partially exiting is recommended from our side, because this counter seems to be very strong to us. Now talking about GIPCL, I have not seen the results of this counter because this company has announced its results few days back. So in the power space also, we are liking 2-3 counters a lot, in which power grid is our top pick. So one can look after those counters as well.
That's the view with regards to where Garden Reach stands, and of course GIPCL. And it's interesting, Alex, because I was looking at the financials. 3-year CAGR growth in terms of revenue has hardly been 3%. In terms of profit also, it's been 7%. The company, in fact, in 2025, FY 2025, has seen a degrowth in terms of its sales. So I think you should keep all of these things in mind, one, before investing in a stock like GIPCL. All right, the next counter that we're talking about is Bandhan Bank. Guru from Mysore is writing in. He's holding 1100 odd shares. He invested before a year ago, and he wants to know whether he can hold or sell at the current levels. Vikas, I'll come to you on this one. What are the charts indicating for Bandhan Bank?
The chart remains sideways. The stock has been a massive underperformer for the last many years and trading at multi-year lows. So I would recommend to switch to some other bank, maybe RBL Bank or IDFC First Bank, where we could witness some amount of positive momentum. So it's better to exit and invest into some other mid-cap private sector bank like RBL or IDFC First.
Okay, so you've gotten alternatives as well. Navendu is calling us from Patna. Very good morning, Navendu. How can we help you today?
Good morning.
Please go ahead.
I have 1,500 shares of Aster DM Healthcare.
Okay.
Which I bought at around 375 rupees.
Mm-hmm.
The stock has gone up.
Yes.
My view is generally long term, and I've been trying to hold the share for 2 to 3 years. Is that advisable, or should I book some profits at this point of time.
Yeah, so and you bought it quite a while back. Seemingly, you're making a decent profit. Should you take money off the table? And would you also want to know where to deploy it if the advice is to book some profits?
Not now.
You can take the cash. Is that what you're looking at?
Yeah.
Okay.
Yeah,
okay. I got it. Asta, on the fundamentals, it's a pretty steady performer operationally, not too bad in the way of its PAT growth. I think it's actually a considerable outperform on a year-on-year basis. I was looking at the Q4 numbers, 86 crore PAT, and it's an improvement in performance sequentially as well on the PAT, on the bottom line basis. What do you make of the numbers? Would you hold on or would you book some profits at this point?
So, I mean, this hospital, they have main concentration in the Kerala and I suppose Andhra Pradesh for that matter. So, what we have seen, first of all, in the hospital space, average length of stay is the key parameter, key ratio. And they have shown a good improvement. It is 3.1 days. That is the average length of stay. The lower it is good for a hospital. So average length of stay is 3.1 days and it has reduced from 3.3 days. Again, average revenue per occupied bed has seen a significant increase of more than 10% of around rupees 47,800 average revenue per occupied bed. So this is also very good. And another thing that oncology is such a stream, which is always a high margin driven, because they're the patients stay for a longer term also, and in fact it always yield good margins to the hospital. This is only for hospital, I'm saying. So and the oncology, their oncology segment has also shown a good improvement, and now their revenue contribution has started increasing. So if I look after all these parameters, I believe that this hospital is well placed at the present moment of a time, and a strong operational performance, as you have also rightly pointed out. I think this is a counter which one should remain invested in for some more time. So idea here is to not book profits at the present moment of a time if one is comfortable to remain invested in, because we believe there is more upside for this counter. 600 is the price target, and above those levels can also be seen. So right now we are attributing a price target of around 610 to 620 to this counter.
Okay, so that's the view with regards to where Aster DM stands. Our next question is from Surendra, who's writing in from Chennai. He wants to know the entry price for data patterns. Vikas, I'll come to you on this one. Is this the right time to enter data patterns, or should he wait for some downside? And what are the kind of resistance and support levels that you're observing on the charts?
In terms of data patterns, no doubt the stock has witnessed strong amount of move along with the whole defense space what we have been witnessed for the last fortnight. The stock has made some amount of proper formation near to 3200 levels, but it has good support near to 2550, 2600 band, which is a formation of the long-term averages. So 2550 to 2600 levels should be a good entry point to enter to the name. We believe some amount of retracement could be expected after a strong move from 1500 to 3200. So which gives a retracement near to 2550, 26. So that should be an ideal point to enter.
Next caller, Mr. Reddy is calling in from Hyderabad. A very good morning to you, Mr. Reddy. How can we help you?
Madam, I have purchased Kalamandir, ACC.
Okay.
ACC 200 quantity.
Okay.
Can you tell me can I hold it or sell?
Okay, and this is from a longer term perspective, or did you see the charts while buying this?
Shortfall only.
Sorry?
Shortfall only.
Charts only. All right. Vikas, I'll come to you quickly on this one. What are the charts indicating for ACC?
So cement space, ACC continues to remain a pretty laggard. It has not underperformed. But some formation has been taking place, which gives a formation that the stock will see some amount of outperformance. So you can continue to remain invested. Maybe on a shorter term time frame, 2020, 2030 could be expected on an immediate basis over the next 2-3 weeks. So we can continue to remain invested.
Continue to remain invested. By the way, standard disclaimer, ACC is part of the Adani Group, and so is NDTV, of which NDTV Profit is a part. We've got the next question from Amit, who's asking about Tata Motors, which he's purchased at 721 rupees. He's got 10,000 units and he's in the green. Not a lot of people can say that, and he's wondering what is the ideal price to exit from a short-term perspective. Coming back to you then, Vikas, on the charts, a lot of people lost money in Tata Motors, particularly those that have been holding since the 1,000 levels. What would you advise on the shorter time frame?
So if you look at the structure, the stock has witnessed good amount of corrective action since the demerger was been announced. And from the highs of 1100, it made some amount of bottom-up formation. But it has been witnessing good amount of recovery from those 560, 570 area. It has been trending in a particular range of around some formation has been expected. So we believe the stock could retest the 200-day average near to 780, 85 over the next few weeks. So continue to remain invested. And if it draws down a longer term process, maybe 6 months down the line, the October demerger date is expected. So that post the demerger, the stock will witness strong amount of returns. So if he remains invested for the next 6 months, good amount of returns should be expected.
All right, so that's a view on Tata Motors. Shailendra is calling us from Odisha. Shailendra, very good morning to you. How can we help you today?
Good morning, sir. Sir, I'm having Vadila Industries 460 shares.
Yes.
At the rate of 3870.
Right.
And I want to hold it for long term.
Okay.
So please suggest me. Can I hold
okay.
for long term? Long term means more than 1 year.
More than 1 year. And you're asking based on the fundamentals, right?
Yes, exactly, sir.
Okay. You've seen the earnings?
No, not this quarter earning is of course revenue has risen by 25-30%. Profit is a bit down.
Yes. Margins have contracted. You're right, and which is why the stock was a little bit under pressure. It has recovered from the low point of the day, though. I get your question. Let me ask Astha. Astha, it's a result that was not necessarily the best. Particularly if you're looking at, and of course this is a seasonal business and the first quarter of the year is generally seen to be positive, but since we've got an early onset of the monsoon, do you think that's going to hurt the company? 1, 2, would you hold for the long term or would you book at this point?
So first of all, guest results were not on the expected line. In fact, if I take out their other income extraordinary items, so it was a degrowth in the bottom line by 25%. This is, I'm talking about Q4 numbers. Now, in fact, if I look after the full FY25 figures also, the bottom line was quite flat of around 133 crore, I believe. So there was no growth in the full year financial 25 also. Now, talking about third part, the valuation, on the valuation parameter also, it seems to be fairly priced. So, I mean, if I look after all these parameters together, then it is signaling that they can be some more downside in the stock, and stock will not be able to perform at least coming 2 months due to the bad or not so good results. So, idea here is to book partial, profit and remain invested in partially. Yes, you are absolutely right. Maybe the company can see some sort of a moderation in the demand due to the earlier, onset of the monsoon. But whatever is there, we will see it in their Q1 numbers. Right now, exit partially, but don't exit fully from this company.
Exit partially is the view coming in on Vadilal. In fact, it's very interesting to keep a track of these ice cream companies because Vadilal has focus in West and North region more. There's Hatsun Agro, which completely takes over the southern markets. But we've also seen that in the quick commerce space, there are a lot of new startups that have come in. There's Go Zero, there's NIC, which are taking up a lot of market share from these companies. So that is also one of the reasons that is impacting earnings for all of these companies.
No doubt, and even in of course, it's a completely different space where you're talking about the food space and the quick delivery space. Correct. A lot of the listed entities are facing problems from the unlisted space, which is similar in this case as well, right?
Absolutely. So I think that is also one of the factors to watch out for when you track these ice cream companies. All right, the next question is from Lalita, who's writing in from Chennai. She's holding 100 odd shares of Sirma SGS, bought at 478 a piece, and wants to know if this is good to hold or switch to another stock. I believe it's from the EMS space only that she's asking about. So I'll come to you on this one. What's the view like for Sirma SGS, and would you prefer any other EMS stock over Sirma SGS or continue to hold?
I think the guidance was very, very strong. So, I mean, in fact, the margin was there, the guidance was strong. So there is no need to, switch to any other counter. This counter seems to be perfectly fine at the present moment of time, at least for the upside potential of around 600 to 610 odd levels. Remain invested in this counter.
Okay, all right. Mubarak has got the next question and asking about Canara Bank. Bought as many as 20,000 shares purely from a dividend point of view. Okay, so it's actually a combination view. Let me do this. It's actually a combination view. So let me add what he's also asking. Mubarak is asking about NMDC 60,000 shares and Canara Bank 20,000 shares. Plan is to have a combination of 1 lakh shares of both, purely from the perspective of dividend payout. Is this the right approach to have? Asa, what is your opinion?
Yes, one can have, this type of combination with the dividend approach, but I still believe that the more capital appreciation lies in the stock price momentum, dividend approach is, somewhat a safety net as well as, a fixed income sort of thing. So for Canara Bank, in fact, even I believe that there is a more scope for the capital appreciation because we believe that the kind of credit growth this bank has posted, it has, outpaced the expectation. So we believe that this counter is is having a potential to move more upside from here till the level of 120. So Canara Bank with the capital appreciation as well as dividend thing, I think it is a good bet to remain invested in. For another counter which is NMDC also, I believe that is also a strong counter to remain invested in. So both these counters are looking good to me, both from the perspective of dividend as well as capital appreciation.
Okay, so that's with regards to where both these stocks are concerned. Our next caller, Harish, is calling in from Visakhapatnam. Harish, a very good morning to you. I believe you have a query on Tanla.
Yeah.
Go ahead with your query,
morning,
Harish. Good morning.
I am having 100 shares of Tanla platform at the rate of 739.
Okay.
Can I hold it or sell it?
Okay, got your point, Harish. I'll take this up with Vikas. Vikas, I'll come to you on this one. Recently, promoter bought in almost 1.4% of the equity around 13th May, and we saw a significant spike in the counter at that point of time. What's the view like with respect to where charts are concerned for Tanla platforms?
Chart looks promising because the stock has witnessed a double bottom structure near to 440, 400 odd levels. Huge amount of volume expansion has taken place in the 460, 480 when the promoter would have bought from the bond market with more than 2 crore shares trading. So the stock has the potential to touch the 200-day average near to 685, 700. So continue to remain positive on the name.
All right, let's take the next question. TD Power Systems for a long-term investment. Raza wants to know about this. Is it a good counter to invest in? Quick view, Asta.
Yes. We have in fact given a buy rating to this counter a few days back also. So a good stock to remain invested in with the kind of the results they have posted exceptionally well. Our price target for this counter is more than 500, which is at around 545 at the initial levels.
We've got Sikan calling us from Odisha, asking about BEL, I understand. Sikan, is that right?
No, I am asking about Bell, Bharat Electronics.
Same. Okay, go ahead. What is the question?
I am holding 100 shares at 278. So should I book my profit or sell it?
Got your question. All right. Let me take this across to Vikas. Vikas, Bharat Electronics, would you sell at this point if you bought at levels of 278?
I would recommend to book profits because if you look at the defense story has been played out, the stock has been just trending in this particular range. So partial profits can be booked out, maybe not fully, and wait for some amount of decline or retracement near to 345, 350 or levels.
Right. It is time now, Vikas as well as Asta, to hit the rapid fire round. And this is where we ask you as many questions as we can over the span of 2 minutes. The first one is on Olectra Green Tech. Under a little bit of pressure today, would you buy for the short term? Shiva wants to know. Vikas, what's the view?
Would recommend an hold.
Okay, Balaji from Bengaluru wants to know whether he should sell or add more of Samvardhana Motherson. He's bought 100 shares at 133 a piece. Asta, your view?
So I think he can add more at the lower level of around 140 to 135 zone.
Okay, BHEL, hold or sell is a question. Bought at levels of 325. Nikhat wants to know, would you do either? What's the view, Vikas?
They surely should buy for a target of 280, 85.
Okay, Nalco is the next counter. Ranjana from Bengaluru has bought 500 shares at 185 a piece. What's the short-term outlook? Vikas, your view?
The stock has some resistance near to 188, 89, so avoid.
Ramya wants to know about Bata shares. Is it safe to just hold without accumulating? I do not know the buy price. Asa, what's the view?
Yes, one can hold this counter at least for coming 3-4 months.
At what levels can I enter HAL? Narayanan from Chennai wants to know. Vikas, what's your view?
Wait for some 5 to 7% decline.
Niva Bupa is the name of the counter. Bought at levels of 80. Akash wants to know 4,000 quantity. Should he book or wait for further upside? Vikas?
Recommend to book profits.
Okay, HBL Engineering is the next counter. Harshit wants a long-term view on this one. Astha, your view?
So long-term view is positive, but in the near term, we can see some sort of a pressure. But long-term view is really positive with a price target of 610 rupees.
Okay, NRB Bearings, if you've got a view, Astha, Shiju wants to know, bought 1800 shares at 330. Would you hold?
Yes, definitely. The results were exceptionally well in the quarterly numbers. One can remain invested in this counter. Price target can be set at around 285 to 290 odd levels.
Okay, Kotak Mahindra Bank. Should the person continue to hold or sell? He's holding 100 odd shares. Vikas, your view on the charts?
You can continue to hold.
All right, that brings us to the end of the rapid fire round and to the show as well. Vikas as well as Astha, always a pleasure having you on the program. Thanks so much as always for taking the time. Right, that brings us to the end of Ask Profit from Mahima and myself and the team that put the show together. Thank you so much for watching. As I said, at 11 o'clock, up next is Know Your Company. Do stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture? Hello and welcome. You're watching KYC, which is Know Your Company. Today we're going to focus in on Jyoti CNC. It's a niche business again, and that's why it's very interesting. Took me some time to understand the business itself, but let's quickly dive down on what I want to know about this business more than anything else. It currently trades at 90 times price to earnings. Certainly not cheap by any standards. Question is, can are valuations justified just given the growth potential? So that's something we'll try to answer, and of course we'll get insights from the management as well as to what they believe the growth trajectory is going to look like, and therefore what the potential is, and therefore whether valuations actually justify that kind of potential, because we are looking way out in terms of valuations or earnings multiples starting to normalize. So that's the one big piece that I want to understand. Second one, it's a specialized business. So what opportunities will it capture? Because as of today, it is the only component manufacturer selling to EMS companies, which is electronic manufacturing companies. Now, when you're looking at an opportunity which is that large and you are the only player, of course, you are virtually like a monopoly. But what happens when other players start to eat your market share, at least the domestic market share, for among the EMS business? And therefore, that's something I want to really understand. What opportunities will it capture going forward, and what happens to the opportunities it's already captured? So something I'd want to understand. The third piece is with regard to Hurun, its manufacturing facility in France. Again, there's a big turnaround in Europe, which is already at play. I want to understand whether that opportunity is getting adequately captured already with what the markets are anticipating, or is there a larger opportunity over the next couple of years? Because that opportunity we're not fully clear with regard to how large it is and how Jyoti will capture it. And therefore, that's the other thing I'd want to understand. Working capital, there is some pressure with regard to working capital. Clearly, your working capital days are way too high. You want that to come down. They've guided for it to come down in FY26. What gives them that comfort, and how much can they bring it down by? Because that is eating into cash flow from operations. We'll see it in the metrics. And that's the other thing I want to understand. The last piece is with regard to capex plans and funding. You have obviously this extremely large opportunity, but capex, just to put it into perspective, they're going to take 6,000 machines, which they currently have a capacity for, and increase that to 16,000 in the next 12 to 15 months. That's a very, very large increase in terms of capacity itself. And therefore, what is the funding, sustainability of return ratios as they ramp up is really the question I will be asking. So large capex plans, how do you fund it, and what's thereafter, what lies is what I want to understand. So that's how it all stacks up with regard to what I want to understand. But let's quickly zoom into what the company does. And this is where it starts to get very interesting. And I'm going to try to break it down. Let's look at what it does. It is the leading manufacturer in India of 5-axis CNC machines. I'm going to try and break down what a CNC machine is. A CNC machine is a computer numerical control machine. Typically, when you want to make a niche component or part, think of it as an auto component, a nut, a bolt. You typically will need a 3-axis machine, which goes on the side and down. A 5-axis allows for a rotation and a more nuanced component to get made. So that's a 5-axis machine. Jyoti is one of the players which manufactures this 5-axis machine, which allows the manufacturing of a component by the machine moving in all directions. There are of course 6 and 7-axis machines as well, which are far more or higher in terms of their niche, but the 5-axis itself is a very, very high niche product. In India, you have around 10 to 12% market share that Jyoti caters to, and 50% plus is catered through import. So the import substitution potential for this machine is extremely high. This is where it stands out versus some of the other players. It allows, these are broadly the type of products it manufactures. Okay, I won't get into the nuances of the products itself, but it's a niche component manufacturing capex machine, which allows you to manufacture niche components within the aerospace, auto, transport segments, right? instead of the 3 axis, it uses the 5 axis. That should kind of cap it off. What does it enable? It enables complex design of machine parts. It enables high accuracy, reduced time, and it also enables lack of manual intervention. A lot of this is done completely automated, which is the big positive. Now let's talk about what it caters to and what industries it caters to. The new products that it caters to is medical devices, toys and drones, which is on your screen, but it's largely utilized in electronics, telecom, auto, aerospace, medical, transport. This broad breakup of where all it is utilized. Now I want to also talk a little bit about some of their clientele, because that gives us deep insights into what is the kind of niche product that it does. Its clientele includes HAL, which is HAL, Tata Advanced Systems, Airbus, you have a GE, a Rolls-Royce, a Safran, Boeing, again the defense manufacturing of Bharat Forge. You have a Tata Motors, a Mahindra within the auto space, a Volvo, a BMW, a Mercedes, an Audi, a Volkswagen, an Ashok Leyland, a Fiat, and then within even the others basket, you have something like a Harsha Engineers, you have a Titan, a Bosch, a Havells. So you get the kind of diversity in terms of clientele that Jyoti deals with, and broadly the components and parts used in some of these industries are what Jyoti helps. So it's a pure B2B, helps other businesses with. That's how it stacks up in terms of clientele as well. Now let me quickly also take you through its presence and its manufacturing. It has 2 facilities, one in Rajkot, where they have more land as well to allow them to grow, and the other one is in France. And this is their Huron facility in Strasbourg in France. They had bought this in 2007. Important to understand some dynamic around this. Okay, so let's first talk about the India capacity. They've grown the India capacity from 4,400 machines per annum to 6,000 machines per annum. Their current capacity utilization is around 85%. So it's nearly at full capacity utilization. There is an expansion plan in India to expand the current facility to enable manufacture of 10,000 more machines. So taking the total to 16,000. Okay, by end of this financial year, capex of 400 to 450 odd crore will be undertaken for this, and this capacity will come on stream as early as June 2026. So in the next 12 to 15 months, you'll likely see this capacity come on stream. Let's talk about Europe also a little bit. There's been some bottlenecking which has happened there. So the top line of around 400 to 450 crore coming from Huron will now go to 800 crore as a result of this debottlenecking. Again, this will happen maybe in the next 2 to 3 months. So we'll try to understand how these timelines will work and how demand is shaping up in both of these markets. But let's talk a little bit more about Huron. It was acquired in 2007 for 16 million euros. At that point, the top line was around 33 million euros. Currently, and that top line was largely flat till 2019, so no change. But what they did was they utilized some of the R&D sitting in Huron in India to try and do product innovation, and that's exactly what's helped the numbers. So by 2023-24, Europe had also picked up. The order pipeline from 2023 to 2024 sitting currently is around 2,000 crore. So there's a large execution which is waiting to happen over there. And that's why that 800 crore push to potential top line looks likely, because you have a very large order backlog which is sitting there. Even in terms of how the market dynamic is working, it's a highly fragmented market. The top 10 players hold just 30 to 40% of market share. So that kind of goes to show that the potential to grow from where Jyoti is in terms of global outlook is quite high. India, 55%, I did mention this, of the tools are imported. We are reliant on China, Japan, as well as Germany with regard to our demand. Where is the demand currently coming from? It's coming from electronic manufacturing players. That's the big play, right? They're literally doubling every year. and therefore they really require a push with regard to setting up more capacities for which they require tools, and Jyoti CNC is currently the exclusive supplier of those tools among all Indian manufacturers. So something to look out for. They have a very, very large order book already. We'll talk a little bit about that, but we'll also speak with the management. We have Mr. P.G. Jadeja, who is the chairman and managing director, who we'll speak with at the end of this conversation. But that's a long enough introduction. Let me start off very, very quickly by looking at the parameters on this one. We'll look at the income statement, the balance sheet, the cash flows. We'll look at return ratios, shareholding, street cred. We'll look at outlook and valuations. Very quickly, we'll try to cover this. And let's start off with the income statement. You look at the growth in terms of the top line, extremely strong, a 35% CAGR over the last 3 years, and a consistent increase in each of the years. That's how the revenue has gone up, 35% CAGR. EBITDA has done far better at 86% CAGR. Profit after tax, I can't give you a CAGR, but it's doubled versus FY24, and honestly it was negative in FY22 and 23, so the CAGR number may not apply, but it's doubled in FY25 versus FY24. So very, very strong growth clip that it's on. Let's look at the margin trajectory also one more time. Kind of gives us an indication as to how margins are going. Look at that, from 10% to 27% now. There's been a very strong tailwind and a very strong pickup, at least domestically, led by the EMS play. Let's look at the balance sheet now. So clear thumbs up with regard to income statement. The balance sheet, there's some amount of equity added versus FY23. That's because of the IPO that they did, around 1,000 odd crore coming in to the other equity due to securities premium plus the fresh issue. You look at the book value currently sitting at around 1,700 crore. You look at borrowings, which is roughly 500 crore, but they've gone up quite sharply. But when I'm comparing borrowing to total equity, it's around 1:4, so fair amount of equity sitting there, or 1:3 rather. And then when you compare borrowing with the total market cap, which is around 28,000 crore, it's very comfortable, right? And therefore we've still given this a thumbs up because it's a high growth business. You would expect some amount of borrowing on the balance sheet. Borrowing doesn't seem to be completely out of whack. 1 year of profitability odd should take care of that borrowing number. We did speak about how profits have doubled versus last year and around 300 odd crore. So you have a decent amount of profitability sitting to take care of a full payback of borrowing along with cash balances as well, if one wants to look at it. So no particular concern with regard to the borrowing number. Cash balance is also sitting at around 125 crore, not bad at all. So therefore we switch to the cash flow. That's where some bit of tepidness starts to trickle through, right? You look at the negative cash flow from operations number and you look at the way in which profit after tax has moved. Cash flow from operations hasn't moved in the same fashion. That's because of increased working capital requirements, and this needs to come off. This is really the possible concern with regard to financials. So you want to look for how this will come off, how the working capital requirements will come down, and if that were to happen, you could well see cash flow from operations get much better starting FY26. But for the moment, we're giving this a thumbs down because we're not quite happy with the way this number is proving to be a headwind. Let's talk about return ratios now, because a large part of what they do in terms of free cash flow or cash flow in general is taken care of by reinvestment. They're doing high amounts of reinvestment. They're going to do another 400 crore of capex on a balance sheet size of 1,700 crore. So what you want to see is how they're doing on ROCE, and that's very strong because you look at the way ROCE has moved up and is sustaining around that 24% mark, 20+% over the last couple of years, gives good amount of credence to new investment to be made within this space. Let's look at shareholding therefore. Again, shareholding kind of shows that the promoter holding at 63% is reasonable. It's quite solid in that sense. FIs hold around 7% odd, DIs hold around 10% odd, public holds around 20%. And you look at the number of shareholders, they've gone up, but not materially. Between FY24 and FY25, the number of shareholders have gone up from 37,000 to 63,000. That's the journey of the number of shareholders as well. Nothing really materially incorrect in any of these. There is enough comfort here, and therefore we'll give it a thumbs up. Now let's look at street cred. Now you look at the 1 month performance, it's at 15%. 6 months year to date has been a little soft, no doubt, but understandably so. You look at the 1 year performance, 38% is the kind of return that this stock has given over the last 1 year. And since the listing in January, 2.8x is what the stock has done, even if you've bought it at listing. Therefore, it's given shareholders a very, very strong return. It's also left enough money on the table, because in Jan 24 there was an IPO which happened at sub 400 rupees a share, currently sitting at 1200 rupees. Surely it's left enough money on the table for shareholders. So we'll give this a thumbs up as well with regard to how shareholders would view this one and the way in which the stock has moved. But let's look at the outlook now going forward, and thereafter we look at valuations. This is how the outlook looks. In Q4 of FY25, they've delivered 1,350 odd machines. In full year FY25, they've done 4,070 machines. All of this has enabled it to clock a top line of around 1,818 crore in FY25. Now, when you're looking at current capacity, it is constrained. So what they're going to do is they're going to do a capacity expansion. But let's look at the order book first. 1,818 crore top line, order book sitting at 4,360 crore. A large part of that will come from EMS. EMS, which is electronic manufacturers, the orders will kick in starting H2 FY26. So allow them a quarter or two of softer sales in comparison, and the real pickup will start to happen H2 FY26. Of course, we'll take management guidance as to whether that currently also stands. Competition currently is sitting out of Japan, especially in the EMS space. Other than that, no domestic competition. The margin outlook is 25% for the foreseeable future. The new facility will add 10,000 machines. We did speak about it, and will go on stream from June of 2026. We spoke about that as well. 400 to 450 crore of capex on a 1,700 crore balance sheet, and Huron can do annual sales of around 800 crore post the new capex that they've done. So we've spoken about that as well. Around 80 million euros worth of sales, which we've just converted to INR to roughly 800 crore post the new capex that they have done. The risks, though, very important. Moderation in global aerospace demand, not bringing down working capital days, and execution of order book. Those could be potential risks, but those look slightly, that there is decent amount of comfort that they may not materialize. Let me put it that way. So that's how it's stacking up. Now let's look at valuations, because certainly no comfort there. With regard to the revenue, currently sitting at 1,818 crore, the revenue that broadly analysts have estimated, and there's only one analyst on the street, have estimated is around 2,700 crore. We've actually taken a 10% discount to that at 2,500 crore. Thereafter, we've built in a 50% growth in FY27, because mind you, that's where the real capacity will start to kick in, especially on the EMS side of things. EBITDA is as per guidance 25%. That means they'll do an EBITDA of 625 crore in FY26, 940 crore in FY27. They're currently at 28,000 crore in terms of market cap. I just want to flag that off. I've factored in around 100 crore of depreciation plus interest expenditure, thereby extrapolating the profit after tax. And that's where the PE currently stands. A 2-year forward PE of 45 times. No real players in this space, no major ones, like the way Jyoti is, and the growth that they are expecting. And therefore, we've not been able to kind of map that or compare that to others, at least for the moment. But that's how it all stacks up. A clear thumbs down with regard to valuations, and that's because it's an expensive story to buy into, at least at the moment. So keep your eye out on that one. Let's go, though, across straight to the management. We have PG Jadeja, who's the Chairman and Managing Director of Jyoti CNC Automation, joining us. Sir, good having you, good speaking with you. Sir, talk to us about FY26. What's the growth number that you'll be looking at? Because you have a very large order book. There's plenty of work for you to execute.
So basically, thank you very much to giving me this opportunity to explain about 26 numbers and questions and all. I was watching. Yeah. So 26 will maintain similar growth trajectory what we are having into 25. because still our limitations is going to be at 6,000 machines, and we are optimistic to be utilized at 90% in FY26 there. And that's the our focus area to be on that. The next facility will come on 27 there. Yeah.
So therefore, what should 27 numbers be like?
So in 27 numbers, let's say definitely we will have a better visibility. Let's say we will grow by on a similar fashion for a next 27 also to be there.
How long will it take to execute your full order books of 4,500 crore?
Basically, based on our run rate today, it is coming to be a 2.5 year. But we are planning to have let's say around 18 to 20 months we are looking to be executed to them.
Okay, so maybe in the next 18 odd months, you'll try to execute all of that. Excellent. Got it, sir. Sir, what's the downside risk? Because you're putting up large amounts of capex, right? Currently, you're sitting on a very large order book, but you're also growing capacity. So your current capacity, or rather once all of the capex is done by June 26, your capacity will sit at 16,000 machines. Talk to us about what is the downside risk to orders not coming at the rate at which you've put up capacity, because it's a very large capacity that you've put up.
So basically, let's say until last year, we were having a constraint. We have just removed the bottleneck and reached to a 6,000 machines, and based on capex, the size of operations, what we are doing, and what the let's say our book is allowing us to expand our capacity, and the market, basically my customers are growing everywhere, particularly in aerospace and defense. The way the geopolitical situation has been arise, and everybody, those countries has not been invested in last 30-40 years like in Europe. There this it's a huge opportunities are open up, and we are very much confident in Indian manufacturing story also over here, that here also a lot of manufacturing is going up, and particularly keeping in mind to on electronic manufacturing. This capacity is right now we feel it is from 6,000 to 16,000 has been very high, but as on today's what the pipeline we are sitting, it's still we need to another 2 years down the line we need to expand further more quickly there. That's kind of a wind we are able to see today.
Wow, so you will have to expand capacity 2 years from now, despite nearly tripling capacity in the last 12 months odd. Am I hearing that right?
Yeah, you are hearing right.
Okay.
And right now, let's say, you have to consider that 10,000 machines, what the capacity we are expanding is based on the model mix today. Okay. So today we are putting up into more into a general engineering and EMS and entry level product there. Okay. So we may not mind seeing in 10,000 machine average value what we are achieving to like that. Okay. But seeing in a next round of our capex after this 10,000, we will put forward to more into a large heavy machine for aerospace and defense to be there.
Got it. So, but aerospace and defense, do you see growth there? Because what we are largely seeing is a lot of your growth will be driven by EMS, at least at this point for the next year or two.
No, let's say this is going to be completely balanced there.
Okay.
The front runner is going to be aerospace and defense.
Okay.
The EMS will pick up from this year and gradually will grow to the next 2 to 3 years there. But right now, the let's say the flight has been takeoff is more into aerospace and defense there.
Understood. So, would it be reasonable to say that Europe will contribute around 800 odd crore of top line starting this year itself?
No. See, this is a capacity.
Got it.
And capacity is going to come only on this next month only there.
Understood.
And parallelly, this is the capacity we have made a double, but to reach out this utility, we are going to take at least minimum 2 to 3 years time there.
Understood. So the 2,000 crore that you have in terms of orders in Europe.
Basically, all the maximum you will see that the highest growths and everything you will see in a more on an India business there. Huron is in our front end there.
Sure.
And all maximum manufacturing we are shifting towards India and sending from here to their customers there basically.
Got it. And your current order book in Europe is around 2,000 odd crore. You expect that to continue to grow, and how quickly do you execute there?
See, right now we have a lot of inquiries and pressure from our customers to deliver faster there. Right now we are not able to receive those orders because already our delivery period is today is based on this capacity is 18 to 24 months or a 2.5 year like that. So no customers are ready to wait until that longer there. The way execution will be improved, the capacity will increase, this order pipe will increase solid to be there. Right now, there are a good growth we are seeing into this all manufacturing sector over there.
How will you fund your capex, sir? There's capex which is lined up this year as well as 2 years from now. You're saying there'll be more capex.
So basically, right now we don't have any borrowing in a capex. What you have, we were showing that is just some working capital. Let's say today our net borrowing is close to 300 odd crores. It's not 497 based on the deposits and all basically. We have a good margin and we are able to fund from our own margin from this year there. We will see the very cash flow positive and able to 50% maybe fund from our own, and we will borrow something more there because our balance sheets are allowing us very nicely to be there.
Understood. What happens with regard to working capital, sir? That's going up, which is what is impacting your cash flow from operations. Talk to us about why that is so and what makes you confident that that will come off. How much will it come off by in the current financial year?
I would like to correct also to be here that just look at that. The 2 years back, we were having a 330 days of inventory days. Has come down last year to be 234 days. And this year it has come down to 181 days. So it's optimized very nicely there. And still this year also we are looking to be at inventory days to come down to 160 days there. So from 330 to 160 days, and it's a purely optimized now. And this is an industry's requirement. We are fully vertically integrated company. We do all our castings, we do all the precision machining, sub-assembly, assembly, and largely these are the backward integrations over here.
Point taken. Thank you so much, Mr. Jadeja, for coming in and explaining this. A very, very niche company. But very interesting nonetheless. So thank you for coming in and speaking with us. With that, that's all the time we have on KYC. Quickly going to mark out the ratings on our KYC metrics that we cull out. It's a very healthy 6 out of 8 with 2 thumbs downs on cash flow and valuations. Everything else is a thumbs up. But that's how we sum it up with regard to Jyoti CNC. Stay tuned. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready.
Hello and welcome to Markets at 12. I am Puneet Zaveri, and we have a very interesting conversation lined up on the fertilizer side. But let's first take a look at how the markets are doing, because it's been a tough day to say the least. Since the start itself, we did see a red candlestick, and that's been down as well. From the day's low, though, we've seen a very stellar recovery of almost 200 points in the Nifty. We're down 66 points now. While there was expectations of a very narrow trading range, I think the volatility has been something to watch out for in trade today. Let's also look at the sectoral heat map as well and see how that is doing, because we've seen again the IT pack being negatively impacted, and that is the biggest, the sector that's the biggest loser. We've also seen some positive momentum coming in on media, as well as something on realty as well. We've seen the auto pack largely being, twisting and turning in terms of positive and negative. Today, again, it's on the negative side, and we've seen those stocks getting impacted today as well. Let's look at the mid cap and the small cap, see if it is outperforming the benchmark by any chance. We've seen both these benchmarks largely, trade with the Nifty 50. Today, there is some green there, so that's some positive outlook. So definitely, outperforming the benchmark to say the least. And finally, the BSE 500 as well. Again, a day where we've seen a whole host of moves on individual stocks. Biocrop Sciences, and that's been one of the key ones. Earnings, very stellar earnings, up almost 12%. We've also seen some very interesting move on ITI as well as Mishra Dhatu Nigam are also up almost 6%. Vedant Fashion is making a smart recovery today, up 3.5% after a disappointing FY25 to say the least. On the other side, in terms of reds, Sumitomo Chemical, Blue Dart, again, Blue Dart is also impacted because of results. That's a conversation on that aspect, as well as Prince Pipes down 2%. The company did report, weak set of numbers, and that was impacted because of higher PVC prices in the pipe segment, but largely down. And Interglobe as well is another stock that's down in trade today, and because we did see almost 3 to 4% promoter holdings being sold in the market today by Mr. Rakesh Gangwal, who is the promoter of Interglobe as well. But I'm now joined with my colleague Varsha as well, and to talk more about agrochemicals and fertilizer as well. Varsha, if you can just set up the conversation first before we invite our guests going forward.
Yeah, Puneet. So the above normal expectations, above normal monsoon, the expectation that we are for FY25 is actually a boost when it comes to agrochemical, or for that matter agriculture sector. Now, because the increased rainfall leads to higher demand for fertilizers and crop protection chemicals. Now, if you see, even when I talk about the fertilizer space itself, your fertilizer industry is fully insulated from impact of US tariffs. This is number one. So apart from good rain monsoon, this is one of the reason that fertilizer space is into focus. Also, China is not a major player in Indian fertilizer industry because of the higher barriers to entry, and because of this monsoon, your demand for quality seed rises sharply before and during monsoon to ensure good crop yields. That's one of the reason why you see fertilizer stocks have been buzzing, and even seed companies have been buzzing. Even the other sectors which are in focus on the back of good monsoon is your farm equipment, your irrigation equipment as well. But to speak more about how good monsoon will impact positively, especially on fertilizers. I am here joined by Mr. Himanshu Binani, who is the research analyst at Anand Rathi Institutional Equities. Hello Himanshu, good to have you. Just wanted your view on overall fertilizer sector considering good monsoon expectations.
Yeah, hi. So, first of all, thank you for having me on the show. So, on the fertilizer side, on your first question, so what my understanding is that during the last year, second half, the industry has like posted a double digit sort of like volume growth, and that was largely due to the healthy reservoir levels as well as the good soil moisture levels. So, which in turn resulted into this sort of like a volume growth number. Again, going forward, you rightly alluded with the early expectations of a normal monsoons, and monsoons have been like arrived well before time this year, so which in turn should like boost the at least the sentiments in the farming community. So after the 4Q numbers, most of the companies have been like guiding for a very decent sort of, or maybe a double digit sort of like volume growth, which is likely to sustain going forward for both the agrochemicals as well as for the fertilizer industry.
Also, Himanshu, considering subsidies in place. So previously, there was the subsidies were lower, which was actually impacting all the fertilizer companies, especially EBITDA margin of these companies. Now, because the subsidies have increased, how you're looking at the EBITDA margin of these fertilizer companies, and also if some of the picks that you have, which you see these XYZ companies could have a good growth prospects considering revenue growth and also EBITDA.
Okay, so please understand that for the urea players, the increase or decrease in the RM prices, that is like 100% pass through the subsidies. So now coming into the non-urea space, the complex fertilizer companies, so what we have seen is that the RM prices have been like largely stable, while in the recent past there has been like some sort of like price increase seen in the phosphoric acid and the other key raw materials. So again, you have to like say it this way, that companies who are like backward integrated to some extent. So maybe you have like Coromandel International, Paradip Phosphates. So these guys are like backward integrated to a decent sort of like extent. So these companies are likely to gain. So the indigenous manufacturing of the key raw materials would be like beneficial for them as compared to the imported raw materials.
Right, and Himanshu, any picks that you can give, any stocks that you are bullish when it comes to fertilizers?
On fertilizers, we continue to like Coromandel International, so this continues to remain our like top pick in the sector. So on all the business verticals, they have been like firing on all the business verticals, right from the fertilizers to the crop protections to the specialty nutrients, and now they have the some portion of like the retail as well as on the drone business also. So things are like moving steady on that side. So we continue to like Coromandel.
Right. Thank you so much, Himanshu, for answering the questions, and great to have you.
Sure. Thank you. Thank you.
Well, Puneet, actually, if you see, Adani Power is in focus. Now, this is on the back of Supreme Court, which has declared that power generating companies like Adani Power have the right to claim financial compensation and a late payment surcharge, like interest for delayed payments, if their operational cost increase due to new laws or regulatory changes. Now, this ruling stems from a dispute between Adani Power Rajasthan Limited and Jaipur Vidyut Vitran Nigam, an electricity distribution company. Now, Adani Power's cost went up by 50 rupees per ton on coal due to new charge imposed by Coal India Limited in December 2017. If I were to talk about the legal process, Adani Power argued that this was a change in law entitling them to compensation. But after the Appellate Tribunal for Electricity agreed with Adani, JVVNL appealed to the Supreme Court, to which Supreme Court dismissed JVVNL's appeal and upheld APTL's decision, meaning Adani Power is indeed entitled to the compensation. So, great news when it comes to Adani Power, because Supreme Court has now declared that power generating companies have the right to claim financial compensation.
Well, definitely, and that's a key update coming in on Adani Power. Thanks for that, Varsha. But Varsha, there's another stock that I want to talk to you about, and that's Aurobindo Pharma. Now, the results are largely a weaker set of numbers. We've seen the stock actually being in a very narrow range, but it has been downward in trade today. Tell us about how the results were, and also some key highlights from the con call as well.
Yeah, sure. So, as you rightly said, numbers were not that great, but it's the commentary which has led to the buzz in the stock. So, let me just talk about the numbers. Revenue growth was in line, margin was a miss. EBITDA margin impact that you're seeing is due to higher other expenses. Although their US business grew 13.5% year on year, which was driven by volume, stable pricing, and new launches. Europe business grew 16% year on year, which was led by strong performance across key markets, and the net profit impact that you're seeing is due to higher interest costs and depreciation, and of course there was a share of loss associates, and higher tax also impacted net profit. But what led to the buzz in the stock is the con call highlights. If I were to talk about if you see the revenue growth as per the company was driven by volume and new launches, and the gross margin that the company has seen at 59% was supported by benign raw material and better product mix. And the good thing is company is confident to hit rather to sustain the growth trajectory which they have shown in FY25, and EBITDA margin will be maintained at 21%. They are expecting an inflection point in biosimilars business by FY28, and because the cash flows are good, a board may consider buyback and dividend. Now on to just segments. If you see, formulation business grew 12%, which was driven by US, Europe, which contributes almost 87% to the total revenue, and API business also improved 5% due to higher volumes, which contributes almost 14% to the overall revenue for FY25. So overall, if you see, good commentary, and the fact that they're going to maintain the EBITDA margin at 21%, what led to buzz in the stock. But I think the stock is down now. It has come down almost, it's like 0.09%, it's trading in red. But overall in morning after the con call ended and when the market started, it was buzzing in trade.
Well, thanks for that, Varshan, giving us some key updates on fertilizers, Adani Power, as well as Auro Pharma. Thanks so much for joining in as well. I just want to pull up a couple of names in the auto pack now. One is definitely Olectra Green Tech. Now, the company is in focus after the Maharashtra government has cancelled the company's order of roughly 5,150 buses. And that's because this was awarded back in July of 2023, and the company has failed to deliver even a single bus in almost 2 years. That impact is huge for the company, and the reason is that the company has an order book of roughly 10,200 buses, and this is comprising of 50% of the company's order book, and hence it's a material impact that's happened in Olectra Green Tech. The company was in focus after the company reported its Q4 earnings yesterday. Earnings were very good, but this has come as a major negative for the company, and that's also going to be something that the conference call will be about. It's scheduled tomorrow post market hours, so that will be definitely one thing. But I just want to highlight a couple of other things as well. The government of Maharashtra had given a timeline of roughly 1,000 buses at least to be delivered by May 22nd of 2025, which was roughly just 5 days ago. The company has failed to meet that deadline as well, and hence the cancellation for the company. In the previous conference call, the company had mentioned that one bus essentially will be of 1.75 crore rupees in cost. Just in terms of cost, the 5,000 buses order would be roughly 9,000 crores for the company, and hence it's a material impact. Now, when you look also at the, interestingly enough, at Davos in January this year, the company signed another 3,000 crore order with the Maharashtra government. It's going to be interesting of what happens to that order, because there's no any kind of information from the Maharashtrian Transport Minister on this aspect, but largely that's a key negative for Electra. And the stock actually trades at a very expensive valuations of about 74 times price to earnings on a trailing basis for FY25, and hence seeing that negative reaction. I also just want to highlight one last thing, that the company has an order book of 10,200 crores, taking this one into consideration, but the capacity is only 1,200 buses. So even if this order was not cancelled, it would take roughly 8 to 9 years for the company to just execute the current order that they have in hand. So it's a lot of ambiguity essentially that the company has put its investors in, and that's reflective in this aspect as well. I just want to pull up another key space essentially, and that's the tire space. Because we have seen the natural rubber prices increase over the last year or so, and that's impacted all that. So let's also pull up a bunch of other Apollo tires as well, one of the other ones, because that's largely trading in the green. And the key reason is because we looked at the space very closely. We also had a conversation with an analyst, which we'll just play up. Essentially, in the tire space, we have seen a lot of positive commentary coming in from the companies. Essentially, if we can look at the revenue growth for the company and pull that graphic up, because Balakrishna Tires is the first one, 13% revenue growth for the company. That's the highest among the tire space. MRF and CEAT also in the double digits, so that's a positive. But the middle row is where it gets interesting. Margins for Balakrishna is at 25%, and that's largely because they operate in the off-highway tire space, which is a very high margin, 25%. And the incremental increase from the last year as well by 50 basis points. For all other tire makers, the margins have fallen by at least 200 basis points. For MRF and CEAT, it's visible on your screen. Profit is another aspect for Balakrishna, up 13%, while it's fallen for both MRF as well as CEAT. Let's also look at Apollo as well as JK Tires in this aspect. Again, very low revenue growth compared to other peers, and hence we've seen a correction in those stocks. Margins impacted and profit impacted. The other key aspect is the outlook. All players giving very strong outlook. In terms of Balakrishna Industries, while they've refrained to give guidance, they are expecting some market share gains in the off-highway tire space. For MRF, expecting again market share gains in two-wheelers as well as truck and bus radials. CEAT is looking at establishing growth again in Europe, and that's a very big positive for the company. And finally, in terms of Apollo as well as JK Tire, management expecting growth in their segments that they operate in, as well as a double-digit growth for JK Tires as well. Natural rubber prices, we've spoken about it, they have been declining, but still higher compared to the YOY level. It used to be around 160 rupees per kg, currently trading at 190. It's still lower than the 210 rupees per kg that it was in a couple of quarters ago, so definitely that's a big positive. And finally, I just want to pull up the valuation table as well very quickly, because that is the interesting one, because you get preferences for your picks in terms of growth between 10 PE to 26 PE. And that's price to earnings for FY26 specifically that we've taken. Balakrishna, because of the superior margin profile, is trading there at 25 times, but it has actually fallen roughly 6 to 7% over the last 2 days. And that's largely because they've announced their entry into essentially the passenger car space. Now, with that, that's a low margin business, will impact the company's return ratios, and hence that could be something that investors will have to need with. But apart from that, for another interesting one is CEAT, where they've acquired another entity called Camso in FY25 that will give them entry into the off-highway tire space, and management is very bullish on that. And again on JK Tire, where the valuations are rock bottom compared to its other peers. And I think if growth comes back with lower number of essentially rubber prices, it could impact the stock positively. But across the valuation really, essentially how we've titled that, it's very interesting to take your pick in this space as well. We also spoke to Anand Rathi's Mr. Manlesha, who's the analyst there, and he specifically had a couple of very interesting picks and the reasons for that. Let's listen to what he had to say.
Tire space per se, as what is happening is the crude prices have come down. International rubber prices have come down. So from going here onwards, you will see better margins for the tire companies. That will be a positive tailwind for them. And mostly the reflection of the better margin should happen from Q2 onwards, as is more lag in the impact. So in that way, the margins have bottomed down for them, and from here onwards, there should be an improvement on the margin side. And on the growth side, the replacement market should be around 6-7% growth, and the OEM market should be around mid-single-digit growth, and the exports should see a double-digit growth. So that will help them sustain a good top-line growth for all the tire companies. While in the near term, likes of CR and MRF will likely to continue to gain market share, versus compared to Apollo and JK.
Well, that was Mr. Mumuksh Mandlesha of Anand Rathi. CEAT as well as MRF are his top picks. But let's put some spotlight on the chemical space, because Jefferies had come out with a very interesting note this morning. We managed to get Varsha back. Varsha, what's the outlook that Jefferies is penciling in for the chemical space, and some top picks if you can highlight that?
Yeah, sure. So first, what Jefferies is saying that innovator companies, that is big pharma companies, they are expecting flat revenue, or rather flat revenue growth for calendar year 2025 despite a low base for 2024. Now we all know the pricing pressure that's going in chemical industry, and what they're saying is that why they're saying this, because China is aggressively exporting agrochemicals with volumes up significantly, and their export prices are hitting 9-year lows so that means there's an increasing competition when it comes to Indian players. Now the market for refrigerant gases, are used in your ACs. The market for these gases is stable, but new generation HFOs are actually seeing accelerating adoption in the US. Now on the picks or the company specific, what Jefferies likes is, first is Navin Fluorine. So their preferred pick is Navin Fluorine. Why? Because it is they are considering it is a better placed, because new product startups in both agrochemicals and your custom development and manufacturing from Q4 FY25 onwards provide strong earning growth visibility. We all know that Navin Fluorine did come out with a good numbers based on their CDMO business. And a new contract with Chemrus offers additional upside when it comes to Navin Fluorine. While Jefferies is projecting a 35% EPS CAGR for Navin Fluorine from FY25 to 27, despite the challenging demand that the industry has. The other preferred pick for the Jefferies is PI Industries, because of the custom synthesis or custom manufacturing revenue decline in Q4 impacted PI Industries, but new commercialized products and the biologics segment are actually showing robust growth. So basically PI Industries is an attractive buy point according to Jefferies. So these are the two picks when it comes to Jefferies, that is Navin Fluorine and PI Industries.
Varsha, let me just actually put you on the spot on Bayer Crop Sciences as well. We saw the stocks up almost to 12%. If you can highlight a couple of reasons why that is.
Yeah, so overall, Puneet, a good set of numbers when it comes to Bayer crop. Now the revenue growth that you're seeing is led by strong growth in spring corn and crop protection portfolio that the company has seen. The EBITDA margin expansion that you're seeing is led by lower employee cost. So to say, employee cost, which was 16% to revenue in last year, that is Q4 FY24, came out to 11% to revenue in this quarter. So of course, because of the higher growth in revenue and no increase in employee cost. So basically the operating leverage that the company has been enjoying. The promotional investments have made, that was made in the previous quarter, have also generated significant returns, and the other income that the company has seen has also aided net profits for the company. So as to say, just to speak on the four numbers, revenue was up 32%, EBITDA was up 75%, margins were at 16% versus 12%, and net profit was up 49%. So overall good set of numbers operationally, and even net profit, because of other income also, net profit was higher.
Well, thanks for that, Varsha, for highlighting that. But the paints industry is seeing 10,000 crore of a capex boom, but market leader Asian Paints is actually losing ground. Now, as that's happening because of a consolidation phase of the paints industry, which the company is painting a better picture going forward. That's the question that we are asking my colleague, Mr. Sajit Mangat, to talk more about this and see how the competitive pressure has changed the landscape. Sajit.
That's right. The paints business is now heating up. In FY25, it was one of the, a blockbuster year with respect to the capex coming into the industry. The paint sector itself saw capex of more than 10,000 odd crores, led by new entrants like Grasim through Birla Opus, and there were other smaller players which were adding more capacity to get into the premium and luxury segment there. We had 3 new entrants that came into the paint segment, with Birla Opus being one. Then you have JSW, and then there were smaller players like the Kamdhenus and others who started some of the paint operations in this segment, and that led to a drastic churn of market share within the decorative paints market, which accounts for nearly 70% of the total paint industry there. If you look at it, Asian Paints, being the largest paint maker with over 50% market share, was the biggest loser in this thing at the end of the year. Birla Opus ensured that there was a dent in the premium and the luxury segment, and there were other players like Berger, the Nerolac and Indigo, which gained market share in terms of revenue going into the year. What was important and striking was that the industry as a whole did not grow much. There was a stagnant market. It was a stagnant market. There was no organic growth. Urban discretionary spend was slow, and rural was picking up. If you look at the total revenue of the industry in FY25, and I'm talking of the 9 listed companies in the paint segment, the revenues grew by only just 2% in terms of absolute revenues there. So 9 listed companies' revenue went up by 2%, and incumbents, which are Bergers, the Nerolacs, and the Indigos, did gain some market share in terms of revenues. And while profitability was hit because there was an extensive price war which was coming in, because every company was trying to maintain their market share in this lucrative market, which was a high margin business, premium and luxury segment being the one. If you look at the revenue market share, how it moved during the year, Asian Paints at the end of FY24 had a revenue market share of 58.5%. By the end of FY25, it came down to 54.5%. Berger, it had 18.2%, it went up to 18.6%, and there are slight variations with other players in the market there. But what is striking here is that the Q4 numbers were a little striking, because the leader in the pack, which is Asian Paints, came back to safeguard its market share, and we saw the revenue market share for Asian Paints just jump to 55.3%, and that basically shows the kind of hyper competition which is there in the market. Players are now vying for the limited demand which is coming in. From a dealer's point of view, the dealerships are not increasing. It's the existing dealer which is bifurcating demand to multiple paint makers, and so everyone is vying for that demand, and as a result of that, hyper price competition is coming in, higher marketing and distribution spends are coming in, and that's denting the margin for the Asian paints industry. So going into FY26, you have a lower urban demand which is there. Rural is improving, and hopefully if the spends increase, then there is going to be some kind of relief for the paints industry.
Well, thank you for that, Sajid, but that's all the time that we have in this edition of Markets at 12. Thanks so much for watching. Stay tuned to NDTV Profit for more.
That's huge. That is a biggie. It's out of
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Welcome, you're watching Profit Buzzers. I'm Mahima Vachhajani, with me is Neeraj Shah. Before we move on with the show, let's take a quick look as to how the markets are doing right now. We saw a good bounce back in the Nifty 50 in the past 1 hour. It did touch the 25,000 mark, and then now it's come back to around 24,827 levels. In terms of the Nifty 500, it's down by about 0.4%. The Nifty Bank seeing some pressure, down by about 0.4%. But the broader markets, in fact, the mid-cap 150 is turned positive and trading around 0.13% higher. Not at its day's highs, but recovered quite a bit. The small cap 250 is trading around 0.2% higher. In terms of the Nifty total market, before that, let's also pull up the Nifty 50 heat map and see what counters are buzzing in trade today. There's IndusInd Bank definitely leading the entire pack, but a lot of counters that have turned in green. Is IndusInd up 2%, Trent up almost 1.4%, followed by Asian Paints, SBI and BEL. Some counters under pressure. There is Grasim, Ultratech, NTPC down by about 1.5 to 2%. Let's also pull up the sectoral heat map and see how sectors are faring in trade today. It's the Nifty Defense, which is clearly leading the pack, up by about 1%. Nifty Media up by about 0.5%. Nifty Realty also doing well in trade today, up by about 0.4%. Nifty IT under pressure, down by about 0.8%. There is Nifty Auto, which is down by about 0.7%. Nifty Infra also seeing a tad bit of pressure. Nifty FMCG also facing pressure, down by about 0.6%. But in terms of some specific stocks that are buzzing in trade today on the back of news, earnings, etc., we have counters like Electra Green Tech. Let's pull up that and see what it's doing in trade today. Down by about 6%, and this is on the back of the Maharashtra government cancelling order for the company. There's counters like Blue Dart on the back of its earning, down by about 5%. Stocks like Dreamfolks, Dishman Carbogen, Action Construction all facing pressure. Some counters doing well in trade also include India Pesticides, up by about 12%. Bayer Crop Science on the back of stunning numbers, up by about 11%. ITI, Schneider Electric, all doing well in trade today. There is also CCL Products up by 5.8%. Mishra Dhatu also up by 5%. Tega Industries also up by about 5%. A lot of defense counters also buzzing in trade today. Let's pull up the Nifty Defense and see what counters are exactly buzzing in trade today. There you go. There's Mishra Dhatu, there's Garden Reach, Astra Micro, Bharat Dynamics, Cochin Shipyard, all counters in green except for Data Patterns, which is down by about 0.18%, and Solar Industries, which is down by about 1.28%. But let's also shift focus to Afcon's infrastructure. In terms of the earnings, revenue was down around 11%, and this is on the back of lower execution. There was a healthy order inflow. There was softer raw material costs that kind of aided the gross margins, but the gross margins overall also were impacted by employee costs and hike in other expenses. Overall net profit was down 23%. Margins in terms of EBITDA margins, they were down around 66 basis points. But to discuss as to how the quarter has gone by and how things are shaping up, we're joined by Ramesh Jha, the CFO of Afcons, and we're also joined by Hitesh Singh, Head of Corporate Strategy at Afcons, joining us now. Welcome to both of you, gentlemen. My first question, Ramesh, to you would be that, overall this particular quarter execution was impacted because of Bangladesh, but in terms of your healthy order book, you have a revenue visibility for the next 4 years. Just wanted to understand as to how execution will take place in FY26. How much of an order book do you think will get executed in FY26?
So we have order book of 36,869 crores, quite diversified order book at the moment, and we are also L1 in close to 10,600 crores of order. So as things stands, we are looking at anywhere between 20 to 25% top line growth in FY26.
Okay, and in terms of the overall order book inflow that you're expecting in FY26, just wanted to get a sense of the kind of CAGR growth that you're expecting, and overall in terms of your order book breakup as well. Will the mix change going ahead in terms of the government as well as multilateral trades and private trades?
Yeah, so in terms of our order book, if you see, we have a very well diversified order book, but largely around 80% of our order book comes from government client, and a part of that remaining comes from the private client and multilateral areas. In terms of order book mix, I mean, what we follow is wherever we find good quality, high quality orders, that kind of orders we pursue because we have a very strong risk management process to ensure good quality orders comes in. So if you see currently the urban, which is the metro business, which includes bridges and metros, has the highest share. And going forward in the near future, we believe that their proportion will continue on the higher side, which is close to, if you put everything together, around 50%.
Ramesh, good afternoon, Neeraj here. So it clearly is evident that order inflow and order wins is not a problem. If anything, in Q4 execution was. And there are various reasons attributed for this, maybe delay in the import of the TBMs for high-speed train order or Bangladesh, etc. I mean, do these get resolved in Q1 itself, or is it difficult to predict that?
So Neeraj, I understand that Q4, when we look at the number, we had seen in the economy that there was a liquidity-related, discussions happening that overall in the Indian economy there was a liquidity-related issue, and RBI came in and they tried to, help the economy with the open market operations and other stuffs. So it was a call which we had to take between, funding the growth and at the same time, maintaining the liquidity, because we were not very sure how things are going to unfold. And so we funded many projects, but at the same time, we didn't want a situation where we overexpose ourselves. And that's where calibrated calls were taken in Bangladesh or say Jal Jeevan Mission, because payments were not forthcoming. And also we had seen across the spectrum, many customers' payments were not as smooth as one would have expected. So generally in Q4 every year, we do 15 to 20% more top line as compared to Q2 and Q3, which has not happened this year. And that has impacted the Q4. But at the same time, I think we are seeing that the situation is improving as far as liquidity is concerned. We are not looking at in our projections, we have not factored too much on, say, Bangladesh. And Jal Jeevan Mission in Madhya Pradesh, we have received sizable amount of money in the month of April. And whatever discussions we are having in the project in UP, we are seeing that in June they are going to release sizable amount of money. So I think things looking good, and we are looking at a sizable improvement as far as the execution performance is concerned in Q1.
So, Ramesh, suffice to say, you're saying that you chose to do this in Q4 in order to not lend into an issue of peril. Now, my question therefore would be that if you expect this growth to come back, all right, and if somebody were to look at your CAGR performance over 3-4 years, and if you're guiding to whatever number, if it's a 15%, 20%, what have you, is it from the lower base of March 25 that you believe you'll do this 15-20% or whatever the number is? Or do you believe that over a period of FY24 to 27, you can actually show that 15 to 20% CAGR growth?
You are absolutely right. See, as far as this 26 is concerned, there will be an impact of lower base of 25.
Exactly.
That is given. But at the same time, what we are talking about in 26, because of the lower base, 20 to 25% growth, whereas medium term, we are talking about a 15% CAGR.
Okay. Fair call. Okay, so 20 to 25% for FY26, and which bakes into account some deliberate strategies that you may have to do, because I don't think the Bangladesh issue is over, right, Hitesh? I presume that from whatever little we hear with the GRSC orders getting cancelled, etc., Bangladesh issues might still be there. So you might still be impacted by that, but you will probably still do 25%.
The thing is that here, because Bangladesh happened all over, there were we have done from this year in Bangladesh is going out. So in our planning and calculation.
Hitesh, I'm sorry, Hitesh. I think there is some network issue at your end. I'm going to try and request Ramesh to maybe give this answer. Ramesh, can you give the reply? Because we can't hear Hitesh very, very well.
Yeah, so what we are talking about, last year, we had planned, because at the beginning of the year, there were no issues as such, and the problem in Bangladesh cropped up in the month of August, all of a sudden. Whereas this financial year, we know what is happening in Bangladesh, and all our plans are calibrated.
Okay. Ramesh, one more question to you with respect to where margins are concerned, because your overall EBITDA margins have come back to the 2023 levels. Just want to get a sense, because these have been improving on the back of increasing size plus complexity of projects. Do you think that margins in FY26 will improve going ahead as well, and what will be the levers?
If we look at FY24, 25 on an overall basis, we have done close to 12.8%. And this has improved from the previous year. In 24, we have done 11.6%. So 120 basis improvement. Now for 26, what we are talking about, the guidance we have always talked about is 11% plus. So that's what our guidance will remain for 26.
Okay. One last question, and Hitesh, I'm sorry, but your audio isn't quite there, so which is why we can't really ask you the question. But one last question to you, both of you, and maybe if the audio is okay, Hitesh can answer. But one of the common things that we are listening from every corporate which is into a people-heavy business is that talent sourcing is becoming a big issue. Are you guys facing issues on the ground as well with regards to availability of quality manpower for executing?
Am I audible, Neeraj?
Loud and clear right now.
So yes, there is a challenge. I mean, in terms of both skilled and unskilled manpower, the industry is facing, we are also facing the same challenge. Having said that, we have made adequate arrangements in terms of availability, and the future, whatever is required, we have done tie-ups with many training institutes. So far we are managing it well, but yes, on ground, there are challenges.
Okay, gentlemen, we'll leave it at that. Thank you so much for taking the time out. All the best for the quarters ahead.
Thank you so much for having us. Thank you.
That's Afcons Infra, and talking about some possibilities of a reversal of fortunes in FY26 after a deliberate attempt in FY25, especially quarter 4, to go slow because of the situation as it stood. Now, just a word on the market, just before you take over for KC, because it's very, very choppy out there. You look at the last 45-minute chart, if you will, and just look at the market. It went low. We went to the highest point of the day and are again succumbing to some bit of selling pressure. This is extreme volatility. I mean, it's quite stunning as to what's happening. And I don't think the global markets are so volatile. So, yeah, I reckon a few stop losses might be getting triggered in today's trade.
Yeah, and we're seeing the India VIX also spike. I think it's at 19 right now. Let's pull up the India VIX and see. And if it's come back to 18.9 odd %, but at some point during the day it was almost 19.3, and if it reaches that 20 mark, that indicates a lot of volatility in the market. So that's with regards to the markets. KC International is one of the counter which is in focus on the back of its earnings. The stock has come off from its day's high, but a decent set of numbers, strong earnings in fact. Revenue was up 11%, EBITDA up almost 39%, margins improved to 7.8% from 6.3%, net profit up 76%. In terms of how the business performed, the transmission and distribution revenue was up 28%. The non-transmission and distribution revenue came down by about 5 odd %, where transmission distribution share stands at around 63 odd %. In terms of profit, that was aided by a lot of clearance in their inventory. There was also an 8% decrease in their overall erection as well as subcontracting expenses, and there was a significant jump in their OCI, that is your other comprehensive income as well. In terms of order book, it stands healthy. In terms of order book plus L1 bidding, it stands at around 40,000 odd crores. 31st March order book stands at around 33,300 odd crores, and FY25 order intake stood at 24,600 odd crores. With the management said that FY26 they are expecting an order intake of roughly 30,000 odd crores. In FY26, they did see an order intake so far of around 2,000 odd crores. And overall, in terms of outlook, they're expecting margins also to improve going forward. In fact, we also spoke to Vimal Kejriwal, Managing Director and CEO of KAC International, about what's aiding the margin and outlook going forward. Listen in.
The share of T&D is going up both in the order book and the revenue. Also, we have been able to, close some of our legacy orders which were part of the COVID era, etc. So those are, I think, I'll say two major reasons why the margins are going up, and we have been talking of improving them further next year.
Okay, tell us about the margin expansion that we've seen. Want to understand if this is something pushed by factors we've seen this quarter. Is it sustainable? What are the kind of margin levels you're seeing for the financial year?
So, Tamanna, if you look at the margins for the year, we have ended up at 7%. For the quarter, at 7.8%. And generally, we have been saying that we will be between 8 to 8.5 for the next year. And I'll not say it is one-off. It has been a sustained effort to close old projects and push revenue in the newer projects. Also, we talked about order book being order intake for the year being close to 25,000 crores. So what has helped us is that with the growth in the tender pipeline, we are becoming much more selective in the orders which we take, looking at cash flows, looking at margins. So clearly the order book is looking much more healthy than what it was at the start of the year in terms of margins and cash flows.
All right, so that was the management of KAC International indicating a healthy order book and execution as well. And with that, let's also welcome in our guest for the day, Raghvendra Kedia, founder of Prosperity Advisors, joining us now. Very good afternoon to you, Raghvendra. Your view on KAC earnings and what's the outlook like for the counter?
Good afternoon, Mahima. Broadly, KAC International has come out with very stellar earnings. What is impressive in the result reporting is that the revenue has gone up by 10-11%. However, on a year-on-year basis, if you compare with the full year, the PAT, profit after tax, has gone up by more than 70%. So that great operational efficiency, that's great margin expansion. The company in its presentation has reported that their net debt has also come down by around 10%. And another great performance has been in the net working capital, where it has come down by 12 days to around 122 days. So we have seen a double-digit revenue growth. We have seen a 70% PAT expansion. We have seen net working capital coming down. Broadly, we believe that this performance is not one-off, but in terms of a great operational efficiency for KAC International. And they have indicated their growth plans across Middle East, Africa, and the CIS nations. So we believe that the stock can climb to levels of around 1060. That is a good 20% growth from current levels. So it's a flagship RPG group company. We believe that it can scale to another 20% upside from a 12-year investment horizon in a good global macro environment, and the domestic environment also remaining very healthy, which is what the management has indicated in its result commentary.
Okay. Well, Bayer Crop is a stock in focus as well. It's buzzing, I think, over 10%. Yes, it is still above over 10% on the back of strong earnings. Varsha Johnson with details of these earnings. Varsha.
Thank you so much for that. So yes, good set of numbers by by the company. The revenue growth that you're seeing is led by strong performance in their spring corn and crop protection portfolio, and the EBITDA margin expansion that you're seeing is led by lower employee costs and of course the operating leverage that the company has enjoyed. Just on the employee cost which was 16% to revenue last year was 11% to revenue this year. The promotional investments that the company has made in the previous quarter has generated significant returns for the company, and there was a spike in other income also, which has also aided net profit. Just to speak on the four numbers, revenue was up 32%, EBITDA was up 75%, margins were at 16% versus 12% last year, net profit was up 49%, which was also aided by your other income.
Okay, well, strong moves for sure. Thanks, Varsha, for that. Raghavendra, have you looked at Bayer? And if not Bayer, any other agrochem crop protection business whose results were positive for you?
So broadly, the overall agro space and the pesticide chemical space, we are bullish, considering the government spend across rural space and a good monsoon forecast. Specific to Bayer Crop Science, we believe that the company has reported excellent earnings again. We believe that at this run rate, they can clock a full year EPS of around 180 rupees on a full year basis, and giving a moderate multiple of 36 times P multiple. We come with a price target of around 6,400. So that's still a 12 to 13% upside from current levels in Bayer Crop Science. It's a great management. The promoter holds around 71%. Then the mutual fund and FPIs hold around 13%. So we have 84% across promoter and institutional investors. So that is very comforting. In terms of debt, the company is almost debt free. So we are talking about a very high promoter holding, debt free company, very steady earnings. So a 6,400 target on a full year, 1 year time horizon. In Bayer Crop Science, we believe it's a slow and steady upmarch from current levels also.
6,400 is the 1 year target as per Raghavendra for Bayer Crop. Now on to an NDTV exclusive. Finance Minister Nirmala Sitharaman will meet the CII to discuss the GST reforms. Shrimi joins us with more exclusive details on that. Shrimi, what are you picking up?
Yeah, so Finance Minister Nirmala Sitharaman is set to hold a closed-door meeting today with CII at 5:30 to discuss key aspects of GST reform. Source indicated us that meeting is expected to focus on gathering CII inputs and otherwise like industry representation as government look to kind of push forward with a broader GST overhaul. So top agenda is what we are picking up includes rate rationalization, the future of compensation sets, and the possible structural changes to, simplify and strengthen the entire GST framework. Now, this interaction is crucial because it's coming ahead of the expected discussion in the GST Council, which will convene soon, is what source is hinting at, on the long pending rate rationalization issue, the restructuring of the existing tax slab of GST, even the future of compensation cess, which is going to end, in 2026, and whether the cess will replace with a new tax or subsumed with the existing rate, that clarity needs to come. So overall, there are certain pending crucial agenda, which GST Council is expected to take up in the next council meeting. However, we yet to know the date of that council meeting. But some of these include definitely the rate rationalization and the future of compensations, as well as the GST on both life and health insurance. Remember, in the last GST Council meeting in December, these matters have been deferred. But in the next council meeting, which will happen soon, these pending issues will be taken up and we'll see some progress there.
Okay, thank you so much, Shrimi, for bringing us all those details. We'll keep an eye on what the updates are going ahead as well. All right, the next counter in focus is Aurobindo Pharma. Revenue growth was largely in line. Margins and net profit were a miss. The company's con call was also hosted at 8:30 in the morning today, and we have Varsha joining us on more details as to what has not worked for the company and overall what has, the pharma pack, how has it fared in the fourth quarter overall. Varsha, over to you.
Thank you for that. So overall, if you see the numbers, revenue growth was in line, but margin was a mess. The EBITDA margin impact that you're seeing is due to higher other expenses. Although US business grew 13.5% year on year, which was driven by volume, stable pricing and new launches. Now Europe business grew 16% year on year, which was led by strong performance across key categories. The net profit impact that you're seeing is because of the higher interest costs and depreciation expenses, and also share of loss of associates and higher taxes also impacted net profit. Just on the con call highlight, so what company is expecting is they are confident to continue growth trajectory for FY26, and they are expecting to sustain the EBITDA margins of 21%, and they expect inflection point in biosimilars for FY28, which is the next leg of growth when it comes to Aurobindo. The cash flows are good, so board may consider buyback, and gross margin of 59% that the company has seen is supported by benign raw material and of course better product mix. On the formulation side, which grew 12%, was driven by US and Europe business, and also they have expanded formulation manufacturing facility, which will drive growth for the company, and they are also working on multiple respiratory products as of now.
Okay, Varsha, thank you so much for breaking that down for us. Raghavendra, I'll come to you. Your view on how Q4 panned out for Aurobindo Pharma, and plus any view with respect to what companies you like in the pharma space?
So specific to Aurobindo Pharma, we believe that the revenue miss is a concern. And even if you see the sales growth of the last 3-4 years, that has been pretty unimpressive at around 7% or so. Even the return on equity has been around 10-11% over the last 3-4 years. So that has not been very impressive to the level where we can actually go and take a holding in the stock. We believe that at levels of 1190, we would avoid any fresh buying or entry in Aurobindo Pharma and wait for levels of around 1080, 1100 price correction to follow, where some valuations comfort comes in, but that also with the condition that there should be a sustainability of 21% margin plus, which has been a concern in this quarter. So specifically looking at the current earning reporting, we would avoid Aurobindo Pharma. It's unimpressive earnings and has been below our expectations. Moving to your second question, in terms of what we like in the overall pharma space, we would prefer our weightage in large cap names, and Sun Pharma remains our top pick in the entire pharma pack, considering its global expansion and sustained and steady growth rate.
Okay, on to more news and updates. Adani Power is in focus. The Apex Court has upheld the appellate tribunal for electricity's order. This allows Adani Power to claim compensation under the change in law clause of its power purchase agreement. Confused? Let's get in Somit to explain. Somit, please explain what does this mean, and what would it mean for an Adani Power shareholder?
Well, it's important and positive news that has come in for Adani Power here. Now, Supreme Court has affirmed that the appeals order, which was earlier in favor of Adani Power, will remain, and they have dismissed the appeal that was filed by Jaipur Vidyut Vitram Nigam. Now, Supreme Court is of the view that power generators are entitled to claim compensations and late payment surcharge based a carrying cost under power purchase agreement for cost escalation resulting from the regulatory changes, which means that if there is any regulatory change because of which a power generator is seeing an escalation in cost, they are eligible to claim that extra cost from the state. Now, the bench of Justices M.M. Sundaresh and Rajesh Bindal had the case regarding this dispute, which was around the power purchase agreement between Jaipur Vidyut Vitram Limited and Adani Power Rajasthan Limited for supply of 1200 megawatt of power at a fixed tariff. Now, given that this agreement was under fixed tariff and Adani Power had claimed this compensation, this was filed the case was filed with the APTEL, but Adani Power had sought compensation under the PPA's change in law clause, and this was because under the same clause, Coal India had also imposed an additional levy of around 50 rupees per ton on coal charges. Thereby, Adani Power's cost had increased, and this increased cost was something that Adani Power was claiming from the state government, and this claim was already approved by APTEL, that is the Appellate Tribunal for Electricity. However, Jaipur Vidyut Vitram Nigam had appealed this decision of APTEL in Supreme Court, and now Supreme Court has also dismissed this appeal and given the decision in favor of Adani Power, which means that whatever claim that they are asking from the state government will be given to Adani Power going forward.
Okay. Well, thanks a lot for that, Somit. And pull up that stock once before we take that break. Adani Power should come up on your screen in a minute. It's flat right now, 0.64%, maybe in line with what the market is doing as well, actually. Very, very few stocks are actually bucking the trend quite significantly. As you saw, even some of the other names came off, the likes of KEC, etc. Standard disclaimer, of course, the Adani Group owns Adani Power, of course, and are also the promoter holders of NDTV. We need to slip into a quick break. More on the other side. Stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market mover.
Volatile trade is the name of the game. Nifty and Sensex are off days lows while defense stocks continue to gallop thanks to news reporters of an additional 50,000 crore boost.
Bayer crop shoots up in trade as the chemical company posts a strong Q4. Profit jumps 50% as margins surge by as much as 4 percentage points on a year-on-year basis.
Interglobe Aviation shares under pressure. Founder Rakesh Gangwal and promoter entity offload 5.7% stake for over 11,385 crore rupees. Remember, Gangwal stepped down from the board in February 2022 and had said he would gradually reduce his stake.
Electra Green loses ground as Maharashtra government cancels a tender of 5,000 buses worth 9,000 crore rupees. State Transport Minister says, and I quote, "There is a doubt about the supply of buses by this organization in future," unquote.
The Supreme Court rules in favor of Adani Power, allows Adani Power to claim higher compensation in power purchase since a change in law had led to increased operational costs.
Welcome back. You're watching Profit Buzzers. My name is Alex Matthew, and of course, you know Mahima Vashrajani. And let's talk about the latest update in the cement space. The onset of the monsoon has resulted in a stalling of cement price rise in South India. That is something that has been taking place in the recent past. It in fact caught up with the rest of the geographies only recently. What's next for the sector? Somit is joining in to tell you about the key details. Somit, construction activity getting stalled?
Well, yes, construction activities are getting stalled, but moreover, the fact that the prices are also coming under pressure. Yes, cement stocks are under pressure in trade today, and this is after INCRED has come out with this note on cement companies where they're saying that the monsoon onset has stalled the cement price rise that we had specifically seen in South India. Now, dealers have started to offer discounts from their margins to boost the sales volume, and this is owing to a combination of subdued demand that was already there, and now the onset of rains has also put more pressure on the demand offtake. Now, this has also raised concerns on the potential losses that could happen to the inventory which is sitting with the dealers and as well as with the companies. Now, as per INCRED's dealer check in Karnataka, dealers are providing a discount of approximately 10 rupees per bag, and similarly in Andhra Pradesh and Telangana, the discounts are offering in the range of anywhere between 10 rupees to 20 rupees per bag, and any form of discount that is currently being offered by the dealers from their own margins could also lead to more price cuts coming forward as per INCRED. Now, few companies that have significant exposure towards South India include Ramco Cement, Dalmia Bharat and Ultratech via India Cements.
Got it. All right. Thanks so much, Somit, for getting us those details. Certainly stocks to watch out for because quite a few of these have been in focus. Among them, JK Cement posted its numbers not too long back, in a good set of numbers at that, and the stock was up and about. I wonder what it's doing right now. It's still gaining about 2%, but off the high point of the day. Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities, joining us right now. Raghavendra Kedia already with us. And Raghavendra, hi. Good afternoon from my side as well. Let me come to you on cement stocks. What do you think the implications are of this stalled activity and what Somit was just pointing out in terms of the pricing pressure, the discounts that are now being offered, and the inventory losses that could occur?
This is to me?
Raghavendra, it's for you.
Yeah. Okay. Good afternoon, Alex.
Good afternoon.
Broadly, the onset of monsoon and a pre-arrival by 15 days is not a great cheer for the cement companies. The construction activity would be slowed down. But that's the reason we actually have the seasonality in this business. It could impact the earnings for this quarter and going ahead, considering it will be a good monsoon and a stretched monsoon pan-India basis. So we might see some kind of revenue pressure across the cement companies, and we believe that overall the capacity utilization is under 75%. That might still increase, which might be a concern in terms of the revenue as well as the margins. So this monsoon onset and a good monsoon is a concern, but we believe that if you see the earnings reported, there has been very good earnings specific to Shree Cement, JK Cement, and overall the management commentary for the next 2 to 4 quarters have been pretty upbeat. So we believe that this could be just a small dent in terms of the forecast, but believe the overall growth story is intact, and any sizable price correction in terms of 5 to 10% in the overall market could actually give some good entry points in the cement counters, and JK Cement and Shree Cement continue to remain on a radar for any entry levels at a double-digit price correction from current levels.
That's the fundamental view with regards to these cement companies. Vinay, any of these cement companies looking attractive right now where charts are concerned?
Yeah, good afternoon and thanks for having me on the show. So yes, a stock specific move is there in the cement sector. So if I were to consider JK Lakshmi Cement, it is looking extremely good on the charts. On the medium term charts, we have seen a fresh breakouts and price has been holding up. So no doubt some monsoon related news are there and some profit booking is going on in some stocks in the same sector. Like the large cap stock like Ultratech Cement is showing weakness. But if I go by the charts, then JK Lakshmi Cement and followed by the Shree Cement. These are the two stocks which are looking strong on the charts. So they can continue to do well. It looks like that. So right now market is has turned choppy and into a consolidation. So one day it is going up and another day stock is facing profit booking. So choppiness is there. There is no momentum. Direction is not fixed as of now. But primary trend of the market is bullish. And in as far as cement is concerned, JK Lakshmi Cement and Shree Cement looks very strong on the charts.
Okay, so that's the view with regards to where charts are concerned for the cement counters. Another stock that is under pressure is Olectra Greentech. It has, however, recovered. Let's pull up the charts. It's not really recovered. It's trading within the same range and down by about 5.4%. Now, this is because the Maharashtra government has cancelled a major order of 5,000 e-buses, which amounts to around 9,000 odd crores. And we have Puneet joining us with more details on that. Puneet, we are already seeing the pressure on the stock, and how does this overall impact the overall revenues of the company?
Well, thank you for that. So the key aspect is 5,150 EV buses order cancelled by Maharashtra government, as you rightly said. That's 50% of the company's current order book of 10,200 vehicles, and hence we're seeing that knock on the stock today. This order of 5,000 buses were actually given to Olectra Greentech in July of 2023, and not a single bus has been delivered over the last 2 years, and hence the subsequent action. Now, the key aspect is that the government was in touch with the company, and a revised timeline of 1,000 buses was specifically asked for by the company to be delivered before May 22nd of 2025. That timeline has also lapsed and there's been no delivery, and hence the subsequent cancellation of the order book. As you rightly said, currently the company mentioned in its previous conference call that one bus costs roughly 1.75 crore rupees, and with just a simple multiplication of that into 5,000 buses is a 9,000 crore order value that's been lost by Olectra Greentech. The interesting part is that the company actually signed another 3,000 crore worth of orders with the Maharashtra government just in this January or 2025 at the Davos summit, and what happens to that order is now something to be watched out for, but there's no clarity on that aspect. Finally, in terms of the cumulative orders we've spoken about, that 10,200 crores, including this particular order book. But what is interesting is that the company's current capacity is only of 1,200 e-buses can be manufactured in 1 year. So subsequently, it would take them 8 to 9 years to just deliver the current order book of the company, and hence the writing was on the wall for the last few quarters regarding the lack of investments in increasing its manufacturing facility to deliver the said orders. The current stock price also is reflective of that, but it's trading at 74 times price to earnings on a trailing basis. No analyst coverage, not much ownership by mutual funds. This largely has a 36% ownership by public essentially, which is below 2 lakh rupees investors, and those getting impacted. Just one last bit, that the company is scheduled to hold a conference call to discuss Q4 earnings tomorrow at 4:30 post market hours. So some key questions will be asked there, but largely a big huge negative for Olectra as well as investors.
And important points that you're raising. Thanks so much for getting us those details, Puneet. So the question then, Raghavendra, is it is off the low point of the day, but still seeing cuts of as much as 5%. It's a major negative because it's a very, very large order. But what Puneet was pointing out, the lack of capacity in any case to fulfill those orders from the perspective of the one placing the order, which is the government, they're right in their own way to have cancelled the order. But what does this mean for individual shareholders?
So for an individual shareholder, I would actually say this is a time to exit the stock. This current Maharashtra government has similar regimes across different states of India, and they would also go back to their orders and say if when the order was given and how has been the deliverables. So that could be a chain reaction, a negative chain reaction in terms of Olectra. Now, the debt levels of the company have been concerned. This is in spite of no new capex. And as Puneet very insightfully pointed out, that their capacity to deliver is very low as compared to their order book. So there is a great mismatch in terms of what they have promised and what they have signed versus what they actually have the infrastructure to deliver. So, and plus this particular order which was cancelled was signed in 2023, and we are in half of 2025. So broadly, if you snooze, you lose, and that is what has happened to Electra Green. So from a retail shareholder point of view or any investor into it, we would say it's a yellow flag, and you can actually look to exit this counter. This stock actually has been on a correction mode. It was more fancied in terms of the EV space story, but broadly, even in terms of P multiples, the full year EPS is on a good side, 25 rupees. That gives a very high astronomical multiple of around 50-55 times at current price. So even on valuation metrics, it's very expensive. So we would say this is a time when somebody can look to exit Electra Green even at current levels.
Okay. All right. Very quick check of where the markets are. We've seen a wide swing either way. So on the one hand, you had cuts of about 1%, then you had a complete recovery and a move into positive territory for the benchmark Nifty 50. You see the high point of the day midway through the session so far. And then we've again seen a slip to not the low point of the day, but cuts of about 0.7%. And what is leading the declines and contributing most at this juncture is the big wigs, right? You have Reliance Industries, you have HDFC Bank, you have ICICI Bank, ITC, all leading the contributors on the downside, and not too much in the way of gainers. In fact, only about 15 stocks gaining ground as I speak to you right now. And among them, you have the likes of IndusInd Bank that is up about 3%. You have Trent that's 1.3% higher, Asian Paints about 0.6% higher. So not too much in the way of big gainers. Very quick view on the charts, just so that we can get a sense of this. Vinay, how do you trade this? Because there's increased volatility ahead of that monthly expiry at the benchmark level. How do you trade?
Yeah, so a lot of events are there, like we are passing through the result season and we are in the fag end of the result season. Many mid-cap companies are going to announce the result. Today is a Sensex expiry and monthly expiry is also due. So a lot of event, and Nifty seems to have stuck in the range of 24,500 to 25,100. See, on 15th May, Nifty hit this high of 25,116. That is not being taken out. So we can say that we are basically into a choppy market, zigzag kind of market, and because of the events which are there, I think 25,116 should be the trigger level above which we can see the bullish momentum coming back to the markets. But primary trend of the market is clearly bullish, as Nifty is trading well above the key moving averages. So overall trend is bullish, but short-term trend is consolidation. About 25,116, we may see a good extension of the up move, and that could be up to 25,500 also. So we are advising our traders to hold the long position with a stop loss of 24,500.
Short-term pressure on the markets. In fact, consolidation is the word that Vinay has used, and overall long-term market view is positive. But let's also pull up the India VIX and see where it is right now, because it's trading at around that 18.7 odd levels. It did go to around 19.3, 19.4 odd levels and cooled off since then, and that indicates the kind of volatility in markets right now. We also have an update coming in from Electra that is clarified on contract cancellation. They've said that SPV has not received any communication regarding the contract cancellation from MSRTC. Now we'll have to wait and watch as to how this entire thing pans out, because if I'm not wrong, we had a tweet from the government saying that the order has been cancelled. But
there were news reports as well that talked about it. So let's wait. In fact, Puneet pointed out that there's going to be a conference call to talk about the earnings of the company in just a short while. That is, in fact, tomorrow post-market. So perhaps till then, we'll have to wait and see if there's going to be clarification on that. Now, speaking of the automotive space, and let's talk about auto ancillary companies. Tire companies have been in focus recently, not least of which because of their earnings, but also because of increased competition. There's going to be a change in the way that Balkrishna Industries operates. It is primarily an offload tire, but it's getting into the radial space. And beyond that, of course, the question is, with rubber prices easing, should you bet on an improved FY26 for tire companies? Puneet has this report.
Let's look at FY25 as a year first, because that was one of the most crucial years. Natural rubber prices had increased, margins had contracted, and demand was faltering. That is the three key highlights for the sector. But when you look at the numbers as well, for Balkrishna Industries, the numbers have been very stupendous. That's the only company which has actually shown margin growth. First, let's start with the revenue. 13% revenue growth for the company. That's the highest across the sector. 25% margins for the company, which was a 50 basis point expansion. The only company in the tire space to actually show expansions in margins, and subsequently the profit was also up 13%. For the rest, as visible, there was, while revenue growth was there for the likes of MRF as well as CEAT, there was contractions in margins as well. And it's important to note that this is actually growth in revenue as well as growth in profits, while we've given margins in the center as well. When you look at something like an Apollo and JK Tires, it was a tough year, because for Apollo, the company was dealing with company-specific issues of what's happening in Europe, as well as getting out of low-margin businesses, and hence just a 2.9% growth in terms of revenue. There was a larger hit on margins as well, and in the Q4, the company also did a little bit of reintegration in terms of their operations in Europe as well, and that's reflective in the margins. Subsequently, profits were also down for both these companies. For JK Tires, they are a weaker player amongst the 5 listed companies, and hence that's visible in numbers as well. Let's now look at the key guidance, and here's where the differentiation is, because there's positive commentary across the 5 players this time. Balkrishna, while they refrain to give any guidance, they are expecting high single-digit growth. That's what they mentioned. For something like an MRF, they are expecting market share gains in both the two-wheelers as well as the truck and bus radial segment in this year. And this wasn't mentioned in any of these conference calls last time. So it's a positive outlook for MRF. When you look at something like a CEAT, they are anticipating positive growth that will be led by Europe. And for Apollo as well as JK Tires, for Apollo specifically, they are expecting growth in OEM business, which is for the car makers specifically, as well as the two-wheeler makers, as well as exports to largely return, which is a high margin business compared to the domestic market. For JK Tires as well, they've guided for a double-digit revenue growth. Finally, the key aspect on natural rubber prices, we did see the natural rubber prices hover between 190 to 200 rupees in Q4. This was largely between 150 to 160 rupees per kg, roughly between 4 to 5 quarters. But now they've started to subside again starting from Q4 as well as in Q1 of FY26. Currently, the international rubber prices are also trading at a discount of 7 to 8 rupees to the Indian natural rubber prices as well. That's another key monitorable going forward. Brokerage consensus that's largely built in for something like an MRF. There is a large number of hold calls, and that's largely because it is a market leader and growth was absent. That could be one key monitorable. For Balkrishna as well, the sell calls have increased because of valuation concerns, and this was what we saw yesterday as well, a couple of downgrades coming in. For CEAT as well as Apollo, we've seen the largest number of buy calls of 16 as well as 18. And finally, for JK Tires as well, we've seen limited brokerage coverage for this one, but both MK as well as DAM Capital having a buy call on the stock. And finally, in terms of valuation to end this discussion, currently FY26 price to earnings ratio, there's a clear visibility of your choices across the board. Take your pick accordingly, because the growth is where the aspect is. For Balkrishna as well as MRF, growth has been stagnant consistently, even in weaker times, and that could be one of the key reasons. But MRF is one of the most premium players, at least, as well as the highest growth players and the market leader. But for Balkrishna, at 25% margins compared to 15% for the rest of the peers, there is where the valuation differential lies. And for JK Tires as well, it's coming to a very at an inflection point now, anticipating growth in FY26 for CEAT. The acquisition of Camso done in the last year will now get them into off-highway tire segments, something that's very positive for BKT. So overall, there is choices available in this market, and we might be bottoming out in terms of commodity prices. So outlook for FY26 is upward and onwards.
Got it. All right. So the outlook is looking good. Thanks, Puneet, for that. Raghavendra, a question specifically on Balkrishna Industries. It's traditionally known as an export player that is in the off-road space, and that has contributed to the margins being significantly higher than its peers. But if it is now moving to have a larger presence in domestic tire manufacturing and sale, is that going to be dilutive for the margins going forward? What are the implications, and would this be your top pick in the tire space or not?
So, Alex, I'll take the easy portion first. In terms of would it be my top pick? Yes, Balakrishna Industries continue to be our top pick in the tire space. The margins have been in the double digits, or they have indicated in terms of higher single digit growth. So that is comforting to us in terms of specific to how they have in the OHT business. Their global share remains at around 8%, and that should continue on an as-is basis. So that is impressive. And as far as the company promises and delivers the margin around 9 to 11%, so broadly 10% plus minus 1, with their expansion in the domestic business, we should be, as an investor, okay with that. The price correction gives an opportunity to buy. If you see, this stock has a fantastic history, and I think which continues to deliver in terms of price performance, which has a stock price appreciation CAGR of around 20% plus from on a 10-year deep investment horizon. So Balkrishna Industries has been a wealth creator, if you go back, and a fabulous price performance. And this correction to levels of around 24.50, we believe it's a great entry opportunity for the company. In the investor presentation, specifically, Alex, they have mentioned a revenue growth of 2.2x by 2030. So in the next 5 years, they have given a forecast of revenue going up by 2.2 times, which is very comforting. And the management has a track record of going for they do like a walk the talk basis. So we believe that this is achievable in terms of revenue, maintaining the margins. Balkrishna Industries remains our top pick in the entire tire space.
Okay, so that's the view with regards to where Balkrishna Industries and the entire tire pack stands. Info Edge earnings have come out. Revenue is up almost 14% for the counter. Margins have improved. The EBITDA is also up 13%. Net profit has significantly gone up. I'm guessing that there's a one-off here, because that's at 463 crores versus that of 60 odd crores. I'm pulling up the earnings. Let's pull up the stock and see what it's doing in trade today. It's down by about 1.2 odd percent, and this downtick has been seen in the last few minutes itself. The margins are not very good. They've come at 33.1 versus that of 33.4. In terms of the overall numbers also, revenue has seen a good uptick, but just trying to figure out as to why profit has seen such a significant amount of growth. There you go. There's expenses. We've seen overall employee benefit expenses go up. Finance costs have significantly come down, which has aided the EBITDA. There's advertisement and promotion costs which has gone up. We are seeing an overall, there is no exceptional cost. Okay, we do have an exceptional cost. So in 2024, there was an exceptional loss of around 161 crore versus that of an exceptional gain of 25 odd crores this particular quarter, which is why we are seeing that significant spike when it comes to the net profit number. So that's with regards to where Info Edge stands. The stock not seeing much action in trade, down by about 1%. But with that, we're completely out of time on this edition of Profit Buzzers, but more on the other side. So do stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit. The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Varsha. Well, Varsha, it has been quite a volatile trading session. At one point of time, we were below the 24,750 level. Then we crossed 24,000, in fact 25,000 level, and now we are hovering around the 24,800 levels.
Exactly, and you know that's like the markets, or rather I would say Nifty 50 is actually under pressure. It's down almost 0.7%. Let's see, you know, who are the losers. When it comes to benchmark indices, you have Ultratech, you have ITC, NTPC and M&M on the losing side, while on the gaining side though you have IndusInd Bank, you have Trent, you have Geo Financial, you have Asian Paints when it comes to on the gaining side on Nifty 50. Well, let's see sectorial heat map. Let's see which are the sectors which are buzzing in trade today. I think Nifty Media, Nifty Pharma and Realty are in green, and except these three, everything is in red. So Nifty Realty is up almost 0.37%, followed by Nifty Media and Pharma. While if you see Nifty Auto is down 0.7%, Bank is down 0.3%, Nifty FMCG though is down 0.9%. Let's see what broader markets are doing in trade today. Let's see Nifty Midcap 150. Let's pick up that. It's actually not mirroring. It's in green. It's up 0.07%. On the gainer side, you have buyers, crop science, of course, buzzing on the back of very good numbers. You have Adani Wilmar, you have GSK Pharma, Hitachi Energy, who are buzzing when it comes to Nifty Midcap 150. On the loser side, though, you have GIC, you have Sundaram Finance, UBL, BSC, which are on the losing end. Nifty small cap 250. Let's pull up that. Let's see what that counter is doing. It should be in green. Of course, small cap is up 0.11%. Now ITI, CCL products, Credit Access are on the gainer side when it comes to Nifty small cap 250. While on the loser side, you have Electra green. Actually, this is because of the order loss that the company has seen. You have Blue Dart, you have Action Construction and Webhub Global, which are on the losing side when it comes to Nifty small cap 250. So Soumit, when it comes to broader markets, few stocks are buzzing on the back of earnings.
Well, yes, multiple stocks have been buzzing, but one stock that we need to watch out for is Adani Power, and there's a positive news development that has come in, and that is the fact that Supreme Court has affirmed the APTEL's order in favor of Adani Port's entitlement for the compensation that they had claimed from Jaipur Vidyut Vitram Nigam. Now, Supreme Court has dismissed the appeal that Jaipur Vidyut Nigam had earlier filed. Now, this case is the Supreme Court was of the view that power generators are entitled to claim compensation and late payment surcharge based carrying cost under the power purchase agreement for any cost escalation that they have seen on the back of regulatory changes. Now, the bench of Justices M.M. Sundaresh and Rajesh Bindal heard the case regarding this dispute between the power purchase agreement between Adani Power and Jaipur Vidyut Vitram Limited and Adani Power Rajasthan Limited on supply of the 1200 megawatt of power that was at a fixed tariff. Now, given the fact that this agreement was at a fixed tariff and Adani Power was claiming some compensation, Jaipur Vidyut Nigam had gone to APTEL for this dispute that was there, but given the fact that APTEL had given decision in favor of Adani Power, Jaipur Vidyut Nigam had further made an appeal to Supreme Court, which was now dismissed by the Supreme Court and has been given in favor of Adani Power. So Adani Power had sought compensation from Jaipur Vidyut Nigam under the power purchase agreement under the change in law clause. Now, as per this change in law clause, if there is any regulatory changes which results into higher charges or higher cost for any power generator, then they can claim these extra costs from the state government. That is what the clause says. Now, because of this clause, Coal India had in fact increased the coal charges by around 50 rupees per ton, and because of this increase in coal charges, Adani Power also had to bear some additional charges, and that additional charges was something that Adani Power Rajasthan was claiming from Jaipur Vidyut Nigam. So in all, this decision has come in favor of Adani Power, and Supreme Court has also dismissed the appeal that was filed by Jaipur Vidyut Nigam at this moment. Well, that's a positive news coming in. Let's also welcome in our guest Sneha Poddar, Vice President with Motilal Oswal. Sneha, firstly coming to you on the overall market, it has been quite a volatile session. We have seen market Nifty going below the 24,750 level, then again reclaiming 25,000 and then again at 24,800. Is this all because of expiry? What's your view here?
Very good afternoon. Some attribute can be, the volatility can be attributed somewhat to expiry, but then there are other events as well which is triggering the volatility in the market. So with the Trump again, first announcing 50% tariffs on trades with EU, and then again on the later saying that he's pushing it away by another by about 30 days. So that it provides more room for the negotiation. So this this lopsiding from one end to another end from the Trump's end is keeping the market a little volatile. So it's and the earnings are also this is the last leg of the earnings season. So all these factors are keeping markets volatile, and it was expected that the market will trade in a broad range. It will continue to oscillate, and that's what we are witnessing it.
Right. Thank you for that view, Sneha. Well, next stock which is in focus is Bayer Crop. Let's see what that counter is doing. The stock was up 10%, very good, 12%. Now, this is on the back of strong earnings that the company has seen. Let's see the key highlights of Q4 numbers. The revenue growth that you're seeing is led by strong performance in spring corn and crop protection portfolio. Now, the EBITDA margin expansion. So, EBITDA margin expanded from 12% to 16%. Now, this is on the this was led by lower employee costs and of course the operating leverage that the company has been enjoying. So, just to say, employee cost was 16% to revenue versus 11% to revenue this year. So, last year it was 16% to revenue versus 11%. Now, the promotional investments made by the company in the previous quarter has also helped or rather generated significant returns for the company, and the other income has also aided net profit, because if you see revenue is up 32% while net profit is up 49%. So, one of the reasons is good EBITDA, and also the other reason is other income that has fueled this net profit, I mean to say. Sneha, coming to you on the Bayer's Crop, how are you seeing these numbers? Good numbers. Should investors buy, or what is your view when it comes to overall fundamental analysis of this company, and of course about the sector as well?
Okay, so unfortunately, we do not have this stock under coverage, but very broadly that I've looked at the numbers seems to be quite good. And in general, if you look at so all these agri-related stocks, they are doing well. And the reason is that the Rabi crop was good and the Kharif crop, the season is expected to be good. So with monsoon, which came in 1 week advance, so this is a very positive overall in terms of sentiment for these stocks. So basically, all the fertilizer stocks, they have been performing well because of the good monsoon that is expected, and even the Q4 numbers were quite good across the sector, and the outlook continues to be strong. So our view is we are continuously pushing these stocks to our clients because the outlook looks quite promising to us.
Okay, thank you so much for that view. The next two stocks, which are in focus is Bajaj Healthcare. Let's see what that stock is doing. The stock was down almost 6% in trade today. Now this is on the back of weak numbers. Rather, if you see the revenue, there was a revenue growth. Revenue growth was almost 15%, but EBITDA is what has disappointed the street. So if you see, EBITDA was down 27%, margins were down 446 basis point at 7% versus 12% last year. Net profit was at 11 crore versus loss of 29 crore last year. Now higher employee cost has led to actually the suppressed in EBITDA margins, number one. And the next stock is India Pesticides. Good numbers. If you see, the stock is up almost 12%, at least last time I saw the stock is up 12%. Now this is on the back of good numbers. Now revenue was up 64%, EBITDA was up 8.8x, margins were at 15% versus 2% last year, and net profit was at 21 crore versus 1 crore last year. Now EBITDA margin expansion that you're seeing because of the operating leverage that the company has enjoyed, and of course lower employee costs. Now Sneha, so you don't track Bayer crop, but any other picks that you have? Because why I'm asking this is because India Pesticides is also into that sector. So is India Pesticides the one that you are tracking, and also your view on Bajaj Healthcare?
Okay. So unfortunately, we do not track India Pesticides as well, but so broadly we do overview. We keep these stocks under our radar, and in general, if you look at these companies, they have over last 2 quarters, the earnings have started improving for these companies, and the outlook which is coming out is even much brighter. So this time the monsoon is expected to be good, and thus the Kharif season is expected to be good for majority companies. So obviously these pesticide companies will do well. So overall, what we're expecting that the H1 should be good for for the entire sector, and keeping that in mind, one can actually trade on this sector from a medium term perspective. Now in case of Bajaj Healthcare, the number were disappointing. Anyways, we are really not very positive on Bajaj Healthcare, and in general also, if you look, their numbers has always been. There's a lot of volatility in their numbers. There's no as such consistency quarter after quarter. So we in general try to avoid such stocks, and thus my view would be to treat such stocks with a trading perspective.
Right. Another sector that remains in focus is cement, and the cement sector has been under pressure for the last couple of sessions, and this is post INCRED has come out with this note where they're saying that the monsoon onset, that early monsoon onset has stalled cement price rise, specifically in South India. Now they're saying, in fact, their dealer check is suggesting that dealers have started to offer discounts from their own margins to boost sales volume, and this is owing to a combination of factors. Firstly, it is a subdued monsoon, and second is the early onset of rains, which could further put pressure on demand offtake going forward. Now this has also raised concerns about the potential losses to the inventory that not only dealers will have, but also companies could have going going forward. Now, as per their dealer checks in Karnataka, dealers have already taken or have already started to offer discounts of around 10 rupees per bag. And when it comes to Andhra Pradesh and Telangana, dealers are reported to offer discounts in the range of anywhere between 10 rupees to 20 rupees per bag. Now, any form of discount that is being introduced is directly related to price reduction, and this could mean that going forward, price correction could happen at least in the southern India and then on pan-India basis, given the fact that monsoon season has already started. And few companies that we need to focus here on the back of, given the fact that these companies have significant exposure to South market currently. Firstly, it's Ramco Cement, Dalmia Bharat and Ultratech, because they have significant exposure via the acquisition that they have done of India Cement towards South India. Sneha, coming to you on this price discounts that are being offered when it comes to cement bags. How are you looking at the overall cement sector, and how much of an impact do you see that could happen given the fact that now monsoon has already started, construction activities might get stalled now going forward?
Okay, so see, the price hikes were really critical for the sector, because overall, if we look at the cement demand, so because of the the lower government spending and the weak demand from the individual housing, I mean, the demand per se is quite weak. Plus, the overall sector is facing some labor-related issues in few regions, and now with the monsoon onsetting a week in advance, so the price hikes were very critical. But now it seems that if the companies are not able to sustain the price hikes, then probably the profitability will take a hit for the company. In general, going ahead, we were anyways expecting the demand growth to be in low single digit only, and we were banging on the that the price hikes will sustain from here onwards. So now it has to be really seen how it really plays out, because anyways in the near term, in H1, the cement stocks are likely to consolidate, because normally they don't participate well when the monsoon season is ongoing. It's largely in the H2 when the execution picks up and the cement demands picks up, that we see such stocks participating. So at least now with the monsoon onsetting a week in advance, it's pretty much clear that from the near to medium term perspective, the entire sector might remain under pressure.
Thank you for that view. Well, other stock which is in focus is Balrampur Chini. Now, the company has launched Balrampur BioYug, and we caught up with the executive director Avantika Sarogi of Balrampur Chini Mills, who said that BioYug is the new era which will signify biocircularity, and the revenue is expected to rise up to rupees 2,000 crore from their PLA unit in Uttar Pradesh. Do listen in.
I first wanted to understand what is BioYug, and what is the whole motive and the objective behind it. If you could just throw some light on that for us.
So thank you so much for having me. BioYug is a concept and now becoming a reality which is very close to my heart. So the word BioYug is derived from two words, bio, which signifies not just sustainability, bio-based, but also our strong commitment and relationship with our farmers who have always been at the heart of Balrampur. And Yug is a Sanskrit word, it's a Hindi word which signifies an era. So for us, BioYug is a new era that signifies biocircularity. What does that mean? Kind of heavy as a word. So we believe that if we're able to reduce the usage of fossil-based resources, be it from materials to fuels to plastic, and make them all bio, then the carbon which is getting added into the atmosphere, which we are now terming in as climate change, as GHG additions, this and that, this can reduce dramatically. And in fact, if you don't add the carbon by pumping it out from below the Earth's crust, then how would it be added? It would just be a recirculation of biocarbons in the atmosphere, and then we could largely save the planet from the climate impact that we are facing now. So that's what BioYug signifies for us.
Well, this was about Balrampur Chini's capacity expansion, but Max Financial stock is in focus after CLSA upgrades to high conviction outperform. My colleague Harsh joins in with more details.
Well, it is an upgrade that CLSA has made from outperform to high conviction outperform, 1800 being the target price from the 1420 price which it had given earlier. In terms of why they like it, one is they like the life insurance space in general, and within that, this is the top pick within that life insurance pack. They believe that Axis Max has been India's fastest growing life insurer. They're expecting the agency channel to kick in and start contributing significantly going forward. They also believe that the holdco discount is also what's weighing down the stock, and once removed, that holdco discount could play out well with regard to how the stock price performance ought to play out. Therefore, a very strong upside from 1800 being the target price.
Thank you so much, Harsh, for all the details. Well, Sneha, what is your view when it comes to Max Financial?
Okay, so our view is neutral on the stock. I agree with Harsh that the overall Max Financial is doing well, and if you look at the Q4 numbers, it was very solid set of numbers that they gave out, and overall the growth momentum looks quite good for them. However, we are actually awaiting the clarity on the reverse merger post the Insurance Act amendment, and we believe that that would be critical for its re-rating. So until then, we get that clarity. We continue to maintain our neutral stance on the stock, given the current the valuation and the overall regulatory overhang.
Yeah, for that view. Well, shifting our focus to chemical sector. Now, Jefferies has come out with a note on chemical space forecasting flat demand. Now, what they're saying is that innovator companies, the big pharma companies are expecting flat revenue growth for calendar year 2025 despite a low base from 2024. Now, because China is aggressively exporting agrochemicals with volumes up, and export prices are hitting 9-year lows, increasing competition for Indian players. Now, also for stock specific, Jefferies is actually more, I would say, the preferred pick, one of the preferred picks for Jefferies is Navin Fluorine. Now, why? Because they're considering it as a better placed, because new product startups in both agrochemicals and CDMO from Q4 FY25 onwards provide strong earnings growth visibility, and Jefferies projects a strong 35% EPS CAGR for company from FY25 to 27 despite the challenging demand environment. PI Industries is the next preferred pick now because of the new commercialized products, and the biologics segment is also showing robust growth when it comes to PI. So and PI Industry, according to Jefferies, is at attractive entry point because of the recent temporary weakness in the stock makes it attractive buy opportunity according to Jefferies. While for SRF, they have maintained underperform because of the high valuation that the company has, and Jefferies is skeptical when it comes to sharp decline recovery. Now, Sneha, overall, so you have Navin Fluorine, which came out with a very good numbers on the back of CDMO business. PI Industries is expecting a single to mid digit growth when it comes to FY26. So what are your picks when it comes to PI Industries, Navin Fluorine or SRF?
Okay, so our preferred pick is SRF because, if you look at the SRF numbers, it was a very strong set of numbers that they had, reported. And if you look at, it was, half of the contribution, the strong growth that we witnessed, it came because of the chemical segment. So despite, the overall macro challenges that the chemical sector is facing, SRF actually showed resilience, and this has been going on over last few quarters that we've seen that SRF has been continuously able to deliver strong numbers. So and especially the specialty chemical business is doing very well, and that is because they're continuously launching new products, and the agrochemical in case of agrochemical they are witnessing a very strong demand. So these two factors are supporting the growth. Even the fluorochemical segment is now actually started witnessing higher volumes, which was which is a new niche segment for them. So keeping all this in mind and keeping the SRF, the management focus on the continuously trying to increase the proportion of the value added products. So these are actually making us very bullish on the stock, and thus this actually stands out as a one of the topics in the sector.
Right, moving on. If you're tired of this volatile market, let's get in Puneet to give us more details on why tire stocks might be an interesting bet or will not be an interesting bet in such volatility in the markets. Puneet, over to you.
Let's look at FY25 as a year first, because that was one of the most crucial years. Natural rubber prices had increased, margins had contracted, and demand was faltering. That is the three key highlights for the sector. But when you look at the numbers as well, for Balkrishna Industries, the numbers have been very stupendous. That's the only company which has actually shown margin growth. First, let's start with the revenue. 13% revenue growth for the company. That's the highest across the sector. 25% margins for the company, which was a 50 basis point expansion. The only company in the tire space to actually show expansions in margins, and subsequently the profit was also up 13%. For the rest, as visible, there was, while revenue growth was there for the likes of MRF as well as CAT, there was contractions in margins as well. And it's important to note that this is actually growth in revenue as well as growth in profits, while we've given margins in the center as well. When you look at something like an Apollo and JK Tires, it was a tough year, because for Apollo, the company was dealing with company-specific issues of what's happening in Europe, as well as getting out of low-margin businesses, and hence just a 2.9% growth in terms of revenue. There was a larger hit on margins as well, and in the Q4, the company also did a little bit of reintegration in terms of their operations in Europe as well, and that's reflective in the margins. Subsequently, profits were also down for both these companies. For JK Tires, they are a weaker player amongst the 5 listed companies, and hence that's visible in numbers as well. Let's now look at the key guidance, and here's where the differentiation is, because there's positive commentary across the 5 players this time. Balkrishna, while they refrain to give any guidance, they are expecting high single-digit growth. That's what they mentioned. For something like an MRF, they are expecting market share gains in both the two-wheelers as well as the truck and bus radial segment in this year. And this wasn't mentioned in any of these conference calls last time. So it's a positive outlook for MRF. When you look at something like a CAT, they are anticipating positive growth that will be led by Europe. And for Apollo as well as JK Tires, for Apollo specifically, they are expecting growth in OEM business, which is for the car makers specifically, as well as the two-wheeler makers, as well as exports to largely return, which is a high margin business compared to the domestic market. For JK Tires as well, they've guided for a double-digit revenue growth. Finally, the key aspect on natural rubber prices, we did see the natural rubber prices hover between 190 to 200 rupees in Q4. This was largely between 150 to 160 rupees per kg, roughly between 4 to 5 quarters. But now they've started to subside again starting from Q4 as well as in Q1 of FY26. Currently, the international rubber prices are also trading at a discount of 7 to 8 rupees to the Indian natural rubber prices as well. That's another key monitorable going forward. Brokerage consensus that's largely built in for something like an MRF. There is a large number of hold calls, and that's largely because it is a market leader and growth was absent. That could be one key monitorable. For Balkrishna as well, the sell calls have increased because of valuation concerns, and this was what we saw yesterday as well, a couple of downgrades coming in. For CAT as well as Apollo, we've seen the largest number of buy calls of 16 as well as 18. And finally, for JK Tires as well, we've seen limited brokerage coverage for this one, but both MK as well as DAM Capital having a buy call on the stock. And finally, in terms of valuation to end this discussion, currently FY26 price to earnings ratio, there's a clear visibility of your choices across the board. Take your pick accordingly, because the growth is where the aspect is. For Balkrishna as well as MRF, growth has been stagnant consistently, even in weaker times, and that could be one of the key reasons. But MRF is one of the most premium players, at least, as well as the highest growth players and the market leader. But for Balkrishna, at 25% margins compared to 15% for the rest of the peers, there is where the valuation differential lies. And for JK Tires as well, it's coming to a very at an inflection point now, anticipating growth in FY26 for CEAT. Their acquisition of Camzo done in the last year will now get them into off-highway tire segment, something that's very positive for BKT. So overall, there is choices available in this market, and we might be bottoming out in terms of commodity prices. So outlook for FY26 is upward and onwards.
Well, thank you, Puneet, for all the details. But viewers, this is all the time that we have on this edition of Profit Top Trade. Stay tuned to NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold
CDSL
for the long term? Buy, sell or hold?
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Olectra Greentech is actually in the dock at this point of time. The share price has taken a significant amount of beating after the Maharashtra government announced that it's going to terminate its agreement with Olectra Greentech for the supply of about 5,150 electric buses. This deal was signed 2 years ago, but only 220 electric buses have been delivered so far. To talk to us about this actually evolving situation, we have with us Maharashtra Transport Minister, Mr. Pratap Sarnaik. Sarnaik ji, welcome to NDTV Profit, sir.
5,150 आपने जो डिटेल मालूमात दी है वो सही है कि जनवरी 2024 में उनके साथ हमारा एग्रीमेंट हो गया था और अब तक करीबन 2 से 2,500 बसेस आनी चाहिए थे और उस माध्यम से हमने तैयारी की थी कि वो अगर बसेस आएंगे तो हम लोगों को उतनी सर्विस दे सकेंगे, मगर उसकी वजह से हमारा पूरा का पूरा जो प्लान था वो कोलैप्स हो गया क्योंकि 220 बसेस खाली उनकी आई है और बाकी की बसेस के लिए हमने 2 बार उनको लेटर भी दिया, फिर भी अभी तक बसेस आई नहीं है। मई एंड में उनके करीबन 1,250 से 1,300 बसेस आने की उम्मीद हमें थी, मगर वो भी एक भी बस उसमें से आई नहीं है। तो आखिर कितने दिन महाराष्ट्र शासन भी उनकी इंतजार करते रहेंगे कि आज नहीं तो कल वो बसेस देंगे। इसलिए हमने कल डिसाइड कर दिया कि हम ऑफिशियल अभी लीगल एडवाइजर के पास फाइल भेज रहे कि उनका जो एग्रीमेंट है वो अगर कैंसिल करते हैं तो कोई कानूनी कार्रवाई हो सकती है क्या, क्योंकि अगर उनका एग्रीमेंट कैंसिल करके हमें किसी ना किसी के पास से बसेस तो लेनी ही पड़ेगी, क्योंकि हमको लोगों को सर्विस देनी है। ऐसे नहीं है कि उनकी बसेस खराब है, उन्होंने चार्जिंग स्टेशन जो है उसके लिए महाराष्ट्र गवर्नमेंट में 600 करोड़ रुपए खर्चा भी किए कि 5000 बसेस आने के बाद चार्जिंग स्टेशन लगेंगे, उसकी सब सुविधाएं हम लोग ने बना के रखी थी। मगर अभी ज्यादा दिन एक कॉन्ट्रैक्टर के लिए हम लोग रुक नहीं सकते, उनको लास्ट हम अभी ऑफिशियल नोटिस भी भेज देंगे, लीगल एडवाइजर जो हमारे हैं उनका सलाह लेके, तो जल्द ही उनका जो एग्रीमेंट है वो हम कैंसिल करने की कोशिश करें।
क्योंकि ओलेक्ट्रा ने सर अभी एक एक्सचेंज फाइलिंग की है जिसमें उन्होंने बताया कि एमएसआरटीसी से उन्हें कोई कम्युनिकेशन या फिर कोई नोटिस अभी तक आया नहीं है, तो ये कंपनी कब तक एक्सपेक्ट कर सकती है कि कोई उन्हें ऑफिशियल नोटिस से कम्युनिकेशन मिल जाए?
ऑफिशियल नोटिस उनको 3 बार गई है, हमारे प्रिंसिपल सेक्रेटरी संजय सेठी उन्होंने ऑफिशियल उनको नोटिस दी है और मई एंड तक की जिम्मेदारी उनको ही दी थी। इवन राज्य के मुख्यमंत्री जी ने कंपनी को कहा था कि अगर आप बसेस टाइम पे नहीं देंगे तो हमको आपका एग्रीमेंट कैंसिल करना पड़ेगा। तो ये ऐसे कुछ नहीं है, ऑफिशियल हम जो भी नोटिस या जो कार्रवाई करनी है वो हम कर ही रहे हैं। और देखिए हमें तो बसेस चाहिए, उनकी जिम्मेदारी बनती है। अभी वो कह रहे नोटिस नहीं है तो हमारा क्या नोटिस का इंतजार कर रहे हो? अभी आज 15 से 16 महीने हो गए उनके साथ एग्रीमेंट करने के बाद, अब तक हमारे पास उनकी 2500 से 3000 बसेस आनी चाहिए थे, वो तो लंबी की बात है, सिर्फ 220 बसेस आई। फिर भी हमने नोटिस में हमारे जो प्रिंसिपल सेक्रेटरी उन्होंने कहा था कि चलो आपको और हम मोहलत देते हैं कि आप प्रोडक्शन अगर आपके कंपनी का कम होगा तो हम 1250 से 1300 बसेस तो आपको देना ही पड़ेगा मई एंड तक, मगर वो भी नहीं दे पा रहे। अगर आपके पास प्रोडक्शन नहीं है, आप अगर बसेस बना ही नहीं रहे तो आपने काम क्यों लिया स्टेट गवर्नमेंट का? क्योंकि देखिए आपका तो बिजनेस हो रहा है, मगर भुगतान तो हमारी जो जनता है, प्रवासी है, उनको तकलीफ हो रही है। क्योंकि हमने आपके साथ एग्रीमेंट किया इसलिए हम दूसरी कंपनी से बसेस नहीं लिया, उसके ऊपर डिपेंड हम लोग अभी भी है। तो आपका एग्रीमेंट कैंसिल करके हमको दूसरा कोई डिस्ट्रीब्यूटर या कोई हमें देखना ही पड़ेगा ताकि उसके माध्यम से हम बसेस ले पाए।
तो सर आपने किसी और कंपनी से भी बातचीत शुरू की है या फिर अभी कुछ टाइम बाद?
तो देखिए ये एग्रीमेंट जब तक कैंसिल नहीं होता है, जब तक इसके ऊपर पूरा खत्म, ये जो उनका और हमारा एग्रीमेंट है वो खत्म नहीं होता है, हम दूसरे कंपनी से बात में नहीं करेंगे और ना ही कर सकते। हमारे पास प्रपोजल तो बहुत सारे कंपनियों के आए, मगर कैसे है कि इलेक्ट्रिक बसेस की जो प्रोडक्शन है वो भी बहुत कम है इंडिया में, और कहीं पे भी हमें जो मालूमात हो गई है कहीं पे भी इलेक्ट्रिक बसेस जितनी चाहिए उतनी पहुंच नहीं रही है। कुछ पुणे के हमारे पास लोग आए, कुछ हैदराबाद के लोग आए, अलग अलग स्टेट्स के लोग हमारे पास आते हैं और हमारी बसेस प्रोडक्शन हम कर सकते हैं, हमें ऑर्डर दीजिए ऐसे कहते हैं। मगर जब तक इनके साथ एग्रीमेंट जो है वो कैंसिल नहीं होता तब तक हम दूसरे से बात नहीं कर सकते।
सर आपने रिसेंटली महाराष्ट्र ईवी पॉलिसी भी नोटिफाई किया, उसके बारे में हमें कुछ बता सकते हैं, आगे प्रोग्रेस किस तरह होगा?
देखिए हम ये चाहते हैं और राज्य के मुख्यमंत्री आदरणीय देवेंद्र फडणवीस साहब और अजीत दादा पवार और एकनाथ शिंदे जो हमारे पार्टी के चीफ है वो यही चाहते हैं कि राज्य में ईवी पॉलिसी बहुत बड़े पैमाने पे हम ले आना चाहते हैं। और आगे भविष्य में 10 साल के बाद में हम तो कम से कम ये सोच रहे हैं कि राज्य शासन की जितनी भी गाड़ियां हैं वो पूरी की पूरी ईवी हो, इलेक्ट्रिक वो हो, ताकि जैसे हमारी ट्रांसपोर्ट डिपार्टमेंट के सभी बसेस इलेक्ट्रिक ईवी हो, साथ में हमारी जो मंत्रियों की गाड़ी से लेकर हमारी जो बाकी के जो स्टाफ है उनकी गाड़ियां भी ईवी की हो। तो इसी तरह से हम पर्यावरण पूरक वातावरण पूरे महाराष्ट्र में बनाना चाहते हैं, जैसे कि सेंट्रल मिनिस्ट्री का वो धोरण है। और उस माध्यम से हम देखिए अटल सेतु में हमने फ्री कर दिया, हमने समृद्धि में फ्री कर दिया। हम तो ये चाहते हैं कि राज्य के जितने भी टोल नाके हैं वो इलेक्ट्रिक वाहन के लिए फ्री किया जाए। हम 10 से लेके 20% उनको अनुदान दे रहे हैं ताकि बसेस हो, ट्रक्स हो या 4 व्हीलर कार हो या 2 व्हीलर बाइक हो, हम हर चीजों के ऊपर, हर वाहन के ऊपर बहुत सारी सुविधाएं दे रहे हैं ताकि लोग उससे आकर्षित हो और पर्यावरण पूरक कार लें।
थैंक यू सरनायक जी, थैंक यू हमसे बात करने के लिए। दैट वाज ट्रांसपोर्ट मिनिस्टर प्रताप सरनायक टॉकिंग अबाउट द स्टेटस ऑफ द ओलेक्ट्रा ग्रीन टेक डील। अकॉर्डिंग टू हिम द डील इज कैंसल्ड, ओनली द पेपर वर्क इज लेफ्ट।
Okay, thank you so much for that, Tushar, of course, getting us those exclusive details and very interesting ones as well, to say that Olectra Green Tech, outside of actually just been given a notice of cancellation, this order largely stands cancelled. They are, of course, taking legal advice, which is Government of Maharashtra is taking legal advice to cancel this order because less than 300 buses received out of the 2,500 or 2,000 to 2,500 odd buses which ought to have been delivered, Neeraj. Also, what they seem to be suggesting, or what the Maharashtra Transport Minister seemed to be suggesting for viewer context, is also the fact that they are taking advice, legal advice, and they will likely ensure that this order is cancelled. Are they looking at other players to award this order to? Not yet. Not till this order is cancelled. Once this order is cancelled, they will thereafter look at other players. So there is a large void in the system, especially in Maharashtra with regard to public transport, and that void is expected to remain. Due to this, you can see the reaction on the Olectra green stock, which has come out and clarified that there is absolutely no notice that they have received. Puneet here with giving us the full story with regard to Olectra to kind of round up that perspective on what the Maharashtra Transport Minister has also said. Puneet.
Well, thank you for that, Harsh, and definitely the introduction, as you rightly mentioned, 5,150 buses is the award that's been cancelled by the Maharashtra government. There are three key aspects also that I want to highlight for Olectra Green Tech. This is 50% of the company's current order book of roughly 10,200 buses. So it's a huge cancellation that's come in. This order was given to the company in July of 2023, and I think my colleague Tushar might have asked those questions as well. Over the essentially the next 2 years until May of 2025, none of the very small number of those buses have come in. What's also interesting is that they had revised the order. It was estimated that they'll at least deliver 1,000 buses by May 22nd of 2025. And none of that has also been completed, and hence the cancellation coming through now. I also just want to highlight that they have as of now not made any notice currently on the exchanges, so that will be something to watch out for at this point of time. When you look at the other key aspects, that each bus has a contract cost of roughly 1.75 crore according to company, which is mentioned in the Q3 conference call. Just taking a simple multiplication with roughly 5,000 buses, that gets the order value to 9,000 crores, which the company has now lost. Currently, I also want to highlight that in this aspect, the cumulative orders, of course, include these 10,000 buses. But in terms of production also, that is the second key question. The company only has a production capacity of 1,200 vehicles annually. So even to complete these 10,000 orders, the company would actually have to complete them over the next 8 years. It will take them that amount of time to complete those orders as well. And this is again another key, staggering fact. They've only sold roughly around 500 vehicles over the last 2 years per annum at a time where their order book was 10,000 crores. And it doesn't seem they've invested enough to make a manufacturing capacity enough to even sell those orders back to the Maharashtrian government, as mentioned. Current capacity also, it's hovering around that number as well, and that is, although we're still awaiting what was the final number sold by the company in the presentation. But again, a very, very dull aspect as well. Finally, I just want to also highlight one key aspect, that the company released its Q4 earnings yesterday, and the numbers were largely strong again. They've scheduled their conference call on tomorrow post market hours at 4:30, and there will be some of the key questions to answer, but largely Olectra Green Tech not been able to fulfill those orders, and possible cancellation, as mentioned by my colleague, it should be coming soon.
Right. Thanks for that, Puneet, but stay with us. Quick question. Puneet, do you believe that capacity addition or ramp up, is that visible in an Olectra Green? Because you say that just about 550 to 600 odd buses delivered this year. Now, when I'm looking at top line, it's at around 1,800 crore. You're saying a 9,000 crore order cancelled, and therefore I'm assuming the order book size to be around 15 to 18,000 odd crore. And capacity ramp up, how quickly is that happening? Do you have absolutely any insight on that?
They had mentioned the previous conference call that they want to double their capacity to 2,400 to 3,000 vehicles per annum in just the next 6 months. So there should have been some capacity additions as of now. The key aspect will be visible in the presentation that will come tomorrow on the exchanges, because the conference call is scheduled tomorrow, so it just comes before that. But Harsh, to be honest, that number just seems a little bit bigger than the company can chew, because 1200 has been achieved per annum over the last 5 years. So definitely to double that capacity. So they've mentioned 2400 as an incremental addition to the 1200 right now. So definitely it seems that they are on to increasing capacity, but I think the street will wait for more comments in the conference call.
Okay, thank you so much for that, Puneet. And of course, that is our stock of the day as well, and Olectra Green Tech. But before we go across and have a quick management conversation, as we always do, let me quickly have a look at how the index is shaping up. Let's pull up the Nifty 50 index. It's down around 1% now. We did kind of recover from those lows, but we've given up all of those gains, and now we're sitting very close to the day's low again on the Nifty. Let's look at the breadth as well, the advanced decline, because it's clearly not looking as good. There's been plenty of gyrations and plenty of volatility, but for the moment it's nearly even Steven with regard to the breadth as well, but slight bit of inch up in terms of the number of declines versus the number of advances, 1250 to 970 odd, but largely 1:1. But that's been the kind of day that's showing on your screen. Let's look at the broader markets as well very quickly. The Nifty mid cap and small cap indices also not doing as well, but a flattish kind of move on the Nifty mid cap, giving up the gains from the day's high. The Nifty small cap as well, absolutely flat, Neeraj. So surely outperforming, but it's a flattish kind of a day, more tepid day after what's been a couple of good days of trade.
Yeah, and maybe which is why we should go to, the next management that we go to Action Construction Equipment. If you can just pull up that stock once, remember down about 3 or 4%, wherein to my mind the exit margins for FY25 seem to be very, very robust. And let's put all of that into perspective with Saurabh Agarwal, Executive Director of ACE or Action Construction Equipment, Johnson on the show. Saurabh, good having you. Thanks for taking the time out. This is Neeraj here. Good afternoon. Put these numbers into perspective, Saurabh, because I mean, when I look at what you've done over the years, right? Entered double-digit margins, FY21, FY25 consolidated 15%, exit margins 17.5%. The trajectory is looking strong both on revenue and operational metrics. Is this something that can continue going ahead into FY26 and 27?
Good afternoon. Yes, very much, definitely, and for sure. Without a doubt, there is no reason.
Okay. So sum up the quarter and the year for us. I mean, 15-20% growth, I believe that is something that you had guided for, and you kind of met that. So the wrinkle on the banana peel, Saurabh, might be that the past few years, you've beaten the guidance quite convincingly. This time around, you've met the guidance.
We were very hopeful, even in the last year, that we beat our 15-20% guidance when we gave it initially. And then obviously we toned it down a little after the election results to about a 15%. Slightly unfortunate that we are even slightly less than that, a little over 14%. And not to the best of our liking as well, because we want to do what we say. But yes, it was a tough year. The election results were liked by the overall industry, and different types of things happening all over in the country and the world. So the scenario was tough, but yes, we were able to do a good job. And currently owing to, let's say, the emission norm changes and the cost and the pricing increasing for customers, again, there is a slightly tough time, I think, especially in this quarter. So the start has been a little subdued, a little tepid, but I'm sure we'll catch up.
Saurabh, this is Harsh here. Good speaking. I want to start off by understanding from you, what is it that makes you bullish, therefore, for FY26? Is it the lower base of FY25, which gives you a bit of a springboard? Is it the pent-up demand that's coming through and that you're seeing coming through? And how is capacity addition ramping up for you? Because you were pretty much full capacity for a very long period of time.
See, a 14-15% we should be easily able to do, because there'll be some contribution coming in from the big army order that we've got, coupled with the blended price increase that has happened because of the transition from BS3 and BS4 emission norms to BS5, which are actually called CEV5 for construction equipment. So, and we are sure there will be some increase in numbers in certain product categories that we have put together. So put all that together on a conservative basis, we feel that 14% to 15% guidance, which we have given for this year, should go through. And maybe 3-4 months time from now, or let's say sometime around the end of Q2 is a much better time to judge and assess the market further, whether this is going to stay or it is going to be slightly better than this. But yes, to be on the side of caution, I think as of now for this current year, it's a 14-15% growth that comes to our mind. With respect to your question on capex, we did close to about 144 crores in a mix of expansion and upgradation and some land purchase last year. And this year it is going to be somewhere between 300 to 350 crores. About 100 crores are going to go into modernization and upgradation of our existing setup. Because like we also started to export machines, so we need to upgrade certain things apart from modernization. Then we are starting to build a new tower crane factory. So the total cost about 250 crores, and we believe that out of that, maybe about 100 crores will be spent in this year. And yes, we are due to take over some more land, which we had already entered into agreements the last year. So about close to 150 crores will go into capex there. So all put together for this year, about 350 crores. And yes, then it will continue in the next year as well.
So with regard to the ramp up, are you now at 15 to 18,000 units in terms of production capacity?
See, if we talk of, yes, we are more than that, I would say. About 13,200 for cranes of different types, about 2,700 for forklifts, and about 1,800 for construction equipment. So yes, that is slightly more than 18,000.
Saurabh, I'm just reconfirming. So when I asked the opening thing, you said that the exit margins for Q4 likely to be continuing. Now, two questions roll into one. Is it the newer projects that give you higher margins or better operational efficiency? Or what is it that leads to this? And what is, let's say, a 3-year time frame? You moved from, let's say, sub double digits or 9% to nearly 15% to exit margins of 17%. What do the next 2-3 years hold in store in terms of operational metrics?
Yeah, I feel that the current level of margins which we've been able to achieve, going beyond this will only breed more competition. So it has to be the right mix of, pricing vis-a-vis competition. So keeping that in mind, I think we are in a way at this going to stay between 70 to 18%. But yes, the way country is expected to do going forward, and our capacities are available, and we are further ramping up our tower cranes. So definitely operating leverage can play a big role here. So as and when it plays out, let's say maybe in the second half of this year or going forward in FY 27, 28, then we can definitely expect some, let's say, expansion in margins. But I think at the current juncture, the 70 to 18% we are very, very comfortable and happy with.
And that is something that you achieve as an aggregate for FY 26, 17 to 18%.
Yes, this is our aim for this year. We might be able to slightly increase it that time to time.
Okay. One more question from my end, and that is for any of these plans, which is either execution or the capex that you have, is there a requirement for any capital that you need, equity capital, or would you be happy with internal accruals and debt?
I think internal accruals, God has been kind, we don't need debt. So I think we use our own money to, as a matter of fact, we reached good levels of ROE, ROC. So we need to invest our money very wisely into our growth and expansion to be able to sustain and increase that ROE, ROC. So that's what we've been planning and thinking about, and this is a part of it, what I've just explained with respect to capex. And let's wish that next year we are further looking to increase our capacities for pick and carry cranes and backhoes. Let's see.
So a little bit about this defense order now. How large, how quickly do you execute? and how large is the opportunity size? Give us those three perspectives.
See, it's about 420 crores. It's more than 1,100 machines. They are special machines for lifting and shifting application. They are actually called telehandler, but yes, in the army they are called an RTFLT. So this is going to be the backbone machine with respect to 1 or 2 tons load movements, between sites, within intra-site, inter-site, whatever. And we just received, we did get the contract done in the last quarter, and we just received our advances about 10-15 days back. So our 3-year period starts now. And, completing all the formalities before supply of training and whatever. So we believe that end of Q2, but I would say Q3 is when we start executing. So we are looking at executing about 80 to 100 crores within this year. And the balance will go into the next year. We have a 3-year time frame to do it. So I think we can also take it into the year after that, but we'll try and finish it in the next year.
Is this going to be something which is recurring, and how large is the opportunity?
See, it's a large opportunity, and obviously this is the first of this thing. So hopefully they should be recurring, and that the defense budgets and the time will let it play out.
And is this a better margin business? Could you give us some insight on that?
See, it is somewhat similar in sync with our company. And so, because that's what we've been focused on, to maintain profitability and to sustain it. More or less, most of the business have to be just little up, down in that sync or that range you want to work at. So that's how it was. It was competitive bidding. So we came out well. So,
okay, and any update with regard to 2 new initiatives, one on the electric crane and second on your Ghana facility? Any update on that?
The electric crane is going to get commercialized very soon. I mean, we are already ready. We have been ready last 1.5 to 2 years. So now the ministry notification with respect to guidelines for registration, CMVR, everything is in place. There was some minor amendments or corrections that needed. That has also been taken up by RAI and it's gone through. So currently our machine is under, let's say, the CMVR approval. We are very hopeful in the next 1 or 2 months it should go through, and then we should be able to commercialize it, actually start selling it. Even currently we are selling a very few units, for yard or within a factory application, but that's not what the crane was meant for. So I think by Q2 and middle end of Q2, it should completely go through the market. And with respect to Ghana, I think we really don't know, and obviously we cannot do anything without the money coming in. Although we have signed all the necessary agreements about 1.5 years back with the Exim Bank and the government of Ghana, but there seems to be some payment issue between the Exim Bank and the government of Ghana. So, and obviously we cannot start till such time we get our advances and payments in place. So I think as of now that's on hold, unless something comes up positively.
Saurabh, if I were to look at this from a 3 to 5 year perspective, how should I look at this? Can we expect top line to reasonably double and grow at 15%? Is that the consistency which you will look to maintain in the business? And will margins continue to be in maybe the 16 to 18% kind of band? Is that something that one can reasonably expect over the next 3 to 5 years?
Yeah, I think both the things that you said, 15 to 25% range. And like we've experienced in the past, there could be 1 or 2 years that could be faster than that. But I would say putting it in a 15 to 25% range is good enough. Is the right thing to forecast. And they can, like I said, they can be years which can be faster. And profitability around the 17-18% range is what we are aiming. Yes, in faster years or bigger years with operating leverage playing, the margins can also be slightly higher. And apart from this, we are also planning a few other things I really can't discuss. So that will help us attain this, whatever we are thinking.
Point taken. Thank you so much, Saurabh. It's been good interacting, and thank you for coming in and chatting with us.
Yeah, thank you.
All right, so that's, of course, Action Construction stock taking a bit of a knock in trade, but has been flat all the way since the morning, 4% lower in trade. But joining us is Kush Bora. Quick technical check with regard to how he's viewing markets. Kush, it's been a much delayed start to this conversation. Let me first start off with your index calls, both on the Nifty, the Bank Nifty. How are you viewing it?
Sure. Hi, Harsh. First of all, very good afternoon.
Good afternoon.
Well, I think this dip might turn out to be a buying opportunity, but as has been the case in the past, I don't prefer to buy when the index or a stock in particular is, hitting days low. So I would wait and watch. Only a couple of signs that suggested that, we could be perhaps consolidating with a negative bias, certainly not to this magnitude, was the wick that was heightened yesterday and today as well, and the 25,000 call writing. Now what's happened is that the base is shifting lower to 24,800, and any meaningful put pace is close to the 24,500 mark. The 20 DMA also lies close to the 24,600 mark. So somewhere close to those zones, the index should find some support. And if it does, then this again, will turn out to be buying opportunity as we saw during the day as well. Not much sell-off seen in the broader market, so I'll take that as a heartening, as a healthy sign. And on the whole, this does look like a phase of consolidation, maybe a slightly extended one at that. But on the whole, as long as 24,500, 24,600 zone is protected, this dip in the Nifty could well turn out to be a buying opportunity.
What about Nifty Bank? Kush, good afternoon.
Hi, Neeraj. Yeah, we've spoken about this a couple of times, haven't we? I mean, this is the bigger area of concern. In fact, if I just tie this to the Nifty view as well, the issue is that where does the leadership come from? Bank Nifty has gone into a sideways consolidation mode for some time now. And it might just well continue to do so with 555 and 56,000 being resistances. So this could perhaps be sideways for some more time. So I wouldn't really initiate a buy call here. But again, just quickly tying it back to Nifty, IT and autos were the top gaining sectors yesterday, and they are now the top losing sectors today. And as the meme goes, this is why I have trust issues. So I don't know whether leadership really will come from. But yeah, I mean, one of these things kicking in and Reliance doing its bit, we might see some more upside on the Nifty. But as long as the indices consolidate in a broad range, I think the broader markets will see continuation of the action, stock specific action that we've been witnessing. And I think for now we'll take.
What about your ideas, Kush?
Still on the long side. The first one is SAIL. Good moves on this one. It's been gaining ground even in the market like this. It's trading higher. So with targets of 130 and 133 with a stop loss around the 125 mark, SAIL is a long call. The other one is Eris Life Sciences. Fairly similar structure, just that it's been a slightly steadier ride, especially if you compare it to a metal name like SAIL. Volumes also have picked up in the last 3 to 5 sessions. Momentum indicators also looking upward. 1620, 1680 are your targets, and 1530 is where you place that stop loss.
Okay, we take a break. Kush, stay on. Lots more line up on the other side, viewers. Be right back.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Welcome back. Thanks for staying with us. That time of the show where we go across to Somit, who joins us with all of the chatter that he's picking up from dealing rooms on our special segment Heard on the Street. Somit, over to you.
The first stock on the list is Tata Chemicals today, and dealers are indicating that there is strong buying interest that we are seeing on the DI desk, and they're expecting the delivery volumes to be higher for Tata Chemicals in trade today. The second couple of stocks are BHL and Elga Equipments. Now, dealers are indicating that smart investors have started to accumulate both these counters. For BHL, they're accumulating it at lower level, and for Elga Equipments, investors are expecting a strong Q4 earnings to come in, and that's one of the reasons why the stock is also up around 4% in trade today. Third stock on the list is Samvardhana Motherson. Now, this auto ancillary company is seeing sell flows on FI desk. Very high sell flows is what dealers are indicating. Now, yesterday the company did announce that they will consider bonus along with its Q4 numbers, and the stock did open high on that announcement, but it failed to hold on to those gains, and the stock is now down around 2% in trade on the back of the sell flows on the FI desk that I'm hearing. And lastly, PG Electroplast. There was a big block deal today, 5.6% of the stake that promoters sold in the market. Dealers are indicating that the demand was quite strong for this block that has come in. In fact, multiple domestic mutual funds and AMCs have shown interest. Some prominent names among them, firstly is GIC, which is this investment arm of Government of Singapore. Then there was Axis Mutual Fund, Kotak Mutual Fund, DSP. All of them were buyers in this stake that was offloaded by promoters in trade today.
PG Electroplast definitely of interest, because despite that promoter stake sale, Somit, you're seeing some support coming in there, and big investors want to come in. Thank you for that. Heard on the Street. Somit's going to come back in a minute with more on Interglobe. But meanwhile, Kush Bora, founder of kushbora.com, continues to be with us. Aditya Shah also joining us this afternoon. Welcome to both of you, and great to have you on. Aditya, I'm not sure if you've already spoken about Electra Greentech, but one company which has been in the eye of the storm, they put out an exchange filing saying that we have not received any statement from the government of Maharashtra cancelling our order. We have an on-record interview with the transport minister of the state saying that despite repeated deadline extensions, they've not delivered a single bus. Tell us what you think fundamentally of the company, because this is truly a trader and retail investor's delight.
So over the last 1 or 2 years, on the back of e-bus orders, Electra Greentech have moved up, and of course, Electra continues to lead the e-mobility e-bus segment in the entire country. So net, I believe that the order will get cancelled because of non-delivery of this of the buses that Electra Greentech has done, and it is short-term negative for the company. But longer term, within the bus mobility space, Electra Greentech continues to do really well. I believe that the stock will take a near-term correction and then move on. So from my perspective, I'm positive on the stock. Any corrections towards 1,000 could be a good opportunity to add.
Okay, so you're saying it's a good opportunity to buy at dips?
Yes, absolutely.
Kush, do you agree?
Somehow the targets or the levels which Aditya mentions always fascinate me. Somehow they also tend to come true, because I'll give you an example. The famous one is the Zomato, right? I mean, he was trading at what, 270 odd, and he said, "200 के आसपास आएगा तो buy करेंगे." Did you listen to the level that he mentioned? Around 1,000 he'll buy, which is about 25% cut from current levels, right? So I don't share his enthusiasm, but with that caveat, I'll agree that around 1,000, maybe 950 is a good entry point. I'll give you the reason as well. For the last 4 years, and I'm counting from COVID to about 2024, the stock had risen 55x. For the last year and a half, the stock is now in a very serious downward sloping channel, and a very beautiful one at that, where every time it comes up to the resistance mark, it seems some sort of selling pressure. News or no news, it was now again coming up to that resistance mark close to the 1300, 1350 zone, and we're seeing that sell off. So if at all one wants to consider, you're better off buying close to the support zone, and those come near the 900 mark. So maybe a little above that, 950,000 thereabouts. If it comes, then perhaps it might make for a good risk reward ratio, but not on the higher side for sure. And by that I mean at current levels also.
Your target price, or where you are comfortable buying, Kush, is even lower than what Aditya Shah is saying. You're telling him
risk reward ratio.
You're saying 1,000 rupees is 25% cut. You're talking 900.
No, so 900 would be my stop loss. So I would prefer to buy slightly above that, maybe 950,000. So
what are you doing if you hold the stock right now?
If you're holding it, you might as well continue to hold. I mean, that's a different story. But for an entry point, for a fresh allocation that you want to make, the risk reward ratio at the current level will not make sense. Anyway, the stock is off the off the lows, which are also close to the 950 mark. So holding currently perhaps is okay, but fresh allocation is not recommended even with these kind of cuts that the stock is seeing today.
Okay. TTK Prestige is the other one, Harsh, which was on your radar. If you look at the intraday chart, that stock has taken a huge knock after the numbers. Nothing that has pleased the street clearly.
Not at all. In fact, the numbers were a very poor set. There's very small growth that we've seen on the top line, just about 4.5% just pulling out the numbers. EBITDA is down around 33.5% on a YOY basis. Margins have come in sub 8%. Versus the 12.5% number same time last year, and the profitability has slipped into a loss of 41 crore, not impressive. And TTK Prestige on the back of that is down an 8.5%. Aditya, do you have a view on a TTK Prestige?
Sorry, I don't track the stock, so will not be able to comment on it.
Okay, and what about you, Kush?
Nothing to write home about. If you see, there has been mild recovery from 600 odd levels, but hasn't really been able to break out. So I wouldn't really venture a trade into it just yet.
Stay away from a TTK Prestige. And the numbers did look poor. What about an Interglobe? And we'll just get Sumit here in a second to talk about the Indigo stake sale and the Gangwal family's gradual exit from Interglobe. We talked about it this morning, saying that in our view, this means an overhang is receding. On the charts, how do you see it, Kush?
Not a bad setup at all, Tamanna. I mean, the 50-day moving average has been a support for the stock for the last 4 odd months. Today also, if you see, the low that the stock has hit is precisely near the 50-day moving average. All in all, the medium-term trend is intact. I mean, because of whatever happened recently, geopolitics and the sale hangover, all of that coming in, this just gives a breather to the stock. If I had a medium-term view, I would buy it at current levels with the stop loss near the 5150 mark. And on the upsides, you would for sure look at targets of 5500 and then again 5650, the recent swing high that the stock has made. So in all likelihood, this dip is a buying opportunity. Fresh allocations can be made at current levels.
Fresh allocations at current levels works from a technical angle, but what really is happening with Indigo Airlines? It's a fascinating story. So Indigo Airlines founder Rakesh Gangwal and Chinkarpur Family Trust are about to sell 5.5% stake in Interglobe Aviation. Actually, those deals would have pretty much been executed through the day. The stake will be offloaded through a block deal. Sumit is giving us context. Sumit, this is close to the culmination of a long-standing dispute between two co-founders, isn't it?
Right. Yes, there was a big dispute that happened between Rahul Bhatia and Rakesh Gangwal, that were the co-founders of Indigo. And this dispute started back in 2019, and this was related to some disagreements between both the parties on corporate governance and related party transaction. So this started to happen from 2019. In 2022, Gangwal came out and said that he will step out of the board of Indigo and will look to sell his stake over the next 5 years. And that is what he has been doing so. And today in block deal, he has sold close to 5% 5.5% of his stake. That is close to 2.1 crore of the equity. Interestingly, they had upsized the deal today in the morning itself. The overall offer size was close to 11,000 odd crore rupees. The offer was done at a 4.5% discount to the yesterday's closing price, and the lock-in period for the remaining part of the stake for Gangwal is around 150 days, which means that for the next 150 days he cannot go ahead and sell any of his stake in the market. And this block deal happening, for the 8% stake that is left with Gangwal, the lock-in period is 150 days. Now, what it means for Indigo? It means for Indigo that the overhang that has been there will now come down further. In fact, he's left with only 8% stake. Now, this could be offloaded by him either in 1 or 2 tranches. That remains to be seen. But just 8% of the stake that is remaining with Mr. Gangwal, which will go ahead in the market now. Now, so far he has mopped up close to 27,000 odd crore rupees from his stake sale, and today he'll get another additional 11 to 11,500 crore rupees from this stake sale, and the remaining 8% stake that he has in the company, that is also valued at close to 26,000 crore rupees for Mr. Gangwal. Now, for Indigo, if you look at it, is one of the largest airline in the country with market share of more than 60%. Nothing fundamentally wrong because of this block deal. It is just an overhang. Just one thing that could work against Indigo at this moment is the fact that they have indicated that first quarter of FY26 could be a bit weak, given the fact that there were geopolitical issues which could lead to lower numbers compared to what the company had reported in the previous quarter and last year. But apart from that, nothing negative. It's steady air traffic growth, steady fuel prices, and higher ticket prices that have been aiding the company and could aid even going forward. And if you even look at the analyst view at currently for Indigo, around 82% of the analysts who are tracking the company have a buy rating, 9% have a hold, and only 9% have a sell rating on the company. The average consensus target price stands at close to 5,939 rupees, which suggests a return potential of around 10 to 12 odd percent from the current levels of the share prices.
A quick brief from Aditya on Indigo. Thank you for that, Somit, and for giving that perspective as well. How do you see the development? Because apart from, of course, the supply which is coming into the street today and which has depressed the stock price, do you think the Interglobe story is done and dusted, or a lot more to go?
So Indigo is a fantastic company. Gaining 60% market share over the last 15 to 20 years is a phenomenal job. And today, if you go at an airport, you will see 8 to 10 out of 10 flights, 6 to 7 flights are from Indigo itself. So it is a fantastic company. It will continue to do exceptionally well. But if you look at the valuations, Indigo is valued at about 2 lakh crores, which values the entire aviation business at about 4 to 5 lakh crores. I believe that this is really very expensive, and any short-term upwards burst in crude oil will definitely mean that the profitability will get hit. This quarter, we will see, as the Pakistan airspace was closed, Indigo had to take D2 for all its European flights, which will mean a hit to profitability. So aviation is a tough business. Indigo is doing pretty well. But from my perspective, the valuations are too expensive for any comfort. Valuations don't leave any margin of safety per se. I would tend to wait for some corrections before entering the stock. But the company will continue to do exceptionally well. And another thing that to watch out is how does the collaboration with Turkish Airlines plays out. The government has clearly said that they will not allow Indigo to renew their leases of 777s that they have got. So that is another thing to watch out for the stock price. If the partnership with Turkish Airlines falls through, it could be a negative in the near term and could be a buying opportunity for Indigo there.
Okay, so that's a quick fundamental view on Indigo as well. Couple of other sectors which are buzzing. The top gainer today again being defense. I want to quickly take a view from you, Aditya. What the view with regard to defense is? Do you find, if you're finding Indigo expensive, are you finding defense expensive as well?
Definitely. So most defense stocks have really run up. Mind you, over the next 10 to 20 years, India's defense exports are going to materially rise, and all of these companies are going to do exceptionally well. But let me give you an example. Hindustan Aeronautics Limited, it has guided for an 8% revenue growth next year, and it has guided only in 2027 will it be able to make 24 HAL Tejas aircrafts in a year. even with the operational challenges that the Air Force is facing, company needs to deliver really very strongly. So from my perspective, for a company that is delivering 8 to 10% growth and to pay about 40 to 50 times valuation is really very expensive. And if the company is not even able to achieve 8% growth, then the stock price could really tank. So from my perspective, it is very stock specific. Across the board, stocks are no longer cheap per se. They are really very expensive. So I will tend to wait over the last 2 to 3 months as India went into some escalation with Pakistan. A lot of these stocks have risen by about 15 to about 50%. So one needs to be really very careful before taking positions in any of these stocks. I would tend to avoid the entire space right now, only basis the valuation.
Okay, let's take a look at the top 3 stocks on our radar. I mean, BDL is going to report, so keep an eye on Bharat Dynamics. But meanwhile, top 3 stocks that are buzzing this afternoon. Varsha joining in with more.
Okay, for that, so let me start with, Aurobindo Pharma, wherein, company had a very weak set of numbers. Revenue was in line, but there was a miss in margin. EBITDA margin impact is due to higher other expenses that the company has seen. Though there was a good growth in US business, Europe business also grew 16%, but the net profit impact that you're seeing is due to higher interest cost and higher depreciation. The company is confident to continue growth trajectory for FY26. They're going to sustain EBITDA margin of 21%, and they expect inflection point in biosimilars business in FY28. Cash flows are good, so board may consider buyback and dividend, and that's one of the reasons why, despite poor earnings, the stock was up. Good con call commentary. Next on the list is Shilpa Medicare. If you see overall, the numbers are looking good, but it did not meet expectations because so basically they manufacture niche APIs, intermediate and formulations, and they are also into CDMO. There was a lower than expected licensing income, which actually impacted earnings. Revenue was lower than estimates owing to sharp decline in licensing income. Licensing income, if you see, declined 40% year on year, and company expect the licensing income stream to be durable on the back of good CDMO business that they are expecting. Last on my list is Sumitomo Chemical. If you see, again, weak set of numbers. The company operates in, so basically it's an agrochemical company, operates in insecticides, weedicides and fungicides. If you see, poor set of numbers, revenue was down 1%, EBITDA was down 14%, margins were at 17% versus 20% last year. Now this is on the back of higher employee costs, which actually impacted net profit, and net profit was down 9.2% overall.
Okay, so these were the set of numbers which want to grade and add to that some that we've seen recently, TTK Prestige and others that we talked about. I just want to come in on this, Aditya, because this is an ongoing debate in our newsroom and on all of our shows also on as we come to the conclusion of Q4 results season. What has been the outtake in your view? Have we done better than expected, worse than expected, or on balance, corporate India needs to pull up its socks?
In my opinion, earnings have been really very disappointing. Many companies have not reported good set of numbers. I think index also, there will be a downgrade in the index forecast for the earnings per se. Some sectors that have done pretty well, some larger banks, smaller banks have disappointed. Some larger banks, AMCs have done pretty well. If you then look at the brokerages, they have also disappointed. If you then come on to the FMCG space, the FMCG space has also disappointed. The FMCG, some of the FMC or some of the QSR companies have reported disastrous set of numbers per se. Where there are green shoots are the infrastructure companies. They have done pretty well. Some of the auto companies have also done pretty well. These new age tech companies, for example, the Zomatos and the Swiggies of the world, they've also not done pretty well on the basis of some slowdown that they are really facing. So as I said, infrastructure is doing pretty well. The government is investing very heavily. Some defense companies have also come out with good set of numbers. That is also an interesting space to watch out. Net, in my opinion, as a whole basket, the result season has been disappointing, but individual companies are performing in a better way. So you need to look at stocks individually and then see if you want to add a buy or sell. But from my perspective, very disappointing result season, and I hope that next 1 year could be better. But as management commentary goes, it doesn't look really great from that perspective as well.
So Aditya, what's that sector space pocket which in your opinion has done decently well?
As I said, the infrastructure space has done pretty well.
Okay.
Across the board, most infrastructure companies reported good set of numbers. For example, Action Construction reported its numbers yesterday, and I think they came on the channel today as well, and they were guiding for about 15% revenue growth and doubling out their turnover over the period of next 3 to 5 years. So aggressive investment in infrastructure by the government and these companies getting orders is a positive. Although L&T reported a little bit of disappointment in the numbers, but the future guidance continues to be really very strong. So these are the companies that you need to watch out for. Somebody in the water space like a VA Tech Wabag is also doing pretty well. So infrastructure as a whole has done pretty well. Mind you, these valuations are also not cheap. You cannot value an L&T at about 40-50 times. You can value it at about 20 to 30 times max. So that space has done well. Auto space has done pretty well. To that extent, the exporters of auto and auto ancillaries have done pretty well. Some of the chemical names, not all, some of the chemical names, they have done decently enough. Some of the pharma companies have also given good set of numbers. So they need to concentrate on. So the major disappointment comes from the FMCG space, where a single digit volume growth is really very disappointing for a stock that is trading at about 60, 80, 90 times multiple. Really very disappointing set of numbers.
ITC seeing some real pain despite the onset of monsoon. I wonder as the monsoon picks up and if it stabilizes, whether you're going to see a turnaround in some of those consumption plays, and that really comes to mind. This, in fact, a conversation that I just had for Big Question where we spoke about exactly this, and one point of view right now that an early monsoon might do more damage than good. For example, in the cement space, all of your air conditioning stories and your ice cream stories have really taken a hit. But the other point of view being that, as this settles, you might see an uptick going forward on consumption.
Yeah. I only wonder it that in the case of ITC though, one, the fact that if, I'm not 100% sure if it goes ex-dividend or no, but if it is, then that's a bit of price downtick that we'll see on ITC. So maybe a disparate action between futures and spot. And then could be interesting to see if there is a corporate activity that comes in at some point of time, because this overhang of British Tobacco giving some or all of their shares has been there on ITC for a while. It plagued Indigo, and I think we spoke about it for a number of days until finally Rakesh Gangwal's stake has come in today. I wonder if the same happens to ITC. So
yeah,
could be interesting
ITC
to
is
see.
going ex-dividend tomorrow.
Yeah, it is, right?
Yeah, and for a final dividend of 7 rupees 85 paise per share. Record date is also May 28th. So that's perhaps why you are seeing some overhang.
So one is that, and tomorrow we'll see that dip coming in, and then maybe, just maybe, if there is the bad stake or some bit of it, of all of it coming in. I think once in one of the Herd of the Street segments we kind of reported about this as well.
Yes.
That it's a large stake that is likely to come on board, and or rather come on the bourses, and that might be a temporary overhang for ITC.
If you look at it in relative terms, ITC's numbers weren't as bad as some of the other FMCG players, largely because of the diversification that they have. So that also seemed to be relatively okay.
Yeah, the volume growth was okay, and the margins weren't under as much pressure from RM prices as some of the other names have been, at least in recent times. They've been able to hold on to margins to some extent. So in that sense, ITC is more insulated. Aditya, would ITC feature in your bets at all?
Definitely, it's a portfolio stock. We've seen the bad stake sale going on for many years now, and I hope that they finally exit out so that the overhang on the stock is gone away. The results were decent enough, nothing spectacular, decent enough, but the dividend yield continues to be really very strong for the company. And given the diversification that they are doing within the FMCG business, really they are putting a lot of thrust that the FMCG business really grows well. So from my perspective, portfolio stock, any correction, decent correction towards 400 or even 350 could be a good buying opportunity into this long-term compound.
Okay, so it's definitely something on Aditya's watch list. But sticking with this theme, monsoon onset is stalling cement price hikes, at least in South India. That's what we're picking up. What's next for the sector? Somit here with the details and the perspective. Somit.
Well, yes, construction activities are getting stalled, but moreover, the fact that the prices are also coming under pressure. Yes, cement stocks are under pressure in trade today, and this is after INCRED has come out with this note on cement companies where they're saying that the monsoon onset has stalled the cement price rise that we had specifically seen in South India. Now, dealers have started to offer discounts from their margins to boost the sales volume, and this is owing to a combination of subdued demand that was already there, and now the onset of rains has also put more pressure on the demand offtake. Now, this has also raised concerns on the potential losses that could happen to the inventory which is sitting with the dealers and as well as with the companies. Now, as per INCRED's dealer check in Karnataka, dealers are providing a discount of approximately 10 rupees per bag, and similarly in Andhra Pradesh and Telangana, the discounts are offering in the range of anywhere between 10 rupees to 20 rupees per bag, and any form of discount that is currently being offered by the dealers from their own margins could also lead to more price cuts coming forward as per INCRED. Now, few companies that have significant exposure towards South India include Ramco Cement, Dalmia Bharat and Ultratech via India Cements.
Okay, so Ramco, Ultratech, you're seeing Ultratech surely under some bit of pressure. Let me come quickly to Kush with regard to a view on an Ultratech, 2.5% lower, Kush.
So Harsh, the entire pack had actually run up quite a bit. So profit booking was par for the course, but I think this also ties into the seasonality bit that's coming in. I think I'll hold up any kind of fresh purchases because the 200-day moving average support near the 11,300, 350 mark has acted up about 10 sessions ago, might continue to act up this time as well. If it breaks the 11,300 mark, then it just might become a shorting candidate. So crucial juncture, I will perhaps wait and watch this one. One stock in particular that's actually been on my radar for some time from the cement space is actually Sagar Cement. It's had a good run, far less volatile than some of the other names. Today it's come into a bit of a correction, but the last 3 to 4 sessions there's been a very good volume action and price action on this one. So maybe closer to support zones of about 230. This could give you a good entry point. So keep that one on your radar. Ultratech, as I said, close to the support zone. So you might want to hold on perhaps for a day or two to see which way this one goes.
And Aditya, do you have a view with regard to cement and a preference? Because nearly everyone who used to give a fundamental view on cement was of the opinion that price hikes would really drive the re-rating on some of the stocks. Now, with price hikes not looking particularly visible, is that a big concern in your opinion? And how would you play it?
So Harsh, the cement industry has been struggling to take price hike over the last 5 to 7 years. So I don't think that those price hikes are really coming. And of course, the monsoon coming in sooner than expected will only mean that the construction activity slows down to a large extent, and it will mean short-term hits for all of these cement players. But I am positive on cement per se over a longer period of time. My preference continues to remain with the larger players nationwide with Ultratech. Of course, Ultratech has other problems, as in it is diversifying into businesses that it has no business to be in. Or then you will have to go for Dalmia Bharat, where it is very strong in the eastern part of India. So that's where my preferences would lie. But right now, given Ultratech's problems, I would tend to avoid and not invest in any of these stocks and wait for any correction that may come in because of the unseasonal rains that we are already seeing right now.
So, in fact, you could see heavier rainfall over the next few days as per the latest IMD alert that we reported. That's one space to watch out for. The other is Info Edge, stock in focus in the back of its Q4 numbers. Now, saw a bit of a dip when the numbers came in, although the numbers on the face of it look decent. It saw a double-digit growth in key sectors while earnings were in line with estimates. Puneet joins in for more. Puneet, some one-time gains also reflecting on the balance sheet there.
Well, definitely, and I just want to focus a little bit more on the segmental performance as well, because the franchise of recruitment, which is Naukri.com, has done really well in this particular quarter. Numbers, in terms of billings, for Q4 is up 18% for Naukri.com, while for the whole year it's up 15%, coming in at roughly 2,100 crores for this franchise. In terms of operating profit as well, it's coming at 1,100 crores, and that's the major cash generation vehicle for the company. In terms of the 99 acres business as well, the billings grew 22%, and in this particular quarter coming at 160 crores. For the whole year it's also up 18%, and they have been trying to, do a lot of measures in terms of getting operating profitability in 99 acres. For this year, they've improved 31% compared to last year, but it's still at 48 crores is an operating loss for this entity. While the other two verticals, Jeevan Sathi as well as Shiksha, again very small verticals when compared to the larger recruitment business, but both have done well in terms of billings. The billing momentum for Jeevan Sathi is up 24%, as well as for Shiksha is up 16% on a YOY basis. They have mentioned one very interesting trend in the recruitment business which I just wanted to highlight, which is that the GCC segment is now contributing 16% of total billings, and that's just want to integrate that with what we heard from TeamLease as well, that a lot of their specialized staffing is now coming specifically from the GCC segment, which is the high margin business of the company. Apart from that, the tech IT services is around 28% of billings for something like an Info Edge, and 25% is for recruitment consultants. So overall, business momentum is strong. The conference call is scheduled later this evening, and some momentum, a little bit more information on that in continuing for profitability for both the 99 acres and Jeevan Sathi will be something to watch out for. The recruitment business continues its double-digit growth, as you rightly said.
Info Edge is one such stock. Thank you so much, Puneet, firstly. But Info Edge is one such stock which is nearly always on the radar because of all the investments it's making in terms of incubating businesses as well. And that's the interesting angle also to this, outside of the numbers, of course. So while the numbers came through, stock down 2% odd, but that's one thing to keep your eye out on. Aditya, would Info Edge feature on your list, or would you find valuations too stretched here?
So Harsh, of course, the valuation last year, the results are very okayish. Nothing to complain about on the results per se. The smaller businesses will take time to turn around. And as you said, the real gist of Info Edge would lie in the futuristic investments that they are doing. And if one of the startups that they invest in really turns out to be pretty well, then they could do really well. So from my perspective, okay stock, tracking it for any investment that they do turns out to be pretty well.
Technical view from Kush Bora on Info Edge as well. Are you liking what you're seeing here on the charts?
Not really, Tamanna. In fact, 1480, 1500 resistance, this might be a shorting opportunity for someone who's looking for a hedge in this portfolio. On the way down, 1420, about 1400 odds target, maybe a little lower as well. So 1500 is a stiff resistance. So Info Edge is more of a shorting candidate.
Okay, what else is on the BTST radar? That's going to be after this break. Kush, thank you so much for joining us this afternoon. He doesn't like Info Edge at all, but what are your other picks? We're going to be talking about all that and more after this very short break. Stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
Back with India market close right here on NDTV Profit. 0.78% lower for the Sensex. The Nifty 92 is clawed back some of the losses, but the pain remains. I think the banks are probably the best performing large index today, but in a bit of a slumber, as I think Kush Bora mentioned earlier. Volatility index too has clawed back a little bit, from 19.3 at the high of the day to 18.64 currently. But it's time to talk about specific pockets. Now, Brainbees, the recently listed stock, Brainbees Solutions, the company behind firstcry.com, reported a rather disappointing set of numbers, which has put pressure on the stock, 5.5% lower. To tell us what the future holds for the company, Mahima brings us a comprehensive bull versus bear presentation. Mahima, I'm interested to see what is the bullish argument here.
Right, so it was actually very difficult to find the bullish argument, but overall, in terms of the Q4 numbers, revenue was largely in line with what the street was expecting, but the real miss was in terms of margins because they was lowest in the past 6 quarters. Now, in terms of how their segments performed, in the India multi-channel performance, the gross merchandise value did see a growth of roughly 14%, which was on the positive note, but overall growth, which has been more than this 14% mark, was impacted by a slowdown in offline sales, plus shorter winter and closure of a lot of their company-owned stores. In terms of their international business, margins slightly improved from 14% to 15%, but revenue was impacted by higher competition in the international business. So revenue saw a single-digit growth there. In terms of a good thing that they've done this particular quarter is that this is the first time that the company has actually disclosed the gross merchandise value for their apparel and footwear segment, and that stands at around 52%. But the overall inventory days for this particular quarter have gone up to almost 102 days, which was earlier just 83 days in FY23. In terms of stock performance, where the stock has been down 46% since listing and 22% versus its issue price. In terms of valuations also, the EV to EBITDA is at around 88 times right now. But in terms of what Bloomberg analysts suggest, they have around 6 buys and 1 sell call, and they are suggesting that the return potential could be around 39% for this particular counter. But today the stock is definitely under pressure on the back of its Q4 earnings. So this is how Q4 and FY25 has panned out for something like a Brainbees.
Mahima, thank you, and I tell you what, that whole comment from Morgan Stanley about increased disclosures hasn't helped the stock today for sure.
No.
Not at all.
We were just, I think Harsh is an active user of Brainbees. So yes. What is your experience of the product?
No, so I mean, we do use it quite often because there aren't too many websites or shops which cater exclusively for babies and kids, right? So that's the one big attraction. But outside of that as well, it kind of gives you the whole hog in terms of product, and therefore we use it. So surely a big user of Brainbees, but not reflecting on the performance.
Yeah, no, you alone can't save Brainbees. That's
no matter what you try.
No matter how much you shop and sell, which you would with a new baby. But okay, Aditya Agarwala joining the conversation this afternoon, also with Aditya Shah. I'm going to use full name so we don't confuse it. Welcome, Aditya Agarwala as well. But Shah, let me get your take first on the whole Brainbees story as it's panning out.
Tamanna, sir, I'm not tracking the stock, so will not be able to comment that.
Okay. I think we should do an in-depth on some of the howlers of 2024 IPOs. Listings which took place in 2024, and I mean, I was just looking at that, 22% down from listing price, 46% down from its high. I mean, we have to start questioning valuations at some point as we go back into IPO season.
And there is an upside even now of 39%. That also is kind of fascinating because even from here at 88 times EV/EBITDA, you're seeing a 40% upside on the stock, delivering a performance of 15% top line growth. That just kind of underlines.
Rankles.
This kind of underlines as to where we are placed. There's either some serious margin upside here, which is going to get built in maybe over the next 2 to 3 years, or there's going to be some
how?
more disappointment.
How? Unless you shop much
It's a
more.
platform company, and therefore
Okay.
maybe a 3%
Maybe.
margin increase could
Okay.
change numbers.
Okay,
Maybe.
Aditya Agrawala here with us this afternoon. Aditya, let's get your take on the indices first. Bad day for the street. Some recovery from its lows, though. Are you seeing more strength coming in?
Hi, afternoon, Tamanna. Thanks for the show. I think it's more of a consolidation. If you take a look at the way market moved yesterday, it was an up move. Today, it's more of a down move. We need to take a look at the Indian VIX, and that is something that I've been mentioning for quite some time. You can't take your eye away from the VIX. Till the time VIX settles below the level of 16, I think this kind of a volatility is going to continue in the market. I don't know what is spooking the market, but the market is definitely spooked for some reason or the other. So 19 is the threshold level for the VIX. If that is taken out, you will see further volatility picking up in the market. If it settles down here and starts to inch lower, closer to 16, then I think you will see a gradual recovery in the market. But overall picture, if you take a look at both the Nifty and the Bank Nifty, both are locked in a range, 25,100 on the upside for Nifty and 24,800 to about 400 on the downside for support on the Nifty. Talking of Bank Nifty, 56,000 to about 54,500 is where the support zone and the resistance zones are. So my sense is markets will continue to trade in this zone till the time either VIX crosses that level of 19 or inches below 16. You will not see any decisive move in the Nifty. There are stock-specific and sector-specific activities which do happen on a weekly basis, and my sense is that is likely to continue in the market for at least some time.
Okay, what are your top picks this afternoon?
So I've got a couple of recommendations, predominantly on the long side itself. The first one is PEL, Piramal Enterprises. Looks an interesting trade for me. For a target of 1150, I'll be a buyer here with a stop loss at 1075 on the downside. The second is, interestingly, a lot of these small banks are looking interesting. So IDFC First is something which is looking interesting to me on the chart setup. At current levels, I'll be a buyer in the stock for a target of 72. Place a stop loss at 66 on the downside.
The other one in focus, and it's interesting you say small banks. I'll come straight to that, Aditya Agarwala, but let's talk about Blue Dart for a bit, because has been buzzing after its Q4 numbers. Mahima here with a comprehensive report card of how that went. Mahima.
Right, so more details of course awaited because the con call is at 4 o'clock today for Blue Dart. But in terms of numbers, the numbers did not look very good. Revenue was up 7%, EBITDA down around 6%. Margins came in at 15% versus that of 17%, and net profit was down almost 29%. The company is also set to pay a dividend of 25 per share. But in terms of key highlights, profits were largely impacted by freight handling and servicing costs, which was up 10%. Employee benefit costs also went up by 6%. Other expenses went up by 13%. Even depreciation and amortization expenses went up by around 10%. Other operating income saw a twofold growth, but other operating loss in the previous quarter stood at around 4 crore for the company. In terms of outlook, the management has said that they remain cautiously optimistic considering the external uncertainties right now in terms of the logistics space, and they continue to invest in expanding their network and advancing their digital capabilities. But of course, we'll have to wait and watch out for as to what the commentary is in particularly for this quarter and how overall FY26 will shape up for this particular counter.
Aditya Shah, wonder if you have a view with regard to, first off, thank you, Mahima. Aditya Shah, any view with regard to logistics plays, and how would you assess Blue Dart's numbers? Quite slightly disappointing in that sense.
Yeah, no traction. No, I'm not tracking this space, so not be able to comment.
Okay, point taken. Aditya Agarwala, do you have a view with regard to a Blue Dart?
Doesn't look all that great, Harsh. Stock has turned down from its 200 DMA. It's been a while that it's trading below its 200 DMA. Till the time it crosses that hurdle, which is around 7,200, I'm not too bullish here. Maybe I'll just give it a pass. If you already own the stock, place a stop loss somewhere around 67.50. If that is taken out on the downside, I think there will be further downside in the stock. If you're looking to play this space, maybe a VRL logistic is something which is looking very interesting to me. After a big up move, decent number, stock at open gap, it has covered up that gap. I think offers an excellent risk to reward, can be bought at current levels with a stop loss at 540 on the downside for a target of 660 to about 680 on the upside. As a disclosure, this is one stock which has been recommended to our clients, so they might have it in their portfolio.
Okay, I want to talk with Aditya Agarwal a bit about defense. Aditya Shah earlier said that he's not interested in defense stocks, but look at that entire pack. And what's probably also fueling it are a couple of things. Prime Minister spoke today and talked about how Operation Sindoor is now going to focus on the Make in India movement, another boost to defense. This story in the Times of India today, which has helped defense stocks, saying 44,000 crore rupees is the size of the plan to build indigenous specialized warships that will detect, track and destroy underwater mines. They call Minesweeper. So apparently that is back on track. Add to that BDL. I want to look at BDL specifically because I think numbers are expected for Bharat Dynamics. Aditya, when you look at the defense pack, and I mean this is a story that has sustained for the last 2 weeks. You could say that, okay, Operation Sindoor has bumped it up, but it has sustained as well. Is there anything that you would look at for a short, medium and long-term play? Let's look at all three scenarios.
Definitely, Tamanna. There is a lot of stocks, in fact, within the space which look interesting to me. In fact, some of them are smaller plays, but they have the potential to become sizable if you look at their order size. And purely going by the chart setup, I will name few of them which do stand out for me. So BEL, BDL, both of them are right there at the top for me in the pecking order, and I think both of them should be there in your portfolio from a longer term time frame. If I can talk about 2 to 3 years. From here on, I see BEL maybe hitting a level of 450 to about 500 on the upside. So any declines here should be an opportunity to go long. Not at current levels, trading at extremely overbought levels, but closer to about 370, 365, you can latch on to BEL. Same holds true for BDL. I think augurs. So at current levels, I think one can actually initiate fresh long, closer to about 1850. Add further to the position 2200 is something that we are eyeing on BDL. Coming to slightly smaller plays, I think Apollo Microsystem is something which is looking very good to me. Again, these are some of the stocks which would be recommended to our clients and might be in their portfolio at current levels. I think so. It again can be bought for a target of 250 on the upside. Looks interesting to me. From the shipbuilding companies, I think look at Mazgaon Dock. That looks very interesting to me. And at current levels, you can latch onto it. Some part of it, maybe do a staggered buying as far as Mazgaon Dock is concerned. Closer to about 3320, 3200, you can buy more for a target of 50. 4,500 to about 5,000 on the upside. So these are some of the mid to large plays which I have. Apollo Microsystem and Mazgaon Dock are medium to shorter term plays, whereas BDL and BEL are slightly longer term plays.
You want to comment on this, Aditya? On just looking at the kind of spends that we will see, do you think that that's already priced in for defense? Aditya Shah.
Yeah, exactly. So these companies will end up making a lot of money over the next 5 to 10 years. But as I said, if you buy these companies at a very expensive valuation, there is a good chance that these companies can undergo a time correction of next 2 to 3 years, post which there could be a move. So from my perspective, the near term 2 3 years of good earnings is already into these stocks. Mind you, let's say a BEL was not available at these valuations about 3 to 4 years ago. The growth is already now being priced into the valuation multiple that you are giving it. So let these stocks have some breather, post which you can definitely try to add these stocks. But defense continues to be a longer term structural theme over the next 10 to 15 years per se. Indigenization of defense is a strong play that is coming.
By the way, today, the characteristic of the gainers is that a lot of these small sized chemical and pharmaceutical names have done well. So Camlin Fine is yet again up 14%, but you add to that what a Bayer Crop Science has done because of numbers, or a Suven Life has done, it's up about 10%. IPL, India Pesticides, is up 9.5%. There is Venus Remedies, which is doing well. Nectar Life, 8.5%. So a lot of these stocks have had some very, very interesting moves today. 8-9% seems to be the order of the day for a lot of these small cap pharma/chemical names. Aditya Agarwala, your top BTST idea, and if you like anything from this small cap pharma/chemical space.
Hi, afternoon, Neeraj. First, let's put up a BTST idea. Marico is something which is looking interesting to me. Can be bought for a BTST after a bit of a correction. Looks interesting for a target of 750 on the upside. Can be bought with a stop loss at 705 on the downside. Now, coming to a lot of these stocks that you mentioned right now, unfortunately, all of them have run up significantly in a very short span of time, trading at extremely overbought levels. Few of them I do like Suven Life Science has been on my radar, and but at current levels, we are not recommending the stock to buy anymore purely because it's overheated at current levels. On a decline closer to about 210, 200, I can look to go long on the stock. Apart from that, Nectar is also something which is looking interesting, and again, this is one stock which has shot up big time in short span of time. So maybe give it some time. If it comes down to 24, 25, maybe that can be a good time to go long.
Okay, Minda Corp numbers on your screen. Stock is actually coming off as the numbers play out. Revenue up 8.7% at 1,321 for Minda Corp this quarter. We're seeing quite a bump up, but you're seeing a slide the last few minutes. EBITDA at 10.3%. Margins have stayed all right, from 11.4% to 11.6%, so no big pain point there. But the profit number, I think, is the pain point. Yeah, there you go. Down about 26.5% at 52 crores. We'll wait to see some details on Minda Corp, but definitely you're seeing a bit of a slide there as well. Aditya Shah, is this a space that you're looking at, and Minda Corp in particular?
Yes, the auto ancillary space looks really very interesting. We need to look at the Minda Corp numbers very closely. But ancillaries like Recall, ancillaries like RSCL, Geartech, or Motherson as well, those companies who are export oriented will do pretty well over the period of next 2 to 3 years as all of the as Europe and US come out as a slowdown and they continue to do really well. So from my perspective, auto ancillaries is something that I'm really positive on over the period of next 3 to 5 years. We need to look at the Minda Corp numbers closely.
You know, the other one that we'll have to look out for is also Life Insurance Corporation, set to declare numbers later today. We are expecting the APE number, which is the annualized premium equivalent or the top line equivalent number, to grow by around 9% on a YOY basis at 23,052 crore. Your VNB, which is your value of new business equivalent to profitability or equated to profitability, is expected to be up roughly 12% and your VNB margins are expected around the 17.7% number versus the 17.2% number same time last year. Now, mind you, LIC in terms of margins used to do single-digit margins for a very long time, and that also was largely due to the fact that they never used to do non-par in a big way or non-participating products in a big way. Now that they've entered that, margins have inched up. The guidance is that they'll go to 20% soon in the next 2 years or so. That's the guidance. You want to again keep your eye out on how close they are to that and how long that they are going to take to get there. Is there a change there? Aditya Shah, you track life insurers closely, and some of them have really done well over the last few months. Strong outperformance, something like an SBI Life, HDFC Life also has done fairly well, from the lows up 30%. What's the sense like, and what's the expectation like from LIC? Is that a value buy at this point?
So the LIC stock performance will all depend on the VNB margin improvement. If the management guides for a good improvement over the course of this year, the stock will continue to do well. But I think it will be a slow and steady improvement. As you said, the pure risk product, which is a term insurance, which is a very, very high margin product, margins about 50 to 70% on those products. They need to ramp up the sales of term plan per se, which is a pure play risk product per se. So from my perspective, I tend to watch out for how the margins are progressing, and that will lead to the decision on LIC. So I will wait and watch on LIC. However, on the life insurance segment, as you said, HDFC Life stock has taken a breakout. The company is doing pretty well from a business perspective. It is the fastest growing life insurer, and LIC, the growth there is faster than LIC per se. So from my perspective, we continue to be positive on HDFC Life. LIC will be a value buy if the margin guidance, if the VNB margin guidance continues to be as strong as the street is expecting, and they hit 20% over the next 2 quarters. If that doesn't happen, the stock will stay here.
So we'll watch out for the VNB margin guidance. The numbers will come after market hours. We'll hear from the management tomorrow, so we'll watch out for that as well. Aditya Agarwala, HDFC Life versus LIC on the charts.
If I purely go by the momentum, yes, HDFC Life, Tamanna, because it's given a fresh breakout, and this is one stock which we have also recommended to our clients. But overall, I think life insurance companies are one to be watched out for, and for the entire 2025, I think so. Life insurance companies are something that one should clearly bet on. Two space I clearly like. One is life insurance, and one is housing finance companies. So names like PNB, LIC. I think these are some of the names that one should look at. So from housing finance companies and life insurance companies, I think these are the two spaces that I'm quite concrete on, and 2025 should be very good for these companies.
PNB Housing also in the mix. I'm wondering if we should also look at some of the IT names. A bad day for IT, one of the top losers. For a short-term kind of a momentum strategy, Aditya Agarwala, would you look at some basic strength in any of the IT majors?
Mid-cap IT stocks, yeah, they're definitely looking good, Tamanna. Coforge as the top bet for within that space. I think matter of time before it breaks out of that resistance zone of 8,100. I'm looking at a target of 9,400 on the upside as far as Coforge is concerned, and this is a good time to add the stock because you're seeing more of a consolidation than anything else. So once the consolidation phase is over, you will see levels of 9,400 with a stop loss at 8,200. I would recommend a buy in Coforge.
Buy in Coforge. That's very interesting. As we wrap up, Aditya Shah, I haven't asked a question to you, but I heard you speak about chemicals, right? So very quickly, is it the smaller names that you're going for? Is it names with some CDMO attached you're going for? What is it that you like and why?
Gujarat Solar Chem has reported its numbers today, and the numbers I don't think are as strong enough as SRF or Navin Fluorine were. So it's a mix. It's a mix of larger, stronger plays and some smaller plays. So my top pick continues to remain Navin Fluorine. Navin Fluorine has done pretty well this quarter as well, and the Honeywell partnership will bear fruits over the period of next 2 to 3 years. That is one of my top picks within the chemical space. Another company which has done pretty well is Vinity Organics. This quarter the results were fantastic, and the company is guiding for about 25 to 30% growth for a period of next 2 to 3 years. So that is also one of the stocks that looks really very interesting to us. And then if you go on to the smaller place, the CDMO place per se, in CDMO, of course, you cannot ignore the likes of Syngene and Divi's. Those who are doing pretty well, and Divi's results this quarter were fantastic. And the new capex that they have announced will make sure that over the period of next 2 to 3 years, DVs also will continue to do well. So from my perspective, sticking to larger and stronger places where businesses are really very strong, that's where the real mode is within the chemicals and the CDMOs.
Okay, thank you so much, both of you, for joining us this afternoon. Thank you, gentlemen. Quickly looking at how we're shaping up at close, where, of course, it's been a tough day, around 0.8% lower on the Nifty 50 index. Okay, maybe 0.7. 24,840 odd is where we are settling in at, 160 points lower. Let's look at it intraday as well, because from 24,750 we've bounced from the lows around 80 points odd. It's surely not a range bound day of trade. There's been plenty of spikes there pretty much through the day, and from the high point of 25,062 we've of course fallen quite a bit, 200 plus points. So that's the other way to look at it, of course, is the fact that we are off the day's lows for sure. Let's look at the heat map as well on the Nifty 50 and try and zoom in. Of course, some flavor in terms of gainers, but no sector per se, no single sector dominating. What's not doing well, and Ultratech, no doubt, after possible cement prices, or rather price hike being stemmed due to the monsoons. But outside of that too, several stocks, but no major movers on either side of the fence. You had an IndusInd Bank up 2.5% and an Ultratech down around 2.5%. So those were the 2-3 big winners. Let's look at it sector-wise now. In terms of sectors as well, when you're looking at the defense index, yes, that one stood out, but outside of that, quite a tepid move across the board. What were the top losers? Auto and FMCG were the top losers. IT also saw a bit of a reversal after yesterday's gains, so around 0.7% lower on the IT index among the heavyweights. The Nifty Bank also not doing too well, 0.4% lower, slightly better than the Nifty, of course, and the Nifty Private Bank also not too far behind. So that's how it played out. Now let's look at the advanced decline and thereafter look at how the broader markets have fared. The advanced decline largely even Steven kind of somewhere somewhere stabilized midway through the day. Prior to that, there was plenty of volatility, at least within broader markets. Let's look at the Nifty mid-cap and small-cap index. That shows the volatility there, and around 0.1% higher on the Nifty mid-cap. Some bit of positive bias, clearly doing better than the Nifty 50. The small-cap index also around 0.1% higher thereabouts. Let's look at the BSE 500 top gainers, top losers. And that's how it shaped up. A large part on the back of numbers. Let's look at ITI, Bayer Crop, all of those doing well. Even a GSK Pharma doing fairly well for itself. But in terms of the losers, a Sumitomo Chemicals, a TTK Prestige. TTK Prestige's numbers far cry from what we're used to, and therefore 5% lower on the stock after that intraday fall that we saw. Even a Blue Dart was down 5% on the back of numbers. MedPlus Health down 3% as well, and a Polymed down 2.5%. Again, as you would see, no large movers, a few large movers, and followed by okayish moves across the index. That is the big one. There's going to be a dividend announcement, or rather, there's going to be dividend record date of around 8 rupees of dividend that ITC is going to be distributing. You saw a bit of action on the counter today as well. A Sundaram Finance and a Colgate too, on the back of interim dividend, will likely see adjustments. A Gandhar Oil Refineries shares to exit lock-in, anchor shareholding. So keep your eye out on that one tomorrow. And those are some of the numbers which one would need to expect. Some of the numbers that I'll be looking out for, something like a Bata India, Cummins India as well, will be in focus. Then of course there's an LG, a Hinduja Global, a Natco Pharma, and Welspun Corp. That one will also be on our radar. But with that, completely out of time on this edition of India Market Close. From Tamanna, Neeraj, myself, and everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side as Himakshi takes up Market Express. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. Viewers, the benchmark indices such as the Nifty 50 and the 30-pack Sensex ended Tuesday's session with cuts of about 0.7% each. Now both the indices concluded trades significantly below their intraday highs. The broader markets ended almost flat but with a positive bias, thereby outperforming the benchmarks. Now more than half of the sectoral indices ended with losses. FMCG, auto and IT lost the most steam. The top draggers in the Nifty 50 basket were HDFC Bank, ICICI Bank, Reliance, ITC and Axis Bank. Now while the top gainers were Jio Financial Services, IndusInd Bank, Trent, Sun Pharma and Adani Ports, the market breadth ended skewed in favor of the declines. Rupee closes weaker against US dollar, settles 25 paise weaker at 85.34 against the greenback. Tyre stocks face margin pressures in FY25 with companies like Apollo Tyres and JK Tyre reporting significant profit declines. Now, despite the challenges, natural rubber prices are easing, offering potential relief for the sector. MRF and CEAT remain optimistic, expecting market share gains and growth in Europe. Brokerages show mixed sentiment, with JK Tyre having the highest return potential at 14.2%. Anand Rathi's Mumuksh Mandlesh forecasts strong growth for tyre companies, expecting margin improvements and double-digit export expansion. He highlights MRF and CEAT as preferred stocks in the sector over Apollo. Monsoon onset stalls cement price rise in South India. It can dampen cement demand in South India. To boost the sales, dealers planning to offer discounts from margins. Companies like Ramco Cement, Dalmia Bharat and Ultratech comparatively have a higher concentration in southern part of India. Bayer Crop Sciences stock surges over 10%, fueled by a strong Q4 of performance. Now revenue rises 32.1% to 1,046 crore rupees, while net profit jumps 49.3% to 143 crore rupees. Now EBITDA soars 75.4% to 170.8 crore rupees, lifting margins to 16.3% from 12.3%. Now the company delivers robust spring corn results and double-digit growth in crop protection liquidation, despite an OCI loss of 42 crore rupees against last year's 37 crore rupees income. The Supreme Court upholds an order favoring Adani Power, granting compensation for increased operational cost in a Rajasthan project. The Jaipur Electricity Board had signed a power purchase agreement, but Adani Power sought relief after Coal India imposed evacuation charges. Now, the court ruled in Adani Power's favor earlier, recognizing a change in law. The company now secures victory at the Supreme Court as well. KC International delivers a stellar Q4 with net profit soaring 76.8% to 268 crore rupees, driven by inventory clearance and other comprehensive income. Revenue climbs 11.5% to 6,872 crore rupees, while EBITDA surges 38.9% to 539 crore rupees, boosting margins to 7.8% from 6.3%. The company boasts a robust order book of 33,000 crore rupees, with FY25 order intake up to 36% to 24,600 crore rupees, and secures over 2,000 crores in FY26 orders. Now, a dividend of 5.5 rupees per share is also announced. Vimal Kejriwal, MD and CEO of KEC International, attributes the margin growth to robust performance in the T&D business, saying that our T&D segment has significantly bolstered both the revenue and our order book. Looking ahead, he's optimistic, stating that we expect margins to stabilize at 7.5% in FY25, with a target to improve to 8 to 8.5%. He also highlights plans to reduce debt by 500 crore rupees and increase international order intake to 40%. Electra Greentech stock faces pressure as the Maharashtra government cancels a 5,150 e-bus contract after the company fails to deliver a revised 1,000 buses by May 22. Now, Maharashtra Transport Minister Pratap Baburao Sarnaik also says that there is doubt about Electra's future supply capacity. The company, which has not yet filed an exchange update, sees its share slide amid concerns over its delivery capabilities. Blue Dart Express sees revenue climb in Q4, but rising costs weigh on the profit. The company names Sagar Patil as the interim CFO and declares a dividend. Freight, employee benefits, and depreciation push expenses higher, impacting the earnings. Now, despite hurdles, Blue Dart says that it's focused on growth, prioritizing network expansion and digital upgrades for the year ahead. Info Edge reports a 667% year-on-year surge in its consolidated net profit, reaching 463 crore rupees for the March quarter compared to 60 crore rupees in the same period last year. Now, the profit is attributable to the company's shareholders. Revenue from operations for the quarter stood at 750 crore rupees, marking a 14% year-on-year increase from the 657 crore rupees reported in the corresponding quarter of the previous financial year. Minda Corp reports mixed quarter for earnings, with net profit declining while revenue and EBITDA show steady growth. Margins remain stable at 11.6%, reflecting consistent operational efficiency. Action Construction delivers a strong Q4 performance, maintaining solid margins and reinforcing its leadership in the mobile and tower cranes. Now, the company sees major opportunities in the defense sector, securing an order from the Ministry of Defense for rough terrain forklifts. Now, with steady growth and strategic expansion, it also continues to strengthen its market position. Brain B Solution reports a wider Q4 of loss, with net loss rising to 76.7 crore rupees. Revenue climbs 15.8% to 1,930 crore rupees, but EBITDA drops sharply, pulling margins to a 6-quarter low of 0.82%. Now, higher employee and other expenses, along with elevated ESOP costs and an exceptional loss of 36.7 crore rupees, weigh on the profitability. A shorter winter and slower offline sales add to the pressure. Vadilal Industries faces margin pressure in Q4, hitting a 4-year low. Despite revenue growth, higher raw material costs weigh on the profitability. EBITDA declines and net profit sees a sharp drop. Rising expenses continue to challenge margins, reflecting cost pressures across operations. Capacite Infra Projects reports a mixed Q4 with profitability supported by higher other income. Despite revenue growth, margins hit a 15-quarter low as operational costs weigh on the earnings. Net profit also sees a slight uptick aided by non-operating gains. The company reaffirms leadership stability, reappointing Rahul Katyal as the MD. India Pesticides shines in Q4 as EBITDA margins expand significantly. Driven by lower employee costs, the company reports strong revenue growth, with EBITDA surging nearly 9-fold, boosting margins substantially. Now, net profit also sees a remarkable rise compared to last year's modest figure, reflecting a robust financial turnaround. Bajaj Healthcare delivers a strong Q4, swinging to a profit after last year's loss, fueled by robust revenue growth. Now, the company faces challenges from rising employee costs, which pressure EBITDA and compress the margin significantly. Despite this, the stock actually captures strong market interest, with trading volume surging to over twice its 30-day average, signaling a heightened investor focus on its turnaround performance. Aurobindo Pharma's Q4 con call highlights robust revenue growth of 10.6% to 8,382 crore rupees, fueled by strong volume, new product launches, and solid performance in the US and Europe markets, says the company during their earnings con call. Now, the formulation business, making up 87% of its revenue, grows 12%, while the API revenue rises 5% due to increased volumes. Now, despite one-time expenses squeezing margins to 21.4%, stable raw material cost and a better product mix support gross margins, now the company notes.
Shilpa Medicare reports revenue growth in Q4, but earnings take a hit due to weaker licensing income. Margins also slip as licensing revenue declines sharply, impacting the profitability. Despite this, the company sees long-term potential in its CDMO business, expecting licensing income to stabilize over time. Sumitomo Chemical reports modest revenue growth in Q4, but higher employee costs weigh on the profitability. EBITDA declines, pushing margins lower. While the net profit sees a dip, the company also continues to navigate cost pressures across its core operations in insecticides, weedicides, and fungicides. Jefferies maintains a cautious stance on the chemical sector, expecting flat demand and stagnant revenue growth in the calendar year of 25. Now, pricing pressure weighs on the Latin American markets, while Chinese agrochemical exports remain high with mixed crop prices. Refrigerant gas markets stay flat year on year. PI Industries faces slowing pharma growth, while Navin Fluorine stands out for its strong earnings from the long-term contracts. SRF also grapples with high valuation and limited earnings visibility. Despite these challenges, Jefferies have named PI Industries and Navin Fluorine as its top chemical picks. CLSA boosts its outlook on Max Financial, upgrading it to a high conviction outperform. Now, the firm also sets a target of 1,800 rupees, highlighting Max Life's rapid growth as India's fastest expanding life insurer. CLSA anticipates stronger contributions from the agency channel and removes the holdco discount, enhancing the company's valuation. With these factors in play, Max Financial secures its spot as CLSA's top life insurance pick. Borana Weaves makes an impressive stock market debut, fueled by strong investor interest in its IPO. Priced at 216 rupees per share, the offering sees remarkable demand, with non-institutional investors subscribing 237 times. Retail participation surges to 200 times, while qualified institutional buyers subscribe 87 times. The company, specializing in synthetic grey fabric, steps into the market with a valuation of 14.7x PE, reflecting investor confidence. OYO is gearing up for a fresh IPO attempt, with discussions underway with the bankers. The company eyes a listing in the last quarter of the financial year with a potential valuation of $6 to $7 billion. Informal talks began last month, and OYO is now inviting pitches from investment banks. The decision on filing its DRHP could actually come between August and September, depending on its financial results. SEBI sets new rules for equity derivatives expiry, restricting it to Tuesdays or Thursdays. Exchanges can pick one weekly benchmark index option contract for the expiry on their chosen day. Any changes to the current schedule require prior approval. Now, the framework also aims to create more streamlined and consistent expiry process across the markets. Top infrastructure lenders plan to urge the RBI to ease project financing norms, advocating for sector-specific provisioning. They also, the proposed is to remove the one-size-fits-all approach and aligning the norms with the IFRS expecting credit loss models. Now, the lenders also seek the removal of extra provisioning once the projects become operational. RBI had earlier proposed raising provisions for construction phase projects to 5% from 0.4%. Finance Minister Nirmala Sitharaman is set to meet industry leaders today to discuss the GST reforms. The closed-door meeting will focus on rate rationalization, the future of compensation cess, and broader structural changes in the GST framework. Now, the government seeks inputs from India to shape the next phase of tax reforms, aiming for a more streamlined and efficient system. Balrampur Chini Mills has launched Balrampur Bio Yug. The company says that it is the new era which will signify biocircularity and the revenue is also expected to rise up to rupees 2,000 crores from the PLA unit in Uttar Pradesh. Now, the company also witnessed the largest downswing in sugar production has come from south because of the climate last year. Indigo Airlines co-founder Rakesh Gangwal along with the promoter entity are planning to offload a 5.5% stake in Interglobe Aviation. The stake is worth rupees 6,833 crore rupees, which will also be sold via open market transactions. Now the floor price for the Indigo block deal is set up at 5,175 rupees per share, making it a discount of 4.5% to the last closing. Now multinational investment banks like Goldman Sachs, JP Morgan and Morgan Stanley are handling the deal. Garden Reach Shipbuilder states that the Bangladesh government has cancelled its 180 crore rupees order without providing a clear reason. Now, the contract issued by Bangladesh Ministry of Defence was for an advanced ocean-going tug scheduled for construction and delivery within 24 months. Mumbai is under a yellow alert today as the monsoon intensifies over western India, bringing heavy rainfall. The city has broken a 107-year-old record for May rainfall, with downpours affecting multiple areas. The weather department confirms that this is the earliest monsoon arrival in 69 years, marking an unusual start to the season. Maharashtra continues to battle with monsoon as heavy rains claimed 5 lives and left 1 person missing across the state. Mumbai, Thane, Palghar and several Konkan and western regions remain severely affected. The Indian Meteorological Department warns of intense rainfall across multiple regions this week. Parts of the northeast, Sikkim and sub-Himalayan Bengal brace for extremely heavy showers. Central Maharashtra faces very heavy rain until Thursday, while southern and western India see similar conditions through Monday. Now, Kerala is also set for extreme downpours until Friday as the monsoon strengthens across the country. In a major boost to India's higher education landscape, the University of Liverpool gets UGC approval to establish a campus in Bengaluru. Now, this marks the second foreign university to set up a base in India after the University of Southampton. Now, Union Education Minister Dharmendra Pradhan has also given the letter of intent. Admissions for undergraduate and postgraduate courses will also start from August 2026. Mumbai police received a bomb threat call claiming that Mumbai International Airport would be blown up. Police and bomb squad teams searched the area but found nothing suspicious. A case has been registered and efforts are underway to trace the unidentified caller, says the Mumbai police. Now, US Embassy in India warns Indian students of revoking their visas if they drop out, skip classes or leave their program without informing the university, and adds that the students may also lose eligibility for future visas. Japan loses world's top creditor spot to Germany after 34 years, despite its net external assets hitting a record of 533.1 trillion yen in 2024. Germany has surpassed it with assets totaling to 569.7 trillion yen. Now, China also follows in third place with 516.3 trillion yen. The shift marks a significant moment in global economic rankings, highlighting Germany's growing financial influence on the world stage. Firefighters in Ecuador have successfully extinguished a fire at the country's largest oil refinery in Esmeralda. Now, the blaze, which also broke out on Monday, prompted an evacuation of the site. Local officials confirmed that the fire was brought under control after several hours with no injuries reported. Authorities have also launched an investigation into the cause of the incident. The Esmeralda refinery, built in the late 1970s, processed around 110,000 barrels of crude oil per day. A terrifying incident unfolded in Liverpool as a driver plowed into a crowd of soccer fans celebrating the team's English Premier League championship. Now, the police also confirmed that the multiple pedestrians were hit and have launched an investigation into the crash. A widely shared social media video appears to show a grey minivan striking at least one person before surging through the crowd, pushing people along the street before finally stopping. Authorities are also continuing their inquiries into the incident. Tesla's European sales plunges 49% in April, with companies selling just 7,261 cars according to the European Automobile Manufacturers Association. Now, the drop comes amid brand challenges as CEO Elon Musk's political ties with US President Donald Trump have reportedly impacted Tesla's reputation. At the same time, the company is facing intensified competition in the European market with shifting consumer sentiment and a growing field of rivals. Tesla's foothold in Europe faces mounting pressure. A brief moment between French President Emmanuel Macron and First Lady went viral as she playfully pushed his face while they disembarked in Hanoi. Now, the president later clarified that it was a light-hearted gesture, and the LC Palace confirmed that reflected their affectionate relationship. Now, this incident highlights how quickly personal moments can spread in the digital age. Punjab Kings defeated Mumbai Indians in the final face-off of both the teams. Mumbai Indians batting first put up a score of 184 runs, batting for 20 overs, while the Punjab Kings chased down the score in just 18.3 overs with a loss of 3 wickets. Now, with Josh Inglis being the highest scorer, having 73 runs off just 42 balls. Lucknow Super Giants will play Royal Challengers Bengaluru today as the final league game before the qualifier starts. The match will be played at the Ekana Stadium in Lucknow at 7:30 p.m. today. Royal Challengers Bengaluru have already qualified for the qualifiers, being on the 3rd position. Now, they will try to win this game and make it to the 2nd spot, giving them a safe position in the qualifiers. Filmmaker Boni Kapoor submits the building layout for the highly anticipated Film City project in Noida Sector 21 as confirmed by the Yamuna Expressway Industrial Development Authority. The plan features a film institute, an underwater studio, a festival zone and guest accommodation. Boni Kapoor assures that construction will align with the concession agreement guidelines. The project is a significant move towards establishing Noida as a major cinematic hub. Now, with that, viewers, it's a wrap on Market Express. Stay tuned to NDTV Profit as there's more lined up ahead on the other side.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio.
Benchmarks end lower after gaining for 2 sessions. FMCG ends as the top sectoral loser, with ITC dragging the stock lower. Mid-caps gain marginally while the small-cap index closes flat. The Supreme Court rules in favor of Adani Power, allows it to claim compensation under the change in law clause
of its power purchase agreement with Jaipur Vidyut Vitran Nigam. The Maharashtra government cancels a massive e-bus contract with Olectra Green Tech after the company fails to deliver buses as per the agreed timeline. State Transport Minister Pratap Sarnaik says the government will soon serve a notice to the company. Intra-lenders seek relaxation in lending norms from the RBI. Sources say they have urged the use of sector-wise default probabilities, loss estimates by rating companies for provisioning. Government restores tax and duty benefits worth over 18,000 crore rupees under the RoDTEP scheme for exports. Benefits applicable to all eligible exports made from the 1st of June. The Prime Minister in Gujarat takes a dig at Pakistan, says the Indus Water Treaty is badly negotiated and the suspension is making Pakistan feel the heat. The US Embassy in India warns Indian students of revoking their visas if they drop out, skip classes or leave their programs of study without informing the university. Adds that the students may lose eligibility for future visas. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's take a look at how the markets fared today. After gaining for 2 straight days, both the Nifty and the Sensex ended lower. Most sectoral indices ended lower as well, with FMCG plunging the most. Defense, however, rallied more than 1%. And now my colleague Harsh joining in to give us a quick wrap of the day's action, what dragged the markets and counters to watch out for. Harsh, over to you.
Well, surely pressure on the index today. We saw nearly 1%, or rather 1% plus wiped off the index at the day's low. We saw a bit of a recovery as well from that low slightly later over the next hour or so of trade. But nonetheless, we saw around 160 odd points wiped out on the Nifty 50. The breadth on the Nifty 50 was difficult. Very few gainers, around 40 losers for 10 gainers that we saw on the Nifty 50 index, and no particular trend being seen in that sense. Of course, defense within broader markets was a big trend at play, 1% higher on the Nifty defense index yet again. So we've seen that that index continue to gain traction. But outside of that, you saw some of the other laggards within the large cap basket being FMCG and IT. And the Nifty Bank was somehow trying to hold on, but couldn't, and was down just about 0.4 odd %. So slight bit of outperformance versus the Nifty 50 index, but not a good day of trade either for the Nifty Bank. So that's how it played out. When you're looking at stock specific action, largely driven by earnings today, frankly, the Nifty mid cap and small cap index saw some bit of respite, where saw a bit of a bounce back from the lows of the day. The Nifty mid cap was up just about 1/5 of a % to 1/10 of a %, and similar number for the small cap index as well, 0.1 to 0.2% higher on both of those. But when you're looking at the way the Nifty 50 index has performed, that was a bit of an outperformance that we saw from both of those indices. So broader markets doing better or faring better in trade today. Broadly, in terms of stock specific action, as I did mention, largely driven by numbers. Some names on your screen, something like a TTK Prestige came out with numbers, a Brainbees too came out with numbers, and both of those were punished on the back of slightly weaker numbers. On the other hand, ITI has done fairly well for itself in trade today, among other counters, of course.
So in terms of the earnings delivery, the March quarter, the earnings have been quite up to the mark, in the sense that they have met the expectations, but as we know, the expectations itself was very low in terms of single digits earnings growth, but generally they have met the earnings expectations. So now we are looking forward to FY26, and the earnings growth is generally now in the about 11, 12, 13%, that ballpark, which has been a downgrade of about 3% in the last 6 months or so. And of course, we are looking forward to some of the positive triggers which are lined up.
Now, the Supreme Court has upheld the appellate tribunal for electricity's order allowing Adani Power to claim compensation under the change in law clause of its power purchase agreement with Jaipur Vidyut Vitran Nigam. Somit now joining us with more details on this.
Well, yes, it's important and positive news that has come in for Adani Power here. Now, Supreme Court has affirmed that the appellant's order, which was earlier in favor of Adani Power, will remain, and they have dismissed the appeal that was filed by Jaipur Vidyut Vitran Nigam. Now, Supreme Court is of the view that power generators are entitled to claim compensations and late payment surcharge based carrying cost under power purchase agreement for cost escalation resulting from the regulatory changes, which means that if there is any regulatory change because of which a power generator is seeing an escalation in cost, they are eligible to claim that extra cost from the state. Now, the bench of Justices M.M. Sundaresh and Rajesh Bindal had the case regarding this dispute, which was around the power purchase agreement between Jaipur Vidyut Vitran Limited and Adani Power Rajasthan Limited for supply of 1200 megawatt of power at a fixed tariff. Now, given that this agreement was under fixed tariff and Adani Power had claimed this compensation, this was filed the case was filed with the APTEL, but Adani Power had sought compensation under the PPA's change in law clause, and this was because under the same clause, Coal India had also imposed an additional levy of around 50 rupees per ton on coal charges. Thereby, Adani Power's cost had increased, and this increased cost was something that Adani Power was claiming from the state government, and this claim was already approved by APTEL, that is the Appellate Tribunal for Electricity. However, Jaipur Vidyut Vitran Nigam had appealed this decision of APTEL in Supreme Court, and now Supreme Court has also dismissed this appeal and given the decision in favor of Adani Power, which means that whatever claim that they are asking from the state government will be given to Adani Power going forward.
Thanks so much for that, Somit. And after a challenging FY25, tyre stocks have remained underweight, weighed down by high input costs and sluggish demand. However, projections for FY26 are signalling a turnaround, with the sector outlook improving as rubber prices ease and order inflows rise. Puneet now joining us with all of the details.
Well, it's been a bumpy road for all the tyre makers in FY25, but the next year seems more promising because of lower costs from natural rubber prices, with that declining as well. Apart from, that demand conditions are also improving. But let's first look at FY25 as a year, because specifically we've seen Balakrishna Tyres have the highest growth in terms of revenue at 13% versus peers like MRF as well as CEAT, which are in the double-digit range of between 10 to 11%. In terms of EBITDA though, Balakrishna Tyres is the only listed tyre maker which has seen actually an increase in EBITDA margins by 50 basis points in FY25. They also have the highest EBITDA margin percentage essentially at 25%, because 70% of the revenue comes from the off-highway tyre space. In terms of profit as well, the company has the highest at 13% growth amongst the listed players. And when you look at the other ones like MRF, like a CEAT and Apollo as well, we've seen margin impact of more than 200 basis points, and that's largely because of slower demand as well as higher cost of natural rubber in India. When you look at the second key aspect, which is the guidance, all players are actually quite optimistic for FY26. MRF is expecting market share gains in two-wheelers as well as the truck and bus radial segments, while CEAT is positive on FY26 and actually expects growth meaningfully in the export segment. Interestingly, JK Tyre management has guided for a double-digit growth in terms of revenue in FY26, and that's one of the key aspects from the valuations as well, which is the final thing I want to address. Valuations for both Balakrishna as well as MRF is the highest, between 25 and 26 times price to earnings for FY26. What's also interesting is that on the other hand, we have players like JK Tyres that trade at almost 50% of that, just at 10 times price to earnings, and market is giving you an opportunity between the 10 to 26 times price to earnings range to take your pick wisely in terms of growth as well. We've seen both CEAT as well as Apollo Tyres are trading between the 16 to 18 times price to earnings, so definitely a lot of options in the tyre space. But the key aspects will be that FY26 is a year of growth, and that is upwards and onwards for the space going forward.
Absolutely, Puneet. And let's take a look at what's happening in the paint sector, which is undergoing a major consolidation with 10,000 crore in fresh capital investments. However, market leader Asian Paints is losing ground as the competition intensifies. Which company is painting a brighter future? My colleague Sajid joins in with the details.
That's right. The paints business is now heating up. In FY25, it was one of the, a blockbuster year with respect to the capex coming into the industry. The paint sector itself saw a capex of more than 10,000 odd crores, led by new entrants like Grasim through Birla Opus, and there were other smaller players which were adding more capacity to get into the premium and luxury segment there. We had 3 new entrants that came into the paint segment, with Birla Opus being one. Then you have JSW, and then there were smaller players like the Kamdhenus and others who started some of the paint operations in this segment, and that led to a drastic churn of market share within the decorative paints market, which accounts for nearly 70% of the total paint industry there. If you look at it, Asian Paints, being the largest paint maker with over 50% market share, was the biggest loser in this thing at the end of the year. Birla Opus ensured that there was a dent in the premium and the luxury segment, and there were other players like a Berger, the Nerolac and Indigo, which gained market share in terms of revenue going into the year. What was important and striking was that the industry as a whole did not grow much. There was a stagnant market. It was a stagnant market. There was no organic growth. Urban discretionary spend was slow, and rural was picking up. If you look at the total revenue of the industry in FY25, and I'm talking of the 9 listed companies in the paint segment, the revenues grew by only just 2% in terms of absolute revenues there. So 9 listed companies' revenue went up by 2%, and incumbents, which are Bergers, the Nerolacs, and the Indigos, did gain some market share in terms of revenues. And there were, while profitability was hit because there was an extensive price war which was coming in, because every company was trying to maintain their market share in this lucrative market, which was a high margin business, premium and luxury segment being the one. If you look at the revenue market share, how it moved during the year, Asian Paints at the end of FY24 had a revenue market share of 58.5%. By the end of FY25, it came down to 54.5%. Berger, it had 18.2%, it went up to 18.6%, and there are slight variations with other players in the market there. But what is striking here is that the Q4 numbers were a little striking, because the leader in the pack, which is Asian Paints, came back to safeguard its market share, and we saw the revenue market share for Asian Paints just jump to 55.3%, and that basically shows the kind of hyper competition which is there in the market. Players are now vying for the limited demand which is coming in. From a dealer's point of view, the dealerships are not increasing. It's the existing dealer which is, bifurcating demand to multiple paint makers, and so everyone is vying for that demand. And as a result of that, hyper price competition is coming in, higher marketing and distribution spends are coming in, and that's denting the margin for the Asian paints industry. So going into FY26, you have a lower urban demand which is there. Rural is improving, and hopefully if the spends increase, then there is going to be some kind of relief for the paints industry.
And let's take a look at what's happening in Maharashtra. The state government will be cancelling its high-profile electric bus contract with Olectra Green Tech over delivery delays. Now, speaking exclusively to NDTV Profit, State Transport Minister Pratap Sarnaik confirmed the termination of this contract. Now, this pact, aimed at adding over 5,000 electric buses to the public transport fleet, was actually signed in January 2024 and required Olectra to deliver more than 2,000 buses by now. But the company has only managed to supply around 220. Now, Minister Sarnaik said that the state had expected at least 1,200 buses by May 2025, a target that also went unmet. With mounting pressure on public transport infrastructure and rising commuter demand, especially in cities like Mumbai and in Pune, the state says it cannot afford further delays. The government is now seeking legal advice and moving forward with the formal cancellation of the deal. Let's listen into that interview.
जनवरी 2024 में उनके साथ हमारा एग्रीमेंट हो गया था और अब तक करीबन 2 से 2,500 बसेस आनी चाहिए थे और उस माध्यम से हमने तैयारी की थी कि वो अगर बसेस आएंगे तो हम लोगों को उतनी सर्विस दे सकेंगे, मगर उसकी वजह से हमारा पूरा का पूरा जो प्लान था वो कोलैप्स हो गया, क्योंकि 220 बसेस खाली उनकी आई है और बाकी की बसेस के लिए हमने 2 बार उनको लेटर भी दिया, फिर भी अभी तक बसेस आई नहीं है। मई एंड में उनके करीबन 1250 से 1300 बसेस आने की उम्मीद हमें थी, मगर वो भी एक भी बस उसमें से आई नहीं है। तो आखिर कितने दिन महाराष्ट्र शासन भी उनकी इंतजार करते रहेंगे कि आज नहीं तो कल वो बसेस देंगे। इसलिए हमने कल डिसाइड कर दिया कि हम ऑफिशियल अभी लीगल एडवाइजर के पास फाइल भेज रहे कि उनका जो एग्रीमेंट है वो अगर कैंसिल करते हैं तो कोई कानूनी कार्रवाई हो सकती है क्या, क्योंकि अगर उनका एग्रीमेंट कैंसिल करके हमें किसी न किसी के पास से बसेस तो लेनी ही पड़ेगी, क्योंकि हमको लोगों को सर्विस देनी है।
Right, it remains to be seen now what happens to the plan of electric buses in the state of Maharashtra. Moving on, the Industrial Safety Department has ordered the closure of Jindal Polyfilms Nashik plant following a massive fire that severely damaged 70 to 90% of its production lines. Thick smoke has been rising for 6 days, sparking concerns over safety violations and environmental risks. Now, the government is taking serious note of the major fire at the plant, and the cause, however, remains unknown, while a full investigation is expected to take at least 3 weeks to complete. And on to an NDTV Profit exclusive. Sources tell us that the top 9 infrastructure lenders will be writing to the RBI to ease project financing norms. They will also recommend the RBI to do away with the one-size-fits-all approach. Shubhana now bringing in all of the exclusive details.
All top 9 infrastructure financiers are actually planning to send the recommendations to the Reserve Bank of India to ease project financing norms. This is because they believe that the proposed stringent project financing norms could actually, stall India's ambitious infrastructure growth plans and could also, increase costs for developers. What they're asking is that the RBI should actually go for a sector-wise approach and look at probability of defaults and loss estimates that are published by rating agencies, and then ascertain the provisioning instead of going for a 5% provisioning on all existing and fresh project finance loans. Like you said, they're actually recommending the RBI to do away with a one-size-fit-all approach. They're also asking the RBI to actually look at data which is backed by banks and NBFCs and rating agencies and publish it publicly, which could improve transparency. They're also asking the RBI to align these norms with international practices and look at IFRS's expected credit loss model, which could actually avoid excess provisioning. What they're also saying is that the RBI should remove extra provisioning when a project actually reaches, is in operational status, when it is in stable cash flows. So these are the recommendations that they've made based on the proposed stringent guidelines that the RBI had come out with in May 2024.
Now, the government has reinstated benefits under the remission of duties and taxes on exported products, also known as the RoDTEP scheme, aiming to enhance India's export competitiveness. My colleague Rishabh now joining us with all of the details.
Right, Sanjana, what we've picked up from the Commerce Ministry is the fact that the RoDTEP scheme benefits have now been extended. This is a major boost for players in the steel sector, in the aluminum sector, especially the MSMEs operating in this sector. What is also very important to note here is that these benefits are now restored starting June 1st. And this has been done after various industry bodies, including the Aluminium Association of India, the Federation of Indian Miners, as well as the FICCI, which is a very, very large industry body. All of them had written to the Commerce Ministry asking for these ROTTEP benefits to be extended. Now, the only sticky point here for these companies is the fact that it has not been extended from the point that it was stopped at. So it was stopped at around February 6th. Industries were expecting for it to be reinstated starting February 7th, but it has now been restated starting June 1st. So this 3-month gap is sort of what companies are complaining about, because it is a problem of stability now and it's a problem of planning that these companies and industries are not able to plan very meticulously in terms of how to lay out their finances. So this is what we have coming in from the Commerce Ministry currently.
Thanks so much for that, but stay with us because we also know Finance Minister Nirmala Sitharaman is set to meet the Confederation of the Indian Industry today to discuss GST reforms with a focus on rate rationalization, compensation cess and structural changes. So Rishabh, if you could take us through the details on this, what exactly are your sources telling you? What could this meeting be about?
Right, Sanjana, this is expected to be a closed-door meeting. Expected to be sat into by various major representatives within the CII, the Confederation of Indian Industry, as well as the Finance Minister Nirmala Sitharaman also expected to be in presence. It will start at around 5:30. In fact, I'm headed to North Block right after this to track that from location as well. What we're also seeing is the fact that the FinMin will seek industry inputs, and CII being the industry in this case. And basically, this is to rehaul and overhaul the GST process currently. So this is a very important part of the public stakeholder consultation process part of this meeting that is currently happening. Well, like you said, the key 4 focus areas will be rate rationalization, future of compensation cess, whether that will be in effect as well. And also just broad structural reforms that might be expected to be seen in the GST framework going ahead. So a lot of them have been long-standing demands of the industry. So we will continue tracking this very important story coming out of them.
Right, Rishabh, thanks so much for that. And let's take a look at what's happening with the export sector. India's exports are projected to reach $1 trillion in FY26, driven by strong growth in both goods and services. Now, according to FIEO President S.C. Ralhan, who spoke with my colleague Rishabh just earlier, merchandise exports are expected to rise to $525 to $535 billion, while service exports could touch almost $475 billion. Let's listen into that entire interview.
We are expecting this year almost $1 trillion exports because the exports last year was good. In the service sector, it was very good. If we have 20% export in the service sector, maybe 12% in the product sector, I think we should be easily touching the $1 trillion. We actually, the tariff for the India is 25% for steel, aluminium and auto parts, and for other products for 10% till 90 days, till the 12th of July or probably July, first week of July. We are still much better. The tariff on China is 75% at the moment. So 25, I mean, we are much better.
Now, the Indian Met Department has revised Mumbai's weather alert from red to yellow as of 10 a.m. today. However, several districts across Maharashtra remain on high alert. A red alert continues for Ratnagiri, Sindhudurg, Kolhapur, Satara due to the risk of extremely heavy rainfall. An orange alert has been issued for Raigad, Pune, Beed, Nanded and Parbhani. Now, Mumbai, Thane, Jalgaon, Nashik and Jalna are also under a yellow alert. Citizens, however, are advised to stay cautious, follow safety guidelines and keep an eye on official updates. And if you're an international student and you skip classes, your student visa may be revoked. You also risk losing eligibility for future US visas. This is a stern warning that the US Embassy in India has issued to India and international students studying in the United States. Now, this is not a rule or a warning that is unknown. These rules are currently very much in place, but this is not a standalone advisory. My colleague Himakshi now joining us from the newsroom to put this in perspective of the current situation of immigration deportations in the US. Himakshi, why is this so crucial to note for Indian students? Let's remember that this rule already exists.
Absolutely, Sanjana. It's concerning for Indian students because they make the second largest population of international students in the US. So a large number of Indian students might have to face the brunt of this action if they don't comply with the visa norms. Now, let me just break it down for our viewers as to what really has happened. So the US Embassy has issued a stern warning stating that if students don't comply with the student visa conditions, their visas might get cancelled. Now, according to the advisory, students who drop out or skip classes or leave their programs without notifying the university might actually risk immediate revocation of their student visa, and they might not be eligible to apply for the US visas in the future as well. And this is not the first time that this has actually happened. Sanjana, earlier this month, the US Immigration and Customs Enforcement Department had issued warnings to international students on optional practical training, that is the OPT visas in the US. They clearly said that if they fail to report their employment within 90 days of starting their OPT, their legal status in the student and exchange visitor information system would actually be cancelled. So now, amid this mass deportation drive ordered by the US government, many colleges have warned international students to avoid traveling outside US in order to eliminate slight chance of getting their visas cancelled. Back to you, Sanjana.
Right, Himakshi, thank you so much for that update. We'll continue tracking that story and bring you all of the latest updates. Meanwhile, let's take a look at some of our other stories that are making news around the country. The Ministry of Civil Aviation has informed passengers that certain household items are now prohibited in cabin baggage due to security regulations. Items like air mattresses, chili pickles, crowbars, nightsticks, coconuts and scissors won't be allowed in cabin baggage. The ministry said these restrictions fall under a comprehensive classification system that divides items into 8 categories: weapons and replicas, explosives, dangerous substances, dangerous articles, tools, household items and sports items. This advisory specifically refers to the household items category. In a push to revive Jammu and Kashmir's tourism after the horrific terror attack that killed 26 civilians, the J&K government led by Chief Minister Omar Abdullah held a special cabinet meeting in Pahalgam today. This is the first time a cabinet meeting is taking place outside the traditional summer capital Srinagar or winter capital Jammu during the government's tenure. A suspected Babbar Khalsa terrorist died in an explosion while attempting to retrieve an explosive consignment in Mathija, Amritsar. The police confirmed this morning. His identity remains unknown, but the authorities have found clues in his clothing that may help establish his background. Officials suspect the blast occurred due to mishandling of an explosive, and investigations are underway to determine potential targets and possible links to Pakistan's ISI spy agency. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
Hello and welcome. You're watching KYC, which is Know Your Company. Today we're going to focus in on Jyoti CNC. It's a niche business again, and that's why it's very interesting. Took me some time to understand the business itself, but let's quickly dive down on what I want to know about this business more than anything else. It currently trades at 90 times price to earnings. Certainly not cheap by any standards. Question is, are valuations justified just given the growth potential? So that's something we'll try to answer, and of course we'll get insights from the management as well as to what they believe the growth trajectory is going to look like, and therefore what the potential is, and therefore whether valuations actually justify that kind of potential, because we are looking way out in terms of valuations or earnings multiples starting to normalize. So that's the one big piece that I want to understand. Second one, it's a specialized business. So what opportunities will it capture? Because as of today, it is the only component manufacturer selling to EMS companies, which is electronic manufacturing companies. Now, when you're looking at an opportunity which is that large and you are the only player, of course you are virtually like a monopoly. But what happens when other players start to eat your market share, at least the domestic market share for among the EMS business? And therefore that's something I want to really understand. What opportunities will it capture going forward, and what happens to the opportunities it's already captured? So something I'd want to understand. The third piece is with regard to Hurun, its manufacturing facility in France. Again, there's a big turnaround in Europe which is already at play. I want to understand whether that opportunity is getting adequately captured already with what the markets are anticipating, or is there a larger opportunity over the next couple of years? Because that opportunity we're not fully clear with regard to how large it is and how Jyoti will capture it, and therefore that's the other thing I'd want to understand. Working capital, there is some pressure with regard to working capital. Clearly your working capital days are way too high. You want that to come down. They've guided for it to come down in FY26. What gives them that comfort, and how much can they bring it down by? Because that is eating into cash flow from operations. We'll see it in the metrics, and that's the other thing I want to understand. The last piece is with regard to capex plans and funding. You have obviously this extremely large opportunity, but capex, just to put it into perspective, they're going to take 6,000 machines which they currently have a capacity for, and increase that to 16,000 in the next 12 to 15 months. That's a very, very large increase in terms of capacity itself. And therefore, what is the funding, sustainability of return ratios as they ramp up is really the question I will be asking. So large capex plans, how do you fund it, and what's thereafter, what lies is what I want to understand. So that's how it all stacks up with regard to what I want to understand. But let's quickly zoom into what the company does, and this is where it starts to get very interesting, and I'm going to try to break it down. Let's look at what it does. It is the leading manufacturer in India of 5-axis CNC machines. I'm going to try and break down what a CNC machine is. A CNC machine is a computer numerical control machine. Typically, when you want to make a niche component or part, think of it as an auto component, a nut, a bolt. You typically will need a 3-axis machine which goes on the side and down. A 5-axis allows for a rotation and a more nuanced component to get made. So that's a 5-axis machine. Jyoti is one of the players which manufactures this 5-axis machine, which allows the manufacturing of a component by the machine moving in all directions. There are of course 6 and 7-axis machines as well, which are far more or higher in terms of their niche, but the 5-axis itself is a very, very high niche product. In India, you have around 10 to 12% market share that Jyoti caters to, and 50% plus is catered through import. So the import substitution potential for this machine is extremely high. This is where it stands out versus some of the other players. It allows, these are broadly the type of products it manufactures. Okay, I won't get into the nuances of the products itself, but it's a niche component manufacturing capex machine, which allows you to manufacture niche components within the aerospace, auto, transport segments, right? Instead of the 3-axis, it uses the 5-axis. That should kind of cap it off. What does it enable? It enables complex design of machine parts. It enables high accuracy, reduced time, and it also enables lack of manual intervention. A lot of this is done completely automated, which is the big positive. Now let's talk about what it caters to and what industries it caters to. The new products that it caters to is medical devices, toys and drones, which is on your screen, but it's largely utilized in electronics, telecom, auto, aerospace, medical, transport. This broad breakup of where all it is utilized. Now I want to also talk a little bit about some of their clientele, because that gives us deep insights into what is the kind of niche product that it does. Its clientele includes HAL, which is HAL, Tata Advanced Systems, Airbus, you have a GE, a Rolls-Royce, a Safran, Boeing, again the defense manufacturing of Bharat Forge. You have a Tata Motors, a Mahindra within the auto space, a Volvo, a BMW, a Mercedes, an Audi, a Volkswagen, an Ashok Leyland, a Fiat, and then within even the others basket, you have something like a Harsha Engineers, you have a Titan, a Bosch, a Havells. So you get the kind of diversity in terms of clientele that Jyoti deals with, and broadly the components and parts used in some of these industries are what Jyoti helps. So it's a pure B2B, helps other businesses with. That's how it stacks up in terms of clientele as well. Now let me quickly also take you through its presence and its manufacturing. It has 2 facilities, one in Rajkot, where they have more land as well to allow them to grow, and the other one is in France. And this is their Huron facility in Strasbourg in France. They had bought this in 2007. Important to understand some dynamic around this. Okay, so let's first talk about the India capacity. They've grown the India capacity from 4,400 machines per annum to 6,000 machines per annum. Their current capacity utilization is around 85%. So it's nearly at full capacity utilization. There is an expansion plan in India to expand the current facility to enable manufacture of 10,000 more machines. So taking the total to 16,000. Okay, by end of this financial year, capex of 400 to 450 odd crore will be undertaken for this, and this capacity will come on stream as early as June 2026. So in the next 12 to 15 months, you'll likely see this capacity come on stream. Let's talk about Europe also a little bit. There's been some bottlenecking which has happened there. So the top line of around 400 to 450 crore coming from Huron will now go to 800 crore as a result of this debottlenecking. Again, this will happen maybe in the next 2 to 3 months. So we'll try to understand how these timelines will work and how demand is shaping up in both of these markets. But let's talk a little bit more about Huron. It was acquired in 2007 for 16 million euros. At that point, the top line was around 33 million euros. currently, and that top line was largely flat till 2019, so no change. But what they did was they utilized some of the R&D sitting in Huron in India to try and do product innovation, and that's exactly what's helped the numbers. So by 2023-24, Europe had also picked up. The order pipeline from 2023 to 2024 sitting currently is around 2,000 crore. So there's a large execution which is waiting to happen over there. And that's why that 800 crore push to potential top line looks likely, because you have a very large order backlog which is sitting there. Even in terms of how the market dynamic is working, it's a highly fragmented market. The top 10 players hold just 30 to 40% of market share. So that kind of goes to show that the potential to grow from where Jyoti is in terms of
हिस्सों में सामान्य से अधिक वर्षा होने की संभावना है, सिवाय उत्तर पश्चिम और उत्तर पूर्व भारत के कुछ क्षेत्रों, जहां की कुछ एरिया में सामान्य से नीचे वर्षा होने का संभावना दिखाई दे रहा है। तो इसको देखते हुए ये जानकारी दे रहे हैं कि लगभग ज़्यादातर हिस्से में नॉर्मल से एबो नॉर्मल रेनफॉल रहेगा भारतवर्ष में। सिर्फ नॉर्थ ईस्ट इंडिया यानी उत्तर पूर्व भारत और उत्तर पश्चिम भारत के कुछ हिस्से जैसे कि लद्दाख और एडजॉइनिंग एरियाज। जून महीने की बात करें तो पूरे देश के लिए जून की औसत वर्षा सामान्य से अधिक यानी 108% से अधिक होने का संभावना है। जून 2025 के दौरान देश के अधिकांश भागों में सामान्य से लेकर सामान्य से अधिक मासिक वर्षा होने की संभावना है, सिवाय प्रायद्वीपीय भारत के कुछ दक्षिण भागों, उत्तर पश्चिम भारत के कुछ भागों और पूर्वोत्तर भारत के कुछ खास क्षेत्रों में छोड़कर, जहां सामान्य से नीचे वर्षा होने का संभावना दिखाई दे रहा है। जून 2025 में देश के अधिकांश भागों में सामान्य से लेकर सामान्य से नीचे मासिक अधिकतम तापमान रहने की संभावना है, सिवाय उत्तर पश्चिम भारत और पूर्वोत्तर भारत के कई क्षेत्रों को छोड़कर, जहां सामान्य से अधिक तापमान रहने की संभावना है। देश के अधिकांश भागों में सामान्य से अधिक मासिक न्यूनतम तापमान रहने की संभावना है, सिवाय मध्य भारत और उससे सटे दक्षिण प्रायद्वीप के कुछ भागों को छोड़कर, जहां सामान्य से लेकर सामान्य से नीचे न्यूनतम तापमान रहने का संभावना है। आप थोड़ी से स्क्रीन से बाहर रहेंगे तो हम एक प्रेजेंटेशन देंगे आपको विस्तार से जानकारी देने के लिए। आगे 2-3 कैमरा थोड़ी से साइड में हो जाए तो आसान होगा। चलिए नेक्स्ट स्लाइड। हाँ नहीं वो तो ठीक है, मैंने बाहर जो सब हाँ आप सभी को पता होगा, and all of you might be knowing that during the pre-monsoon season, especially in the month of May, there has been very good rainfall activity. As a result, we have at present the above normal rainfall activity during the pre-monsoon season, starting from 1st March till 27th May. In the right-hand side diagram, you can see that except Northeast India, like Arunachal Pradesh, Nagaland, Manipur, Mizoram, Tripura, and Jammu and Kashmir, Ladakh, and Himachal Pradesh, all other meteorological subdivisions have received above normal or normal rainfall during this period. And you can remember that when we predicted the rainfall for May, we informed that month of May will have above normal rainfall activity over the country. So in this diagram, we are showing on the left-hand side the district-wise rainfall distribution from 1st March to 27 March. you can see that most of the districts have normal to excess rainfall activity. Green indicates normal, blue indicates above normal rainfall activity, yellow indicates, red indicates the below normal rainfall activity. So district-wise also you can find that there are very few districts in northwest India, and there are some districts in the northeast India which have received below normal rainfall activity. Otherwise, most of the districts have received the normal to above normal rainfall activity. On the right-hand side, this is the rainfall at the meteorological subdivision level. Unlike the previous year since 2009, so this year monsoon has set in early. Monsoon advanced over Andaman and Nicobar Islands before the normal date. Near Kerala, usually monsoon sets in around 1st June, and this year monsoon reached Kerala on 24th May, about 8 days in advance. After that, there has been rapid advance of monsoon over South India, and yesterday, that is on 26th of May, monsoon has covered up to Mumbai along the west coast. It has covered most parts of the South India except north coastal Andhra Pradesh and Telangana. On the other hand, most parts of northeastern states has been covered by monsoon, and all these advance, say for example Mumbai has been about 2 weeks in advance of the normal date, and over northeastern states is in about 1 week to 10 days in advance. As of today, conditions are favorable for further advance of southeast monsoon into some more parts of Maharashtra, remaining parts of Karnataka, some more parts of Telangana, Andhra Pradesh, some parts of Chhattisgarh and Odisha, remaining parts of northeastern states, and some parts of West Bengal and Sikkim during the next 2 to 3 days. So as a result of good rainfall activity during month of May, the temperature, both maximum temperature you can see, has been below normal in major parts of the country, especially South India, Eastern India, Central India, you can see. And minimum temperature has been above normal in many parts and below normal. It is just opposite, because once you have got the cloudy conditions, the minimum temperature becomes higher than the normal. The mean temperature, if you consider, it has become South India and adjoining Central and East India below normal to normal, and remaining parts it has been above normal. Now, if you look at the heat wave conditions, yes, heat wave commenced in the month of March, and we have got the eastern part of India and Gujarat, especially the heat wave conditions. In the month of April, it became well spread. Entire north and central India got heat wave conditions, and especially Gujarat and Rajasthan experienced more number of heat wave days above the normal. In the month of May, there are heat wave conditions, but limited only to northwest India, you can say, even up to UP, but it is very limited. Northwest India, especially Rajasthan, experienced continuously the heat wave days for some time, and Punjab, Haryana, Chandigarh, Delhi, and Jammu Kashmir also experienced the heat wave conditions. Taking the season as a whole, the heat wave conditions have been over the climatological zone, that is North India and Central India, and frequency is in maximum over Saurashtra, Kutch and Rajasthan, which is above normal. Now, looking at the large scale features, you will find that at present neutral condition of El Nino and southern oscillation is prevailing. And as for the forecast, the neutral condition is likely to continue throughout the monsoon season. Till the end of season, we will have the neutral conditions, and hence there is no negative impact of the El Nino. And most of the models globally, if you just look at, they are of this opinion that, including our monsoon mission climate forecast system, that this El Nino and southern oscillation will continue to be in the neutral condition. So, Indian Ocean Dipole, which also plays to some extent, but not so much as the El Nino southern oscillations, is at present neutral conditions, and the neutral conditions are expected to continue for quite some time. And there are certain predictions that it could lead to sometimes the negative phase towards the second half of the monsoon season or so. But it is not so much negative. It is very nearby to the negative end of the normal conditions. Now, looking at the forecast for 2025 southwest monsoon rainfall for the country as a whole, as it has been told by Secretary Saab, is 106% long period average and plus minus 4%. And this above normal rainfall is most likely for the country, therefore, during the period June to September 2025. Considering the categorical forecast, you will find that just like our first stage forecast, here also the probability of occurrence of above normal rainfall or excess rainfall taken together is about 59% against the climatological probability of 33%. So therefore, very high probability of occurrence of above normal to excess rainfall. Considering the probability of deficient or below normal rainfall, it is only 9 close to 11% against the climatological probability of 33%. So therefore, this forecast issued by IMD today has a very good confidence that rainfall will be above normal for the country as a whole. Now, considering the rainfall forecast for different homogeneous regions, we consider 4 homogeneous regions. One is the Northeast India, which covers northeastern states, West Bengal, Sikkim, Jharkhand, and Bihar. The other one we consider Northwest India, that includes Jammu and Kashmir, Ladakh, Himachal Pradesh, Uttarakhand, Punjab, Haryana, Chandigarh, Delhi, Rajasthan, and Uttar Pradesh. In Central India, it consists of Gujarat, Maharashtra, then Madhya Pradesh, Chhattisgarh, and Odisha. And then South India consists of Kerala, Tamil Nadu, Puducherry, Karnataka, Telangana, Andhra Pradesh. So considering this, the forecast is that Northeast India can expect below normal rainfall activity during the monsoon season. That means rainfall could be less than 94% of the long period average. Northwest India, we can expect the normal rainfall activity, and normal is defined as anything between 92% to 108% of the long period average. Above normal rainfall activity is expected over Central India and the South Peninsular India. In both the cases, Central India and South Peninsular India, rainfall could be more than 106% of the long period average. Consider the monsoon core zone. You can see the shaded area, pink shaded area on the right hand side map, which extends from Gujarat, Rajasthan up to Odisha and adjoining Jharkhand and to West Bengal. And this area is mostly the rain-fed region of the country, and here agriculture mostly depends upon the monsoon rainfall. And here, therefore, we give a special forecast, and as per the special forecast, here also rainfall is expected to be above normal. That is more than 106% of the long period average. Now let us look at the spatial distribution of the probability of occurrence of rainfall in the monsoon season. There are you can find out from this diagram that there are 3 types of color. One is the blue color, which stands for above normal rainfall. Green color stands for normal rainfall. Yellow to red color stands for below normal rainfall activity. So from the diagram, you can find out that above normal rainfall activity is expected over most parts of the country. Like the first test forecast what we issued, distribution is almost uniform in the country, showing normal to above normal rainfall in most parts, except the many parts of northeastern states and adjoining areas of Bihar, West Bengal, and northeast Jharkhand, and also some parts of northwest India like Ladakh and adjoining areas of Himachal Pradesh, and some isolated pockets of Punjab, Haryana, and North Rajasthan. Also, there are some isolated pockets in South India like southern parts of Kerala or Tamil Nadu, where you can expect the below normal rainfall activity. I will draw your attention to the white shaded region inside this diagram. That indicates that the model could not find out a signal. Then there is equal probability of occurrence of below normal or above normal rainfall activity. So therefore, that means you can say that there is no forecast for those white shaded areas. Now, about our performance, we have done a study after the introduction of our new forecasting system in 2021. And now we have got 4 years completed, 21, 22, 23, 24. If I take the average absolute error of the operational forecast issued during last 4 years, that is 21 to 24, error is 2.28%. It is well within the margin of error, that is plus minus 4% what we issue. And this error is for the first stage forecast issued in the month of April, that is around 15 April. And the second stage forecast, which is issued towards the last week of May, it has got error of 3.15%. Again, it is also within plus minus 4% error limit. So therefore, it has been within error limit in the recent 4 years with this newly introduced forecasting system. Now, if I compare for the previous 4 years, 17 to 20, we found that the average forecaster is 7.5% of the long period average. That is beyond the error limit of plus minus 4% for both the first stage and second stage forecast. So what I want to say that you have a confidence now that the methodology, the model which is utilized by IMD to issue the long range forecast is robust, is having the less error and more accuracy. At the same time, it is providing you the forecast in the different parts of the country, unlike earlier, only one figure for the country as a whole. Now, this is the forecast for rainfall during June 2025. The rainfall average over the country as a whole during June 2025 is most likely to be above normal, that is more than 108% of long period average. And the LPA of rainfall is about 166.9 millimeters. And from the diagram, you can find out that in June also rainfall is expected to be uniformly distributed with normal and above normal rainfall, except some areas in northeastern states, as you can see, the yellow shaded region, and Ladakh. And here also some isolated pockets of Rajasthan, Gujarat, and here some areas of South Karnataka, Kerala, and Tamil Nadu, where rainfall could be below normal during the month of June. Now, looking at the temperature forecast, the maximum temperature, you can find out that as we are expecting good rainfall activity, maximum temperature is expected to be below normal. You can find out that green and blue area is covering most parts except the northwest India and northeastern states, where it is yellow. That is normal to below normal maximum temperature can be expected in major parts of the country except northwest India and northeast India, where it will be above normal. Now, considering the minimum temperature, you will find that just opposite, because cloudiness will be more, the minimum temperature will be more, and major part or most parts of the country is expected to have higher than normal minimum temperature, except some parts of central India and South India, where it can be normal to below normal minimum temperature or night temperature. Now, therefore, as we are expecting temperature to be below normal, so heat wave conditions are not much expected in the month of June, and the number of heat wave days are expected to be below normal in different parts of the country, as you can see in the left-hand side diagram. On the right,
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your personal finance questions, and we speak about everything under the sun with regard to personal finance, whether it is your expenses or investments that you should make, and certainly insurance is something we speak about often, but we don't talk about motor insurance as much. It got me thinking, why do we not talk about it? And that's probably because it's not something you have a choice about. If you have a car or a scooter or a motorcycle, you're regulatorily required to have motor insurance. And for the longest time, this is not something you spent too much time thinking about. You probably got a few calls of people reminding you that your motor insurance policy is due to expire and offering you a certain premium or a certain product, and you would often choose the cheapest product. But is that the right way to look at it? There are quite a few changes that have come about in the recent past purely because of increased competition in the space, and you as a customer have more options available to you. And today I'd like to talk about motor insurance and what you should know about it to somebody who has created that disruption. I'm joined today by Varun Dua, who is the founder and chief executive officer of ACCO Insurance. Varun, thanks so much as always for taking the time. Pleasure having you on the show.
Thank you, Alex. Good to be here.
Yeah, I do want to ask you about that because you cut out the distributor and you offered the product direct on your platform.
Yes.
And it's been a pretty big disruption in the industry from the perspective of the buyer as well. I'm curious, before we get into the building of motor insurance and how you should look at it as a product, what is the kind of behavior shift that you have witnessed as a company?
Interesting question. I think one of the things that we do see is that customers are getting more and more aware about what they want to buy relative to, like you rightly pointed out, it being some sort of a mandatory product which just gets bundled in with your car, or you get an phone call annually, and you just choose the cheapest one. Does that behavior exist? I think it exists, but by and large, we've seen a bunch of customers now starting to really discern, especially in India. Now you have a lot of second-time car buyers or second car buyers, right? A second car in the home or upgrading their car. These customers are fairly now clear about what insurance they want to choose, how they want to self-select into some options versus being chased down on the phone, and are quite adept at choosing their own coverage. There are still some misconceptions, which hopefully we can shed some light on together during this conversation. But yeah, we've seen a sea change from what it was 5-10 years ago. I think customers going directly and buying on platforms like ours is also a refreshing change, because frankly, a mandatory product should not have so much commission built in, and that's what we were trying to at least change from an ACCO perspective.
Okay, interesting. We'll get into cost and we'll get into variance and what is offered in the product, but let's look at the product per se and try to define it. A lot of people look at it as this whole, but it's not that. It's actually a sum of the parts. So if you were to be asked by an average person like me, how should I look at motor insurance for a car or for a motorcycle that I own? Is there a base policy plus? How would you describe it?
Yeah, I think I think most people I've met don't understand the complexity of that. It's not one product. It's actually at the minimum two and sometimes two plus products that are bundled in when you talk about car insurance or bike insurance. The first distinction to make is that we've all heard, the stories of a cop catching you and saying insurance ka paper kidhar hai. Now that insurance, what the government wants or the law of the land wants you to have is called third party insurance. Just for understanding, that third party insurance is basically taking care of your risk in case your car ends up hitting someone else. It could be that person could, have an injury, could lose a limb, or God forbid, worst case scenario, lose their life because you were driving. It could be an accident. You could lose control of the car, or you could hit someone else's property. That means that family or that person who's lost something because of your car needs compensation, and I may not have the money to pay that compensation. That's what third party liability is. That means I'm liable to the third party. This part of the product, where because my driving or my car could injure somebody or cause destruction somewhere else, and that person needs to get compensated, is what is called third party liability. This is the part that is mandatory. If you have only this product, the cops are okay, the government is okay, because they're saying whether if your car breaks down, or if your car has a broken bumper or a tail light or whatever it is, you can fix it using your own money. Whether you have insurance, you don't have insurance, is up to you. But if your car hit someone and they have to get hospitalized, you better pay up. And that's where the insurance part comes up. So mostly what all of us buy is typically called comprehensive insurance, which has third party, which is the mandatory part. And the second bit, which is called own damage, which is damage to your own car. That's why it's called own damage. This is a third party damage. This is own damage. So when we buy it, we buy actually this bundle together, which takes care of the risk of hitting someone else or the damage to our vehicle itself. So those are the two pieces that typically get bundled together.
I do want to ask you, sorry to cut you, and we'll build on this, Varun. Thanks so much for that breakdown, because so ultimately you're talking about two halves of this motor insurance product. One is mandatory, the other you can or cannot go for. Most people do go for it because ultimately that's one of the primary purposes of getting motor insurance. But actually, a lot of people don't know that regulatorily what they're required to have is the cover in case they do damage to somebody else or their property. So I'm glad that you've stipulated that. Now, if you are, as an insurance company and a seller of insurance, to explain from your perspective, let's not get into actuarial formulae or anything like that, but when it comes to the costing of this, what I pay as a premium, ultimately it's dependent on the risk involved. So how is it determined? Is it so the third party, I would think, is based on my behavior and based on certain other parameters, whereas the second thing, which is the own damage, would be partially dependent on my behavior and also on the vehicle involved, right?
Yeah. One slight, maybe correction, if I can use that word.
Yeah.
So today in India still, while it's fairly deregulated as a market, and there's a lot of openness in how you can design products from IRDA, the third-party liability portion of the premium that you pay, if you're paying A plus B, that third-party liability premium is not decided by the insurance company. It is decided by the government. So, and it is decided by the regulator and MORTH, which is Ministry of Road Transport. They jointly come up with the rates for third-party every year or every couple of years, and all insurance companies have to follow the same rate. And it depends on the class of vehicle that you are driving. So, of course, a truck would be something else, a car would be something else, a 1000cc car or a 2000cc car, a sedan, SUV, everything has a separate rate. So there are segments for which, but the rates are stipulated by the government. So the insurance company is really not deciding the rates. They are actually just applying the rates that have been provided by the government and the ministry and the regulator. The own damage part is where you are free to price, or an insurance company is free to price the risk. And to give you a sense, you're absolutely right. Your driving behavior, to how many claims or accidents that you've had, to the class of vehicle that you own. For example, there are certain cars which parts are imported, right? So it may not be a very expensive car, but the parts are not locally manufactured. So getting those parts or replacing those parts is usually expensive. So your own driving behavior or record and the class of vehicle that you drive decides your own damage premium. So the own damage plus the government price that has been decided for third party, they come together and you pay a single price. That's how it works.
Got it. Okay. So, and then you have some other terminology here, which is things like zero dep, which is zero depreciation. There is, water damage. There is, certain other rodent-related damage. Are these all add-ons? How do they work?
Yeah, I think, it's interesting as competition came up in India and globally also when it came up, people started differentiating a product, which is a commodity product, right? Essentially, it's covering damage to your car. I'm no longer talking about the third party. I'm talking about just the damage to your car. Now, one of the things to understand is that and zero dep is probably the biggest one and the most critical one to understand. Is essentially when you buy a car and you buy insurance, every other car depreciates. Which is, forget insurance for a second. If you now try and sell a 3-year-old car, of course you're not going to get the same value for the car that you got when you bought the car, right? The car is going to depreciate over 3 years, and the market value of that car could come down by half in 3 years. Now, that means the market value of the bumper has also come down by half, which is, let's say, if a brand new bumper was put in, which was costing 10,000 rupees, when the car costed 5 lakh rupees. Now, if the car is costing 2.5 lakh rupees, but it's because it's depreciated, the value of the bumper has also gone down from 10,000 rupees to 5,000 rupees. I don't know whether I was able to explain.
No, it's pretty clear. It's pretty clear, yeah.
So when now it's a 3-year-old car, I end up banging that car and I have to replace my bumper. Of course, I'm not going to give you a 3-year-old bumper. I'm going to give you a brand new bumper. And when I give you a brand new bumper, that bumper cost me 10,000 rupees. But the value of the bumper as it stands today is 5,000. So 5,000, I'm keeping the math simple. So 5,000 will come out of the customer's pocket because you are getting indemnified for the value of that bumper, which is now 5,000, but I'm giving you a brand new bumper, which is 10,000. So 5,000, Mr. Customer, you have to pay from your pocket, which is the depreciation part of the payment that needs to be made. That bumper is depreciated by 50%, so that 50% is paid by the customer, 50% is paid by the insurance company. If you don't want to pay this, you have to buy this zero depreciation policy or the zero depreciation add-on, where you're saying, hey, charge me more, but I want the full cost of the bumper. Don't charge me the depreciation. If the customer doesn't want the depreciation to come out of his own pocket, they have to buy this add-on. So now when I put a 10,000 rupee bumper, the customer doesn't have to pay the 5,000 rupees I was speaking about because they bought this add-on. That's what it means. It's good, but it's not necessarily very good because these policies are expensive. So they work better for younger cars, newer cars. And if the car is 6-7 years old, it just sometimes doesn't make sense.
Oh, okay. So that makes sense because ultimately after that, the amount that you're paying is unnecessarily high. Is that fair? So the cost of that zero dep add-on is more the older the car gets. Is that the right understanding?
Yeah, in some sense, it'll get very expensive, and a lot of companies, to avoid fraud, might not even offer it. Okay. To give you a sense, if my car is 6 years old or 7 years old, and now I want to sell my car in general outside of insurance, it creates a behavior of replacing most parts to make my car newer so that it can get better value.
Yeah.
So customers also sometimes, or bad actors, let me not call them customers, bad actors also try to game the system by trying to do some of these things. So typically after 5 years of the ownership of the car, this add-on is either very difficult to get or very expensive. So my general advice to customers is it makes sense in the first 3 to 5 years. After that, it doesn't make sense.
Yeah, insurance is not meant to make a product more valuable, ultimately. And so therefore that is an easy metric to understand. You mentioned zero dep. and zero depreciation, and you explained it pretty well. This is one major add-on. What are the other add-ons that are relevant in places like Mumbai? And here we're talking about a time when we've had an early onset of the rains. We're talking about possible flooding in certain areas. What do you need to know?
So one of the things that mostly a misnomer around is that the insurance covers when there is an accident. Okay, an event needs to happen. That event could be, it's not just two cars colliding, a tree could fall on your, a branch could fall on your car, or any of those things could happen, but an event has occurred. So a flood is an event. If there is minor flooding and your car is submerged, typically it will cover your car, the repair to your car, but it does not cover your engine, because there has been no damage to that, no damage to the engine that has happened. There is something called engine protect. So for example, if your car is waterlogged and you try to crank up the car and the engine misfires, typically because of water damage, the engine can, misbehave or just completely become useless. This is not caused by an accident. Okay, this is caused by you cranking up the car with water inside it. Okay, especially very critical for now electric vehicles and ICE cars and so on and so forth. In such a scenario, the engine damage, which is a very expensive part of the car, the engine itself, may not be covered. So let me give you an example. If I have an accident on the highway and somebody hits my car from the front and there's damage to the engine, it will be covered because it was part of an accident. But in this case, you just cranked up the engine. That's why it's very technical. Cranked up the engine. There was no event. The engine was waterlogged and you cranked it up. There was no event. The engine does not get covered. So because there was no accident, in per se. So the other one, in especially areas like Chennai and Mumbai, which see constant flooding, nowadays, frankly, even Bangalore, engine protect is something good to have. Where it allows all sorts of damages to your engine to get covered. Beyond that, there are many. There is consumables cover, there is roadside assistance, there is return to invoice. There are many small add-ons. There are some keys also now which are very expensive. You have these wireless keys which sometimes could cost you 10,000-20,000 rupees just to replace the wireless key if you lose it. There are lots of small add-ons, but my general sense after being in the industry and watching consumers is probably between zero dep and zero dep and engine protect is where 80% of the uses are. The rest of it is relevant. If you want complete peace of mind, you should go for it. But these two probably are the most important ones.
Yeah, and also as you have an older car, as you pointed out, may not make sense to get even zero dep. But there's one more technical term that I want to discuss with you, and then we'll get into the claims aspect. The insured declared value.
Yeah.
Is that related to what we discussed in terms of the depreciation of the car?
Yeah, to a degree, it's so typically an insurance company would apply a depreciation chart to say that every year the value of your car comes down, and this number is relevant for two scenarios, specifically what we call total loss and theft. So now it's no longer about the repair of the car. You've totaled the car. Let's say it's beyond repair, or the car is stolen. So there is one finite value that needs to come to you, one fixed amount that needs to come to you. That is what we call the IDV of the car. Now that IDV of the car is really relevant only in these two scenarios, which is the total loss, which it is, it is called BER actually, technically, beyond economic repair. That is, there is no sense in now trying to repair that vehicle. It's total loss. And of course, if the car is stolen, that's when you get the IDV, which is the value of the car post depreciation. Now, because there's no perfect science to say what is the value of the car in the fourth year. Okay. It depends on variety of factors. To give you a case in point, Ford left the country a couple of years ago. The value of the cars would drop because, hey, will spare parts be available, not available? Just market value of the car may drop. So because there is no science, we operate in ranges. So the insurance company would give a broad range of what your value of the car could be. As a customer, you can, in that range, go for the higher value or go for the lower value. the only difference this makes is if you go for the higher value, the premium goes up. Correspondingly, the premium goes up a little bit. Your main benefit in choosing the higher value is that if your car is stolen or if your car is total, which is beyond repair, you get the bigger value.
Okay. Okay, understood. Now, you very nicely explained at the start the premium that a customer pays, and a portion of that, as you pointed out, third party is controlled by the government and government agencies. And so if that is revised upwards, ultimately everybody has to pay more. Does the other part of the insurance, which is own damage, get adjusted for inflation over a period of time? Does that keep going up?
Yeah. We've seen that it keeps going up by about, I'd say on an average, anywhere between 5 to 10% every year. And the reason it's regular inflation. So let's just simply to understand it. If the cost of the car part that needs to get replaced is going up, of course the value of the insurance will go up. If the labor charges, what mechanics charge in workshop to actually fix your car, as their wage bills keep going up, like any other job profile, that all that gets factored. Not like we sit and actually calculate how much of the wage bill is going up, but basically labor charges, part charges, bunch of these things. Typically, like any other part of the economy, these things will also go up, and therefore it gets priced in. Even on the third party side, which is the government decided rates, they also account for inflation and they increase the rates every couple of years. Right now, as we speak, last 4 years, there's been no increase. So we are due for an increase on the third party side. So premiums are likely to get expensive, slightly more expensive sooner or later. But probably the best way to understand it is that unless you've had many accidents and many claims, in which case your premium can shoot up, on a normal case, you will see a 5 to 10% inflation every year.
Okay, and you did mention a few instances where certain cars cost more. I think there is a perception, and you got to tell me if it's true, that certain vehicles that are also used as fleet cars in the transport space generally attract a higher premium, and these are well-known vehicles that are also used in the passenger space. Is that true?
Yeah, that's a very interesting one. See, whether a car is getting used commercially or privately, or a vehicle is getting used commercially or privately is very clear because the number plates in India and the registration data is very clear what is being used commercially and what is being used. You have that yellow number plate, the registration says commercial use. So there's, let's say, a Toyota Etios, which we come across in Uber, Ola, sort of situations fairly often. So there are some of these cars which are registered for commercial use. That's not the problem because they're registered for commercial use and commercial rates apply. The problem starts to happen, or not problem, where customers can need to understand is there are some vehicles which are quasi-commercial, which we believe that take a Tata Sumo or a Qualis, or some of these, Boleros, which we have seen in many parts of the country. They don't get registered as commercial vehicles, but they're being used commercially. It could be in villages, in tier 3 towns to transport people, and they're being used roughly like a taxi or a transport vehicle. And that's when this becomes like roughly a negative profile for the insurance industry, that we don't believe this car is being used privately, even though it may be registered as a private vehicle. And sometimes the rates for these kind of cars or these kind of vehicles tends to go up because they don't believe, the insurance industry doesn't believe that this car is being used for private purposes.
Got it. Okay. All right. The last aspect has to do with claims. And as a relatively new company, I'm sure that you had to deal with quite a few issues here. And generally the perception, and this is anecdotal evidence, that you've actually attempted to do as much as you can to ensure a seamless process. You're completely digital. What do you need to know from the perspective of a customer making a claim so that this entire process is seamless?
See, customers don't have to do much actually. All the customers have to do is report that incident. They could, like for a company like ACO, they could just come onto the app or the website and just tell us what happened in case they're in a difficult situation. Let's say the car is stuck on the road, they could just pick up the phone and talk to us, and somebody will come pick up the car, take it to the workshop, repair it, get it back, and everything. For them, they just have to keep approving stuff and on the app. So all that they need to do is either speak to someone and use the app and say this is what has happened, and somebody just takes over from there. I think one thing customers should be careful about in general, whether they deal with ACO or with any other insurance company, is have a clear view and not let the workshop or the dealership or wherever they want to take their car decide what will go in claim, what will not go in claim. One of the things that we've noticed is that customers tend to doubt themselves and try to trust the workshop to handle the claim for them. And it is in the interest of the workshop to increase the billing as much as possible. Because whatever repair money will go to the workshop is revenue for them, and that hits the insurance rates of the customer in subsequent years, right? Is to just be aware that they should not hand over the entire process to the workshop and work in parallel with their insurance company. I think not only ACO, most insurance companies in India, I would say, are fairly fair. They are deeply regulated. So it's not that much of a trouble to deal with an insurance company. I think it's a perception. It's when you want to use a middleman, usually, is when you don't realize that their incentives might be different than your incentives.
Okay. A quick last view, just to give us some color and perspective. Again, you don't need to answer this. I'm just asking out of curiosity. What is the kind of traction that you've seen, particularly at the first leg, in that when you're at the showroom? Because I think that's something that a lot of people have realized when they're buying new vehicles. They don't necessarily have to buy it as a bundled product.
Yeah, that's the most, I'm going to say something semi-controversial, if I can say that. The customers in India have lost thousands of crores of rupees over the last 5 years, collectively, of course, not one customer, in buying insurance which is 2 to 3 times of what they should be getting charged for insurance, because that's the amount of commission that gets bundled in a new car. To give you a sense, you don't even negotiate your insurance premium when you're buying a new car. You're essentially talking to the car dealer for on-road price, right? Finally, on-road mein kitna discount milega, or you're just trying to negotiate what will you're negotiating a package versus negotiating accessories or insurance separately. And what customers don't realize is that there's a huge amount of commission built in. I'll give you a number as we speak right now. It may not be surprising to take a car like Tata Nexon today, which is, let's say, a popular car, and go to a car dealership and take any popular car. Let me not get into specific names. Take any popular car and you'll figure out that the premium could be anywhere between 75,000 to 1 lakh rupees at the dealer. The actual cost of it, or where ACO would be selling that, probably be 40,000 bucks. So what we've seen is customers now starting to understand that they don't need to pay so much for insurance. There's a lot of bundling in and a lot of commission that gets set in while buying the new car. And the first leg, like you pointed out, it's been very exciting for us to see. I mentioned right at the beginning of this conversation that most second-time car buyers could be upgrading their old car or buying a new car in the household, are starting to look at insurance differently. And when we look at our ACO data, most people who are decoupling the purchase of the insurance from the dealer when they're buying a brand new car are smarter, financially savvy, more astute customers, and realize that they can decouple this financial product from the car.
Fair point. All right, Varun, on that note, thanks so much for taking the time for speaking to me on NDTV Profit. And that brings us to the end of this edition of Your Money Matters. You know now more than you did before about motor insurance. Thanks so much for watching. This is NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Mr. Kejriwal, thank you so much for speaking with us. It seems like a very, very solid quarter. What has aided the numbers and the profits? You've also sharp inventory decrease. Is that one of the key reasons?
Good morning, Samanna, and thanks for having me. I think the basic reason is our T&D ratios are improving. The share of T&D is going up both in the order book and the revenue. Also, we have been able to, close some of our legacy orders which were part of the COVID era, etc. So those are, I think, I'll say two major reasons why the margins are going up, and we have been talking of improving them further next year.
Okay, tell us about the margin expansion that we've seen. Want to understand if this is something pushed by factors we've seen this quarter. Is it sustainable? What are the kind of margin levels you're seeing for the financial year?
So, Tamanna, if you look at the margins for the year, we have ended up at 7%. For the quarter, at 7.8%. And generally, we have been saying that we will be between 8 to 8.5 for the next year. And I'll not say it is one-off. It has been a sustained effort to close old projects and push revenue in the newer projects. Also, we talked about order book being order intake for the year being close to 25,000 crores. So what has helped us is that with the growth in the tender pipeline, we are becoming much more selective in the orders which we take, looking at cash flows, looking at margins. So clearly the order book is looking much more healthy than what it was at the start of the year in terms of margins and cash flows.
Mr. Kejriwal, good morning. Neeraj here. Congrats on a good year as well. I reflect back upon a conversation that we had in June last year, wherein you said that you've never been so bullish in your 22 years of working in this industry. I wonder if that optimism still continues.
Yes, it still continues, and now it's 23 years. And especially what happens is, if you look at the India T&D piece, government was talking about 500 gigawatt of renewable by 2030. Now they've made it 600 by 2032. And, the work just continues, especially on the renewable front, both on the transmission lines, substations. In fact, the Prime Minister inaugurated a few lines yesterday and also last week also, and many of them were built by us. So we are clearly seeing at least a 4 to 5 or maybe 7 years run in the India piece. And similarly, international, our largest markets is Middle East. So whether it's UAE, whether it's Oman, whether it's Saudi, and we are just seeing a consistent flow of tender pipelines. So I think we are pretty confident that at least for the next few years, this growth in the T&D piece will continue.
That was going to be my question, Mr. Kejriwal, that almost everybody is complaining that while the assets are there, evacuation is not happening, and therefore T&D will be on a war footing in FY26 and 27 maybe. Now, do you sense that, and therefore, while you've grown your T&D execution by 28%, and I believe the order book uptake, T&D is about 60% currently for you, would you reckon that that will only get, pick up pace in FY26, both execution and order inflow?
I'm not sure the order inflow will pick up pace at the same level. Okay. Because I think a large part of ordering has happened. It will continue to grow, but execution has to pick up. There's no question about execution not picking up. And that's why, we do expect that our transmission revenue should grow by at least 20% in FY26.
Let's talk about I want to come back to the core numbers just for a second before we get to the outlook, Mr. Kejriwal. In terms of what has aided, we talked about the decrease in inventory. You've seen expenses come in, other incomes go higher, and other income has actually gone up significantly. Just trying to understand where these now sit on your books in the quarters to come so we can get a more comprehensive assessment of the top line.
So other income is not consistent. I think this year we had some interest income from income tax refund, etc. But typically, I think we have been getting 20, 30, I don't know, 30, 40 crores of other income through asset sales or through interest income, arbitration awards, etc., etc. I think that's where the other income part of it. But I think, Amanda, what you should look at is our interest cost. For the quarter, it was at 2.5%. And for the whole year, 3%. And next year, we're talking about the overall number going down to 2.5%. So the increase in the PBT and the PAT would be significantly higher than what we see in the EBITDA. You can see this year also, EBITDA has gone up by, I think, 25-30% in terms of percentage, whereas the PBT and PAT have grown by more than 60%. Other pieces that we have got a lot of, I'll say cash revenue and margins coming in through our Middle East subsidiaries, where obviously the tax rates are slightly lower than India. So our effective tax rates have also helped us in improving the PAT.
Okay, so that's important because that's something that carries on from quarter to quarter. Just want to talk about your order book, healthy order book. What is the outlook or the number that you've penciled in for this financial year, Mr. Kejriwal?
So last year we touched around 25,000, which was our guidance. This year we expect to do around 30,000 crores. That's the broad number which we are looking at for our order intake.
To do an additional 13,000 crores for your order intake, and this is focused on
30,000 for the year, 30 for the whole year.
30,000 for the full year, and this is going to be focused on international markets, because I know your split is about 40-60 international to domestic, if I'm not mistaken.
It's broadly, order intake has been around 70-30. Let me explain for you that T&D is something which is, we are there international. Other businesses we are not there. Hopefully this year we should get some orders in civil, etc. So it may become 40-60. Otherwise, India has been typically 70. So India T&D plus civil plus railways, all is India. And T&D is only the only game in the international. But hopefully some more orders would come in civil and all that, in which case the ratio could be 60 India and 40 international.
So, which was my question going to be, Mr. Kejriwal, that if indeed your T&D order intake from 28 or 29% in the current quarter or the year goes down to, let's say, 20%, right? It was 28% for the quarter or for the year? One of the two, right?
For the year.
For the year.
For the year, the growth.
And you mentioned that it will go down to or be 20%. So therefore, it goes down from 28 to 20. So are civil orders gonna come in thick and fast, or is it a fact that the overall order inflow will decelerate, part one? And part two, would the operational metrics be materially different between T&D versus the other segments?
So Neeraj, what I said on 20% was the 21% of the revenue growth, not the order intake. I think